everyone. I hope you are doing great. I hope you are doing amazing, and I hope your preparations are going amazing. Okay. So without wasting our time, since your time is very, very limited now, you'll have very less time and we need to discuss a lot of things. Okay. So I have planned 2 days marathon for you all. In the next 2 days, what are we going to cover? We are going to cover at least 80 to 90%. At least 80 to 90% of the syllabus. And tomorrow I will be discussing some questions. People have reached out to me regarding pre-populated sheets. So tomorrow we'll be discussing our pre-populated sheets also. How do you attempt pre-populated sheets especially for your consolidation? Okay. So let's start with our discussion. Let's start with IFRS 15, revenue from contracts with customers. I will share these notes with you all, and these notes I have prepared with a little bit different structure over here. We will start with mind map. So when you have a mind map, you know what are the areas that you need to cover, what are the areas of our IFRS 15 that we need to cover. So we will start with our what is a core principle, when do you recognize revenue, then all the 5-step models. Then we will discuss 5-step model in detail, then each step in detail. Contract identification, what are the criteria of identification of contract modification and all. Then we'll go with performance obligation, then transaction price, allocation of transaction price, then revenue recognition. When do you say that PO is satisfied over time, when you say PO is satisfied at a point in time. Then your special areas that we had discussed: sale with right to return, warranties, principal versus agent, non-refundable upfront fees, consignment arrangement, and repurchase agreement. So when you complete all of these points, then and only then you can say that you've understood IFRS 15 in depth. So let's start. IFRS 15, revenue from contract with customer. We started our discussion with this chapter only. That is IFRS 15, revenue from contract with customer. Earlier, prior to IFRS 15, revenue recognition was very, very simple. What was it? You received cash, you debit cash, you credit your revenue. You have sold goods on credit, you debit your receivable, you credit your revenue. Now it is not like that. Now revenue recognition is not that simple. You do not recognize revenue just because you've received some consideration. The important principle that you need to remember, that you need to take care, is you recognize revenue only when control of goods and services transfers to the customer. You can recognize revenue only and only when the control transfers, that is, the performance obligation has been satisfied. If you have received any consideration and for the consideration that you expect to receive. Now, what is my 5-step model? What are the 5-step? Very, very important. The heart of this chapter is 5-step revenue recognition model. So step 1 is what? Identify the contract with customer. Step number 2, identify performance obligation. Step number 3, determine the transaction price. Step number 4, allocate the transaction price. And step number 5, recognize revenue. So you should, by this time, it should be in your system. All these 5 steps should be in your system. Now let's learn each and every step. Let's revise each and every step in detail. Contract identification. You conclude that there is a contract only and only when all of your conditions are met, all the conditions are satisfied. Now, what are the conditions that we need to satisfy to conclude that there is a contract? The contract should be approved by the party. Approval has to be there. Rights have been identified. Your rights and my rights have been identified. Payment terms have been identified. What are the payment terms? The contract has commercial substance, and the last one, collection is probable. Okay, ma'am, we have understood. So these are the 5 conditions that should be met to say there's a contract. Ma'am, what if the contract does not meet any of this criteria? Then there is no contract. Your first step itself fails. You cannot go to the next step. So if there is if your contract does not meet any of this criteria, you cannot recognize revenue. So for example, if the customer is financially unstable and collection is doubtful, the contract may not exist and you cannot recognize revenue. So what happens when the criteria are not met? If criteria are not met, then you continue to assess the contract in future. Check whenever the criteria has met and apply IFRS 15 only and only when criteria are satisfied, when the criteria is met. Now there's one crux over here, there's one special area that you need to focus. This can bother you, this can trouble you a little bit in your examination. What did I just tell you? If your contract does not meet any of these criteria, you cannot recognize revenue. But my dear friends, if you have received consideration, you can recognize revenue even though your contract does not meet the criteria. But when you can recognize revenue? When you have no remaining obligation and consideration is substantially non-refundable. You have received substantially all of the consideration and it is not refundable. For example, my consideration is 100 and I've received at least, let's say, 90 or 92% of my the consideration. You can recognize revenue. One important point over here is the consideration has to be non-refundable, and second point, the contract has been terminated and the consideration is not refundable. If these two situations exist, then even if the contract does not meet the criteria, you can recognize revenue. Okay, ma'am, we have understood. Now, otherwise, what do? You recognize a liability, you recognize a contract liability. Now we go to the next part, that is your contract modifications. Ma'am, what is a contract modification? Contract modification basically means there's a change in scope or price of the contract. So for example, you contracted with me for SBR. You said, ma'am, please teach us SBR. So here, understand, if I'm teaching you, if there's a contract between me and you to teach you all SBR, this is one contract. But in between, let's say we were just done 50% of the syllabus and you say, ma'am, we also want to learn AAA. Now here, there's a change in scope, or if there's a change in price, then you say that either my scope has been expanded or the price has been changed. You say there's a contract modification. Now, when do you treat the contract as a separate contract? My dear friends, mind you, you can treat your contract as a separate contract only and only if both the conditions are satisfied. What are both the conditions? Additional goods and services are distinct and price reflects SSP. And what do you mean by this? So for example, let's say, hey, this is me and this is you. Okay, you contracted me for SBR. You said, madam, please teach us SBR. Then throughout, while we were in the process of learning SBR, you said, ma'am, we also want to learn AAA. We also want to learn AAA. Now here, there is a change in scope. You see, the additional, I will be providing you with additional goods and services. Now, when do I teach SBR and AAA as separate contract? When there is additional goods and services that I'm going to provide are distinct and the price that I'm going to charge for AAA is will reflect SSP. It reflects SSP. And what do you mean by it reflects SSP? It means what? For normally, let's say you are my student and if I give you any discount, then it will not reflect SSP. SSP means what? Stand-alone selling prices. Normally, if anybody else wants to learn AAA, I would charge 30,000, and if I'm charging the same from you all, then we say that the price reflects SSP. You can say that both the conditions have been met and you will treat AAA as a separate contract and SBR as a separate contract. Okay, now we go to the next part, that is, for example, a customer buys extra software and license at a market price. Then it is a separate contract. Now, termination and a new contract. When do you conclude that it is not a separate contract? You terminate and you recognize a new contract used when the remaining goods and services are different and price is not SSP. Here, when your price does not reflect SSP, you will terminate the original contract and you will recognize a new contract. Okay. So the treatment is your prospective adjustment. Going forward, you will adjust this treatment. Now, part of an existing contract, when you treat it as a part of an existing contract, when remaining goods and services are not distinct. When I'm providing you something, for example, I'm teaching you SBR. And let's say there's a contract modification. You said, let's say we contracted only for 2 chapters, but in between you said, ma'am, let's make it 2 more chapters. Then it is the goods and services that I'm going to provide is not distinct. Then you will treat it as a part of existing contract only. Now we go to the next part, that is performance obligation. What do you mean by performance obligation? My dear friends, IFRS 15 performance obligation has to be distinct, separate performance obligation. Start using these words whenever you're solving your case studies. please start using these words like distinct performance obligation, separate performance obligation. So my dear friends, you will have to identify separate and distinct performance obligations. So ma'am, when do we conclude that the performance obligation is distinct? When both the conditions have been met. Ma'am, what are both the conditions? It is capable of being distinct. It means what? You can identify it separately. And second, distinct in contract context. It means what? It is not highly integrated. So for example, my dear friends, let's say you and I contracted. Let's say there's a contract for, let's say we want to get Nawaz sir married. Now here there's a contract between me and you to between me and Nawaz sir to get Nawaz sir married. Now here, understand, I have received a wedding planner contract. Now wedding planner services are highly integrated. Okay, I mean I cannot step down from the contract after just providing him with one or the other service. Are you understanding? If there is a significant integration, even though your performance obligation can be separately identified, but if there is a significant integration, then my dear friends, you treat it as a separate performance obligation. You do not treat it as a distinct. You treat it as a separate performance. You treat it as a If there's a significant integration, you treat it as a single performance obligation. You do not treat it as a separate performance obligation. Now, for example, mobile plus data package, it is a separate performance obligation. But if you have contracted for a customized factory, then it is a single performance obligation. So, ma'am, long story short, ma'am, when you say that there's a separate performance obligation, there's a separate performance obligation. When you conclude that there's a separate performance obligation, first, your performance obligation can be separately identified. It means what? You can identify it separately from the contract. Plus, there is no significant integration. There is no significant integration. Okay, then we say that the performance obligation are separate. If either of this condition is not met, then you say there is a single PO. If both the conditions are met, two different POs. If both these conditions are not met, we say there is a single PO. Okay. Now, separate PO versus combined POs. Now, what are the separate POs? For example, phone and service contract, laptop and maintenance contract. When do you say that there's a combined PO, that is a single PO? When we're talking about construction contracts, or when we're talking about integrated software systems. Now, what are the indicators of a single performance obligation? What are the indicators? What are the signs that we look into the question that will indicate that the contract has a single performance obligation? First, there is a significant integration. The contract to get Nawaz sir married. Significant modification. One contract, one performance obligation significantly modifies the another performance obligation, and these are highly interdependent. If that is the case, you say that it is a single performance obligation. So, use wordings, goods and services are highly interdependent. You use these words, okay? Tell your examiner that you know everything. Now we go to the next part, that is your transaction price. Ma'am, what do you mean by transaction price? There are multiple components in transaction price that we need to discuss. The first one is fixed consideration. What do you mean by fixed consideration? The fixed promised consideration that I promised, the fixed consideration that I promised from here, the fixed amount promised in the contract. For example, 1 lakh of a fixed contract value. Now, what is a variable consideration, guys? Here, discounts, any rebates, bonuses, penalties, and refunds. Any of these situations that you see, these are what? Variable consideration. Now, ma'am, when do you recognize variable consideration? When you include variable consideration in your transaction price, my dear friends, use the word when it is highly probable. Okay, highly probable that significant reversal of revenue will not occur when the uncertainty is resolved. Okay, when these conditions meet, then and only then, when there's a variable consideration, you use this word that you recognize variable consideration, you include variable consideration in your transaction price only when it is highly probable that significant reversal of revenue will not occur when the uncertainty is resolved. So now, ma'am, what are the methods of calculating our variable consideration, guys? First one is EVM, expected value method. When do you use expected value method? When there are multiple outcomes. Second is what? Most likely amount. When there are two possible outcomes, either this is going to happen or that is going to happen, then you will use what? Most likely amount. So for example, bonus, if 100% project is completed, if the project is completed on time, then entity expects a completion, include expected bonus subject to constraint. So you apply here, you will apply what? Most likely method. Either we'll complete it on time or we will not complete it on time. So if there are multiple outcomes, for example, if your let's say the contract says if your work is completed by 20th of May, then you will get 20% as a bonus. If it is completed by 30th of May, then you will get, let's say, 10% of the bonus. And if it goes beyond 31st of May, let's say it is completed by 5th of June, then you will get 5% as a bonus. So here guys, if there are multiple possible outcomes, then you will apply expected value method. Ma'am, how do you apply expected value method? The question will give you the probability weight. Okay, let's say the chances of this happening, us completing the work by 20th of May is, let's say, 70%. Okay, the probability is 70%. Here, the probability is 20% and the probability is 10%. So you will multiply both the amount of variable consideration and the probability, and that amount will be your variable consideration. This is your expected value method. Most likely, either you will recognize it or you will not recognize it. Now, constraints on variable consideration, as I just mentioned, it is highly probable that no significant reversal of revenue will occur when the uncertainty is resolved. Now, what are the factors that will affect? Now, these are the indicators. Okay, after studying multiple questions, after studying a lot of questions, I have come to this conclusion that if these are the indicators given in the question, you say that there's a uncertainty. There's an uncertainty regarding your reversal. So, for example, long uncertainty period, long period of uncertainty. So here you are not sure whether you can include this in your revenue or not. Then don't include. Limited experience. For example, let's say management say, so we start teaching SBR. If your students get all world rank, we will give you a bonus. Now, if I have limited experience in teaching, I don't know whether my students will get all world rank or not, then I will not include a variable consideration. Then external market dependency. Here, so if my variable consideration is dependent on external market, then I will not include it. Now we go to the next part, that is your significant financing component. Guys, whenever you watch this video as a recorded part also, I will highly recommend you all to watch this, because here in a very short span of time, I've tried to cover all the important concepts. You all won't have to, go through books again and again. You just go through these notes, you just go through this video once and you will be done, One day before exam, that's it. I'm telling you, the notes are that concise, the revision is that concise and that detailed, that one day before exam, if you just go through these videos, you will be ready for the exam. But yeah, provided that you have practiced before, okay? If you just watch these videos and go for exams, then it won't help. Provided you have, studied enough, and provided you have revised enough multiple times, 3 times revision, 3 mock tests you have given, then and only then you will be in a position. Now, significant financing component, SFC. It exists only when timing gives timing of payment gives a financing benefit. Now, my dear friends, there can be 2 possibilities. Either let's say there is a customer and there is a supplier. So we say it is a supplier and there is a customer. There is a possibility that supplier is getting a significant financing benefit, or there is also a possibility that customer is getting a financing benefit. Okay, so ma'am, when this is possible, so the way I used to teach you all, the way we did in our normal classes, see, there are 2 possible situations. First, PO is satisfied. Second, PO is not satisfied. Okay, PO is satisfied but payment is pending. Okay, let's say I am done teaching you all, but you all will pay me later. So here, who is getting? I am supplier, provider of services, and you are a recipient of services. You are a customer. Now I am done teaching you all, but you will pay me, let's say, 2 years later. There's a time gap between the PO satisfaction and payment. So here you all are getting significant financing. I mean, here you all are getting financing benefit. It means what? I'm done teaching you all. I can credit revenue. In my books, I can recognize revenue because the performance obligation has been satisfied. I will debit a financial asset. I will debit receivable. Now that we've completed the syllabus has been completed. So I hope you all understand that receivable is your financial asset. I will debit a financial asset. At what value, guys? This will be recorded at present value. This will be recorded at a present value. Going forward, what will happen? You will debit your financial asset and you will credit your interest income. It is a finance income. Interest income. Now, let's say 2 years later, whenever you pay me my amount, what will I do? I will debit bank and I will credit financial asset. That is, I will derecognize my receivable. Okay, ma'am. Now, second situation, when PO is not satisfied, but payment is done. Payment is done. You have paid me, but I'm yet to teach you all. Here, I am getting a significant financing benefit. Okay, I'm getting the financing benefit. So what do we do in this case? You recognize bank. I mean, you debit your bank. What recognize bank? You debit your bank and you credit financial liability. Okay, I am going to pay you later. It is a loan for me. Are you getting me? Sorry, my bad. You have paid me, but I'm going to teach you all later. Here, it is a benefit for me, so I will treat it as a loan. I will treat it as a financial liability. Going forward, what I'm going to do, I will debit my interest, not income. I will debit my interest expenditure and I will credit my financial liability. So whenever I'm done teaching you all, let's say 2 years later, when I'm done teaching you all, I will derecognize my financial liability and I will credit my revenue. Simple. So this is the only thing that you need to remember in your significant financing component. Very important, but if your concept is clear, you will be in a great position. So usually you can expect, if they're testing you all on significant financing component part, then definitely they will merge it with IFRS 9 because financing and financial instruments go hand in hand. So make sure you understand what is a financial liability and what is a financial asset. Ma'am, what are the indicators of a significant financing component? There's a long credit period, okay? And there's a large timing gap. I mean, I'm done teaching you all today, but you will pay me, let's say 2 years later. There's a long gap. Difference from cash selling price. Let's say today I'm charging only 1 lakh from you all, but the normal price of this arrangement or the contract is, let's say, 1,20,000. So if there's a difference, then there's a significant financing component. Now, ma'am, what happens if customer is going to pay later? I'm done teaching you all, but you're going to pay later. It is a financial asset. You will recognize interest income. If customer pays in advance, it is a financial liability. You will recognize interest expenditure. So, for example, cash selling price is 10 lakh. Customer will pay 12 lakh 2 years later. So, 2 lakh is nothing but your financing element. You will recognize it separately. So, what are the journal entries? Let's say, what are the journal entries? If customer pays later, I'm done teaching you all, but you all will pay later. So you will recognize a receivable, a financial asset, and financing element. You will recognize interest element. So let's say cash selling price is 1 lakh and you all will pay me 2 years later 1,21,000. So what is my interest element over here? 21,000. This is my interest element. So what am I going to do on initial recognition? Now I am done teaching you all. I will recognize revenue, but it will be at what? Present value. So I will debit trade receivable or financial asset and I will credit revenue. Preferable, go with trade receivable. Then subsequently you will recognize interest income. You will debit your financial asset. You will credit your interest income. Second year also you will debit your financial asset. You will credit your interest income. Third year, whenever you actually receive it, you will debit cash and you will derecognize your financial asset. Now, if entity is effectively giving a loan, what is the logic behind this treatment? You are giving actually a loan. Interest income is recognized. Now, if customer pays in advance, what happens if the customer has paid, but we are yet to satisfy our performance obligation? It means what? Advance received, it is treated as a financial liability and finance element is your interest expenditure. So, for example, customer pays today 1 lakh. Goods will be delivered 2 years later and cash selling price is 1,21,000. So here 21,000 is your what? Financing element. So what are we going to do today? Debit your cash, you will credit your financial liability. You will recognize interest expenditure, you will increase your financial liability by this. Second year also you will increase you will increase your financial liability by interest expenditure, and when you actually deliver the goods, when you are done satisfying your performance obligation, you will derecognize your financial liability and you will recognize your revenue. Okay. No, so when do we say that there is no significant financing component? These are the indicators. These are, if you see these situations in your question, then there is no significant financing component. First, the credit period is less than 1 year. So if it is less than 1 year, you go with contract liability. You don't recognize the financial. You do not do the discounting and all, because if it is less than 1 year. Advance payment is for protection. I've charged some payment for protection. Maybe I want to secure. So for example, what happens? So a lot of times, the supplier, the service provider or the supplier of goods or services, what do? They charge some advance payment. But see, if it is for protection from future default, then it is not a significant financing component, and timing is controlled by customer. You decide whenever you want to pay. Then in that case also there is no significant financing component. Then the next part is non-cash consideration. What is the meaning of non-cash consideration? Any consideration, the consideration that is to be settled without, not in cash. So for example, it can be shares, or if it can be anything else. Now understand, the non-cash consideration is always measured at fair value. So for example, I'm teaching you all, let's say I'm teaching Tejaswini ma'am, and instead of paying me in cash, in money, she decided that she will pay me in shares of Reliance Industries Limited, or she will pay me in her own company's shares. So understand, if I can measure the fair value of the consideration that I'm going to receive, I will measure it at the fair value. But if I cannot measure the fair value of consideration received, then I will recognize, if fair value is unavailable, I will use the SSP, or standalone selling prices, or the fair value of goods and services transferred. So if I can measure whatever she is paying me, if I can measure it, then I will measure it at that value. But if I cannot measure it, then whatever goods and services I'm providing her, the fair value of the goods and services that I'm providing her will be the fair value of this. For example, customer transfers shares instead of cash, measure it at the fair value of shares. Now, consideration payable to customer. So for example, consideration payable to customer. Understand here, let's say the example that I took in the class, I am teaching SBR, and Madhu ma'am, we have a friend over here, Madhu ma'am, she taught me, she's also into teaching. I decided that Madhu ma'am, I will teach you SBR, and in return you teach me this Bharatnatyam or dance. Okay, so understand here, I will also pay Madhu ma'am. Surbi is let's break it down into drawing. This is Surbi, and this is Madhu ma'am. Who is Surbi? Service provider. And who is Madhu ma'am? She is my customer. Okay, I am teaching her SBR. I said, madam, for SBR, you will pay me, let's say, 10,000 rupees. For SBR, for teaching you all SBR, you will have to pay me 10,000 rupees. Now, this is a contract between Surbi and Madhu ma'am. And later, I also entered into a contract with Madhu ma'am. I told her, ma'am, how about you teach me this also, Bharatnatyam. So she said that to teach you Bharatnatyam, I will charge, let's say 20,000 rupees. No, not 20,000 will be too much. Let's say she said I will charge 5,000 rupees. So my dear friends, understand, whatever I am going to pay her, this part, I am talking about the accounting treatment of this 5,000, the consideration payable to the customer. If this 5,000 is for distinct goods and services, it means whatever I am teaching her and whatever she is providing me are distinct, two separate things, then I will treat it as a separate contract. It is a separate contract. I will recognize it as separately as an expenditure. But my dear friends, if it is not for distinct goods and services, okay, I am paying this 5,000 to Madhu ma'am to compensate her for something. Okay, I'm not receiving anything in return. I'm just compensating her for something in respect of this contract. Then in that case, this 5,000 will be treated as a reduction from your transaction price. Okay, so let's understand. So it can be any type of reimbursement. It can be any type of credit or coupon. So usually you will treat it as a reduction from revenue. You will treat it as a reduction from revenue unless it is for distinct services. Unless Madhu ma'am is providing me Bharatanatyam teaching, coaching, and I'm paying 5,000 for that. So in that case, it is this 5,000 that I've paid is a separate. I will recognize it as a, in my P&L, I will recognize it as an expenditure, and 10,000 that I've received from her, I will recognize revenue at 10,000. So for example, a retailer receives advertising services from a customer, may recognize a separate expenditure. Now we go to the next part, that is your allocation of a transaction price. Now how do you allocate your transaction price? It is always allocated in the ratio of SSP. You allocate your transaction price in the ratio of your standalone selling prices. So for example, what is the formula over here? Transaction price multiplied by individual SSP divided by total SSP. So let's make it sense by this. There's a question. Let's say there's a product that I'm going to provide you, and along with it there is a service. The standalone selling price of the product is 80,000 rupees, and the standalone selling price of services 20,000 rupees. And total of SSP is 1 lakh. The contract price between you and me is 90,000 rupees. So ma'am, how do you recognize revenue? So for product, what will be my transaction price? I will have to allocate it in the ratio of SSP. So for product, 90,000 is my SSP multiplied by 80,000 divided by 1 lakh. Okay. So whatever is a value, that will be your transaction price. Now for service, how are we going to do? 90,000, that is transaction price, multiplied by individual SSP. What is individual SSP? Divided by total SSP. So here, if you see product 72,000, you will recognize revenue at 72,000, and for service, you will recognize revenue at 18,000. Okay. Now, discount allocation. Discount is to be allocated to all POs unless evidence shows otherwise. So if, let's say, I have given you a discount over here, let's say there's a discount. So discount is to be allocated to all the POs. But if there's evidence that shows that discount is given only for product, then you will discount it separately. You will treat it as a separate this. Now, variable consideration allocation. Allocate entirely to one PO if specifically related or allocation consistent with IFRS 15 objective. Now, the last step of your revenue recognition is the recognition of revenue. Last step of IFRS 5 is recognition of revenue. So, how do you recognize revenue? When do we recognize revenue? When the control of goods and services transfers to the customer. So, ma'am, when do we say that the control has been transferred? What are the indicators of transfer of control? What are the indicators, guys? The legal title has been transferred. The physical possession has been transferred. Right of payment. I have a right to demand the payment. Risks and rewards have been transferred, and customer has accepted the goods. In that case, we say that the control of goods and services have been transferred from supplier to the customer. When do you say that the performance obligation is satisfied over time? So in this case, you say when the control has been transferred, you recognize revenue at what? You recognize revenue at a point in time. At a point in time. Okay. When do you say that the performance obligation is satisfied over time? When the customer simultaneously receives the benefit. For example, cleaning services. Or the customer controls the asset that is created or enhanced, for example, building on customer's land. And there is no alternative use plus enforceable right, for example, a custom machinery, a specialized asset. So understand, this I know you all will be able to deal with. Customer simultaneously receives and consumes a benefit as the entity performs. Customer controls the asset as the asset is created or enhanced. This I can manage, this you all can manage, but this is an area that can bother you all. First one is no alternative use. It means what the asset is very specialized. I'm creating a specialized asset. So if the asset is specialized and I have an enforceable right to demand payment, then the performance obligation will be satisfied over time. Okay, ma'am. What if the asset is specialized plus no enforceable right, then in that case the performance obligation will be satisfied at a point in time. Understand? So this is the area that you need to take care of. This is the area that they can trick you. Definitely they can trick you all on. So here, whenever you all go through this note, you all can write it over here. If there is no enforceable right, the asset is specialized and we don't have any enforceable right to demand payment, then in that case performance obligation will be satisfied at a point in time. Okay, point in time. So PO satisfied over time if at a point in time when overtime criteria are not met, revenue is recognized when the control transfers. Now, what are the measures? I mean, if your performance obligation is satisfied over time, you will have to measure your revenue. Yes or no? So there are two methods of measuring your revenue. First one is output method and the second one is what? Input method. Ma'am, what do you mean by output method? The output, the outside results. For example, any milestones given, any units delivered or any surveys. Usually this will be the area that they can test you on. As per architect survey or this and that survey, this much job has been completed. So in that case, if the question will be specific, as per the surveyor's report, 70% of the job has been completed, so you will recognize 70% of the transaction price. You can recognize as a revenue. Now input method means what? Here no outside feedback is given. Inside feedback we'll have to take cost incurred and labor hours. So now what do you mean by cost incurred? Let's say the total expected cost are 2 lakh total. I mean, to teach you all, the total expected cost that I'm going to incur throughout this contract is 2 lakh. So far, I have incurred 1 lakh cost. So I can say that 50% of the job has been completed. I will recognize 50% of the revenue. Whatever is the transaction price, 50% of that will be recognized as a revenue. Irrespective of whether I've received the payment or not, whether I've received more payment or not, it doesn't matter. I will recognize revenue. So important point here, exclude any abnormal wastage. In this case, when you're calculating this, if there is an abnormal wastage, you will exclude that. Now we go to the special areas, like hardly, this is almost 36 minutes. Within 45 minutes or 50 minutes, you will be able to complete this big giant, IFRS 15, this very, very big giant. Now, what are the special areas? Special IFRS 15, sale with right to return. The first area. Now see, understand, if you have sold but there's a right to return, understand you do not recognize full revenue. Okay. You will recognize revenue only for goods expected not to be returned. If you expect that certain goods will not be returned, you will recognize revenue for that. Refund liability, if you whatever is the amount that you expect will be returned by the customer to you, you will recognize a refund liability. And return asset. For the goods that will be returned back to you, you will recognize a return asset. So here, cost of sales will be reduced for expected inventory. Now let's take an example. Journal entries. Journal entries are very important, and I believe with my experience, I feel journal entries help us understand a lot more better. So journal entries. For example, we have sold goods worth rupees 1 lakh. Cost of inventory. Our cost is 60,000. We expect 10% goods will be returned back. So expected refund will be of 1 lakh. 10,000. 1 lakh into 10%. 10,000. So expected inventory return will be of 6,000. Now on day one, what are you going to do? You have received, let's say, imagine this can be a contract with big giants like Myntra, Amazon and all. So day one, you've received full cash. Yes or no? But you will recognize only 90% of the revenue of this as a 90%, whatever is the 90% value of this will be recognized as a revenue, because 10% you expect will be returned by the customer to you. So you will credit revenue by 90,000 and this 10,000 will be recognized as a refund liability. Okay. Now cost of sales, you will recognize cost of sale only for the revenue recognized, the proportionate revenue recognized. So 90% will be recognized as a cost of sales. You will recognize return asset, the asset that you expect to receive back from the customer, and you will credit your inventory. Okay. So ma'am, what happens? What is the journal entry that we will pass when the goods are actually returned? You will debit your refund liability and you will credit your cash. You will de-recognize your liability and you will credit cash. And what if we expected that the goods will be returned back to us, but the customer does not return it back? So we expected that 10,000 goods, ma'am, all the possible scenarios we cover. So if you do not have to return anything back to the customer. You will transfer it to the revenue. So what are you going to do? What if you need not have to refund it? So you will debit what? You will debit refund liability 10,000 and you will credit revenue 10,000 if you did not have to return it back to the customer. Okay. Now inventory returned. When you receive your inventory back, you will debit your inventory and you will derecognize the asset that you had created. Okay. Now we go to the next part, that is your warranties. We go to the next part, that is our warranties. Now, my dear chartered accountants, there are two types of warranties. First one is what? Assurance warranty, and the second one is what? Service warranty. Assurance warranty is covered under IAS 37 provision. You recognize a provision as per IAS 37. But for service type of warranty, where it is, ma'am, how do we identify a service type warranty? Where you are charging something extra. Where you are charging something extra for warranty. In that case, it is a service-based warranty. You will treat it as a separate PO under IFRS 15. So, for example, extended 3-year warranty sold separately. Then it is your what? Service type warranty. You will treat it as a separate performance obligation. Now, principal versus agent, very special area, principal versus agent. If you are a principal, if you conclude that you're a principal, you will recognize gross revenue. If you conclude you're an agent, you will recognize net commission only. Net revenue will be recognized. Now, what are the indicators of a principal? What are the indicators? Inventory risk, pricing discretion, and primary responsibility. So if the inventory risk is of me, I have a right to decide the price, and it is my primary responsibility to deliver the goods and services, then I'm a principal. I will recognize gross revenue. So for example, travel website earning commission, you are an agent, you will recognize net commission. Now, non-refundable upfront fees. So for example, you pay any non-refundable upfront fees for joining fees. You would have experienced this while joining a gym. If you want to take a gym membership, you have to pay some non-refundable fees. So for example, activation fees or joining fees. Usually it is not a separate performance obligation. That is for providing you all with the gym services only, So revenue is deferred over the service period. You will recognize a deferred income. So for example, gym joining fees recognized over the membership period. So let's say we have received 10,000 as advance, non-refundable fees. I'm a gym and I have received 10,000 from you all as an advance fees for providing you all with gym services. Now this will be treated as a deferred income. I will recognize as and when you all take benefit of your gym membership. Now, consignment arrangement. What is the meaning of consignment arrangement? Consignor retains the control until the sale to the end customer. So here there's one party called consignee and the other one is consignor. So consignor is the one who is, think of it like a dealer relationship. Okay. Now see, for example, I am a manufacturer of Maruti Suzuki cars. Okay. And let's say Nawaz is a dealer of Maruti Suzuki cars. Okay. So here I'm a consignor and Nawaz is a consignee. So ma'am, when do we say that it is a consignment arrangement? When I will retain the control of the car until Nawaz sells it to the end customer. So it means what? I cannot recognize the revenue until and unless Nawaz sells it to the end customer. So revenue is recognized only when end customer purchases it or when the control transfers. When I transfer the control to Nawaz, then and only then I can recognize revenue. So what are the indicators? Seller can require return. I can demand, Nawaz, please give me back my cars. Dealer may not be obliged to pay immediately. Whenever I sell, see, I am a consignor, right? So this is Surbi and this is Nawaz. Okay, I gave some cars to Nawaz. Okay, now let's imagine this is a car. Not imagine, this looks like a car. Okay, now I gave this car to Nawaz. Here, when do we say that it's a consignor-consignee arrangement? When I can demand this car back from Nawaz whenever I feel like. So for example, if Tejaswini ma'am comes to me and says, ma'am, I need this car, I can ask Nawaz, please give me this car and I can sell it to Tejaswini ma'am. Nawaz need not make me any immediate payment. And seller controls the product until resale. Of course, I will be controlling the product till the time it has been sold to the end customer. So for example, car dealer selling vehicles for the manufacturer. So consignment arrangement possible. That's what I told you all. I'm a manufacturer of Maruti Suzuki car and Navasar is a dealer. Now repurchase agreement, everybody's favorite repurchase agreement. Now ma'am, what do you mean by repurchase agreements, guys? Very, very important. And the last discussion of this chapter, that is repurchase agreement. Now what do you mean by repurchase agreement, ma'am? Entity has sold an asset. Okay, I have sold the asset to Navasar, but there is a promise or there's an option to repurchase the asset later. Okay, so sale with repurchase option. Okay, I've sold it, but I have an option to repurchase it. Now understand, there are 3 types of repurchase agreement. Okay, the accounting will change as per the type of repurchase agreement. The first type of repurchase agreement is a forward contract. Forward contract means what? Entity must repurchase. So we will take, we'll put this into an example and understand it. Here, this is Surbi. And here we have Amal ma'am and Surbi. I sold this phone. To Amal ma'am. Okay. Now understand if the contract, this is, who is the seller here? Me. Surbi is a seller and Amal ma'am is a purchaser. I sold this phone to Amal ma'am. If the contract contains that 2 years later, Surbi will have to, must, I will have to repurchase it. I don't have any other alternative. I will have to repurchase it back from Amal ma'am. Then it is a forward contract. Entity must repurchase. It is a forward contract. Call option. Entity has a right to repurchase. It means what? I may repurchase it back from Amal ma'am. Ma'am, I have a right to repurchase it. Okay, the contract says Surbi can repurchase it. Can. Surbi has a right to repurchase it from Amal ma'am whenever she feels like. So my dear friends, my dear chartered accountants, understand, future affiliates, understand, in these 2 scenarios, we are not really transferring the control. Surbi has not really transferred the control from Surbi to Amal ma'am. Hi, Dakshineshwar sir. How are you doing, sir? Okay. But you all did not have a link or what to join the meeting? Okay. So here, in this case, what is happening over here, my dear friends? In the first 2 scenarios, you did not have a link. Okay, you did not have. Okay, I'm sorry for that. We are almost, so I'll tell you where am I at. I'll tell you so that you do not miss out on anything. I started off with this, what we say, IFRS 15, and I'm on the last discussion. I thought you all will not join, or maybe you all will watch the recorded one. That was my assumption. So I am on this part, sir, repurchase agreement. So now I was in the midway of it, but now that you've joined it, so we do it together. We discuss this together, okay? How are your preparations going on, by the way? All good? Are you able to manage the questions and all? Any difficulty that you're facing? I will tell you my 2 days plan. I've planned 8 hours for you all, 8 hours of marathon for you. Today we'll cover maximum chapters revision. Tomorrow first half we'll cover some revision part. Tomorrow second half we'll discuss only questions. The pre-populated balance sheet. How do we address the questions of pre-populated balance sheet and all? Okay. So I hope your revisions are going great, sir. If you need any help, you know you have my number. You all can always reach out to me. Now, I am writing. You will write in September. Okay. Okay, perfect. So repurchase. Let's revise it together. So you have a good amount of time. Let's discuss this. Let's revise this together. So repurchase agreement. So what is the meaning of repurchase agreement here? See, entity sells the asset, but there's a promise or we have an option to repurchase the asset later. So what are the types of repurchase agreements in this case? First, there's a forward contract. What is the meaning of forward contract? Now, since you're there, I will use your name, sir. Surbi has sold a phone. I sold a phone. This phone, imagine this is a phone. I've sold it. I transferred it to you. I sold this phone to you, but the contract says here Surbhi is a seller and Dakshineshwar sir, you're a purchaser. Okay. Now understand, if the contract says that Surbhi must repurchase it. Surbhi must repurchase means what? Surbhi will have to buy it back from Dakshineshwar sir. Then it is a forward contract. If the contract contains a call option, when you say the contract contains a call option, when I have a right to repurchase, it is not an obligation for me to repurchase it, but I have an option to repurchase it back from you. Okay, so in that case, we say it is a call option. And put option means what? The customer can require the entity. Put option means the contract says Dakshineshwar sir can put it back to you. If Dakshineshwar sir doesn't like, he may put it back to you whenever, as per the contract, he can sell it back to you, put it back to you. Okay, now understand what is happening over here. In the first two scenarios, we have not really transferred the control. Okay, in the first two scenarios, we have not really transferred the control. I have an obligation. In the first case, I have an obligation to repurchase, and in the second case, I have a right to repurchase. Okay, so it means the control is still with me. So customer may have physical possession, but still not a transfer. But it is still not a transfer. Therefore, sale may not exist. So if there is no sale, you cannot credit revenue. So under forward contract and a call option, what do? It is a mandatory repurchase or entity can repurchase. The customer does not obtain a contract. So accounting will depend on repurchase price. Okay. So now what if my repurchase price is greater than the original selling price? Sorry, it is less than the original selling price. If my repurchase price is 90 and my original selling price is 100. So here it is treated as a lease under IFRS 16, sale and lease back. Customer effectively pays only for the temporary use. So for example, selling price is 10 lakh and repurchase price. Later on, I will have to repurchase it back at 8 lakh. So it means what? Here it is a lease, accounting will apply over here, sale and lease back. Now, here you will not derecognize the asset, you will not remove the asset from your book, you will not recognize revenue. Now, if repurchase price is greater than or equal to original selling price, in that case, it is treated as a financing arrangement. Whatever I have received from Dakshineshwar sir will be treated as a financial liability. Customer is effectively providing financing. So, for example, our selling price is what? Original selling price is 10 lakh and repurchase price is 12 lakh. So here repurchase price is greater than the original selling price. The extra 2 is your finance cost. Extra 2 lakh is your finance cost. It is treated as a financial liability. So asset still remains with the seller. I will not derecognize the asset. Third one is put option. What is the meaning of put option? Here Dakshineshwar sir, you have a right to put back the asset. Call option, I have a right to call back the asset. Here you have a right to put back the asset. So it means what? The ball is in your court. In call option, the ball was in my court. So here customer can require the repurchase. Customer can say, Dakshineshwar sir, you can come and say, Surbhi, buy it back from me. Now understand, here it depends on customer's incentive. Put option accounting will depend whether you have a significant economic incentive to put it back to me or not. Okay, so customer is not likely to exercise option. It means what? You don't have a significant incentive to put it back. So what are the conditions over here? Repurchase price is lower than the original selling price. And it is also lower than the market price, expected market price. For example, let's say our original selling price is 10 lakh. Repurchase price is 8 lakh and expected market price is, repurchase price. This is my selling price. Expected market price is, let's say, 9 lakh. Expected market price is 9 lakh and repurchase price is 8 lakh. So here you have a right to put it back to me for 8 lakh. But if you sell it in the market, you will get 9 lakh. So it means what? You don't have economic incentive to exercise this option. So no significant economic incentive. So you will treat it as a sale with right to return. I will treat it as a sale with right to return. I will recognize if there's a possibility that you might return it back to me. I will recognize a refund liability for that. So you will recognize revenue, credit, refund liability, and recognize a return asset. So for example, selling price is 10 lakh and your repurchase price is 7 lakh. Customer unlikely to return. Customer does not have a significant economic incentive to return it back, you will treat it as a sale accounting with a refund liability. Now, case 2, customer has a significant economic incentive. Ma'am, when this can be possible? When this can be possible? So here my selling price, original selling price is, let's say 10 lakh, repurchase price. Okay, repurchase price is 8 lakh, but expected market price, sir, is only 7 lakh, sir. Expected market price is only 7 lakh. It means what? If you sell it in the market, you will get only 7 lakh. But if you sell it to me, you will get 8 lakh. So you have an economic incentive to put it back to me. You have an economic incentive to put it back to me. It means you will exercise this option. If you will exercise the put option, then it is not actually a sale. I have not actually sold the goods. So here, if the repurchase price, here the customer is likely to exercise the option. So what is the treatment here? If you are likely to exercise it and your repurchase price is less than the original selling price, you will treat it as a lease accounting, just like that. We'll go back to it. Customer is effectively paying for temporary usage. But if repurchase price is greater than the original selling price, you have an economic incentive to put it back to me. Okay. So here, if my repurchase price is also greater than the original selling price, then it is and also greater than the expected market value. Let me give an example over here. Let's say my repurchase price. This is my repurchase price. Repurchase price is, let's say, sir, 11 lakh. Okay. And original selling price is 10 lakh. And expected market price is what? 9 lakh. So, sir, here if you sell it in the market, you will get only 9 lakh. But if you sell it back to me, you will get 11 lakh. And we have compared these two to understand that Dakshineshwar sir has significant economic incentive to put it back to me. Now we will compare these two to understand what type of accounting we will recognize. So here, when your repurchase price is greater than your original selling price, we will treat it as a financing arrangement. So it is a financing arrangement. Customer has guaranteed recovery. Therefore, arrangement is a financing, not a sale. So you will recognize a financial liability, debit cash, credit, financial liability. Subsequently, you will recognize a finance cost. So, sir, tell me, are we okay with this part, sir? Dakshineshwar, sir, are we good with this? I've made some, I've changed, I will provide you with these notes. One thing that I've done over here in these notes is that will help you a lot in revising whenever, you refer this time or in the September, whenever. Here I've added some mind map for you, sir. Okay. So this mind map is very, very important when you revise your any concept. With this mind map, sir, you will know that what are the areas that we need to cover. What is basically the whole part. What are the things that we need to cover in IFRS 15 to ensure that we are done with IFRS 15. So whenever by the time you complete all of this, you will be in a position to say that you're done with your IFRS 15. Okay. Since you've joined late, sir, so any point of IFRS 15 that you want me to address back, want me to discuss again with you, sir? Any point that you feel that should be discussed? Any area that has ever bothered you? I will discuss it again. Any specific point that you want me to, then I'll discuss it. Next is, we'll go with non-current assets. Okay. So we will start with non-current assets. Okay. Whenever you have a time, sir, watch the previous part on 2x. Okay. Put it on 2x. I hope you have this option of, increasing the speed and cover this. Then solve the question. The questions will go very smoothly. Okay. And Dakshineshwar, sir, I forgot to mention one thing to you on chat. Your presentation is amazing, sir. The way you are presenting your answers, amazing. Too good. I checked your recent paper that you appear for. Too good. Keep it up, okay? Ensure this quality of answer every time. Okay. So we do this NCA. Ma'am, what are we going to cover in this? We are going to cover what all standards we are going to cover in this. We are going to cover IS 16. We are going to cover IS 38. We are going to cover IS 40. We are going to cover IS 23. We are going to cover IS 20, 36, IFRS 5 and IFRS 13. So when you complete all these 9 standards, then and only then you say that your non-current assets have been completed. So, you know, these are very, very small standards. Hardly we will require 15 to 20 minutes each for each of these chapter. Sir, just one suggestion, tell me, do you want a separate video for all the chapters? For example, we have completed revenue. So do you want it as a separate revisionary video, or you want it in a 4 hours video only? How do you want it? Like, how efficient you feel? How do you want it to be? Should I record a separate video for NCA, and should I keep revenue and NCA separate, or should I keep it like this together? What would help you efficiently revise? One single video is better? Okay, one single video is better. Cool then. Now we go for NCA revision. Introduction to NCA. Non-current assets. So non-current assets are long-term assets. What are the uses of it? Production, supply of goods and services, rentals, or for admin purpose. If your asset is used for any of these, you say it is a non-current asset. So what are the types of NC that we are going to cover? PP, IS 16, intangible asset, IS 38, investment property, IS 40, and held for asset, IFRS 5. Now, what is the recognition criteria? When do you recognize a non-current asset? These conditions are very important. If you're solving a case study on NCA, please ensure that you add these points, okay? You add these points. So what is the recognition criteria for recognizing an NCA? What are the criteria that should be met to recognize NCA? First, future economic benefits are probable and the cost can be measured reliably. If there's a question on NCA, if there's a question on PP or intangible asset, please ensure you mention these 2 points. Non-current asset can be recognized only and only if the future economic benefits are probable and the cost can be measured reliably. So let's start with IS 16, property, plant and equipment. Very, very simple, okay? There are few things that you need to understand: initial recognition and subsequent measurement. Under subsequent measurement, there are 2 options: cost model and revaluation model. We need to understand one more thing over here. Under cost model, you will recognize at historical cost minus depreciation minus any impairment losses. Now under revaluation model, you will recognize it at a fair value. Any revaluation gain will go to other comprehensive income. Any revaluation loss will go to your P&L. That's it. In this next 2-3 minutes, in this just last 2-3 minutes, we have completely revised it. Okay, that's it. That's it. It is as simple as that. So let us finish our this revision. Initial recognition, PP is recognized only when future economic benefits are probable and cost can be measured reliably. Initial measurement always and always at cost. If anybody asks you in interview or in a question, initial measurement always at cost. Subsequent, now cost includes what? It will include your purchase price. It is a simple list I've given to you all. If in the question this list is given, any area, any part of this list is given, please include it to the cost of your asset. Otherwise, don't include it. So purchase price, installation, any delivery fees, any site preparation, any restoration cost. So you remember this restoration provision as per your IS 37 decommissioning liability. You will include all of this. You will add it to the cost of your asset. What is not included? What is not included in the cost of my asset? Any admin cost, any training, staff training cost, any advertisement cost, any abnormal wastage or any relocation cost will not be added to the cost of my asset. So for example, my machine cost 10 lakh rupees and installation is 50,000 rupees and staff training is 20,000 rupees. So these two will be added. My machinery will be recognized at 10 lakh 50,000. This will not be added. This will be expensed to P&L. Now subsequent expenditure. If going forward, let's say I have purchased a phone. Now, whatever is the purchase price, I will capitalize it. I will recognize as a PP. Now, subsequently, if I incur, let's say I incur some major repairs, okay, major repairs and maintenance for this asset, I will capitalize. Subsequent expenditure can be capitalized if it improves the output, if the efficiency increases, if it extends the useful life of the asset, or it enhances the benefit. If any of these conditions are met, you will capitalize the subsequent expenditure. You will expense it if it is a minor repair and routine maintenance. You will charge it to P&L. You will not capitalize it to your asset. Now, for example, any engine replacement. Let's say, sir, you would be riding a bike. Do you have a bike or any vehicle that you ride, sir? Any vehicle that you prefer? Are you interested in bike or scooty or car, anything? So for example, sir, if you are replacing the engine of your vehicle, let's say you have a bike, okay, you're replacing the engine, it will enhance the capacity of your asset, it will enhance the capacity of your vehicle, then you will capitalize it. A major oil change, the major minor repairs, routine repairs will not be capitalized, it will be expensed. Now component accounting, major component are to be depreciated separately. So ma'am, what do you mean by major component are to be depreciated separately? So see, understand, this is a very important point, a simple point but easy and very important also. This is my aeroplane, okay? It might not look like aeroplane to you, but understand it as my aeroplane, okay? It does look like an aeroplane to us. Now, aeroplane has some major component. The first major component of my aeroplane is what? Body of my aeroplane. And we also have some engine over here, okay? Engine. Now, both these components are major, important component, of course, very important. Now, see, the useful life of my body is, let's say, 10 years. And useful life of my engine is, let's say, 7 years. So, standard says, these are major components. They're very, very important components. So you depreciate them separately. Body will be depreciated for 10 years and engine will be depreciated for 10 years. So let's say the cost of my cost of my this aeroplane is 40 lakhs. Okay, out of this 40 lakhs, 30 lakhs is for body and 10 lakhs is for engine. So this 30 lakh will be depreciated, will be charged to P&L over next 10 years and this 10 lakh will be charged to P&L over next 7 years. So this is what? This is nothing but your component accounting. So separate depreciation is required. Now depreciation will start when the asset is ready for use. It will It will stop on derecognition, when you derecognize the asset, when you sell the asset, when you dispose of the asset, and when it meets the held for sale criteria. IFRS 15, when IFRS 5 is applicable, in that case the depreciation will stop. Okay, so what are the methods of depreciation? Very simple. Usually we do this only. We apply SLM method only. So SLM, reducing balance method or units of production method. So what is the formula? Depreciable amount divided by useful life. So for example, my cost is 10 lakh, residual value is 1 lakh, life is 9 years. So my depreciation will be 1 lakh per annum. 10 lakh minus 1 lakh divided by 9 years. So this will be my depreciation, simple. Now revaluation model, subsequent measurement revaluation model, asset is carried at fair value less depreciation. So what is here, if there's a revaluation gain, it will go to OCI. And mind you, it is an item that is not reclassifiable to P&L. It is not recyclable to P&L. This item is not recyclable to P&L. So it means what? Whenever we derecognize the asset, whenever we sell this asset, then whatever is a balance in OCI, it will be transferred to retained earnings. It will not be, it will not go to P&L. So unless there's a previous loss, if there's a previous loss, then you will recognize it that way. Now revaluation loss will go to P&L unless there's a previous surplus. If there's a previous surplus that exists, first you will reduce your surplus, then whatever is the extra surplus that will be charged to your whatever is the extra loss that will be charged to your P&L. Now derecognition, when you derecognize the asset, when the asset is disposed of and there are no future economic benefits, gain and loss will be recognized in P&L. Now intangible assets, IAS 38 intangible asset, you recognize an intangible asset. When do we recognize an intangible asset? When the asset is identifiable, non-monetary and without physical substance. So here there are two areas that we need to take care of: research and development. These are the two areas that can be tested. These are the most tested areas of your IAS 38. Only these are the two different, I would say, unique areas that we should focus on. So research means what? The initial phase when you're researching about any asset. So any expenditure during the research phase is always expense to P&L. It is always expense to P&L. Development phase. If there's an expenditure during the development phase, you capitalize only and only if all of the conditions are met. All of the conditions are met. So what is the condition? Pi rate. You remember pi rate criteria? Pi rate. If pi rate conditions are met. And what do you mean by pi rate condition? There's a technical feasibility. There's an intention to complete, ability to use and sell, future economic benefits are probable, and resources are available. So if all of these conditions meet, then and only then all of these conditions, mind you, not only just one condition, the examiner will trick you, the question will trick you that technical feasibility is pending. Other than that, all the conditions have been met. Do not capitalize the expenditure. Any expenditure after all of the conditions have been met, only that expenditure can be capitalized. Any expenditure before any of these before these conditions have been met will be charged to P&L. Okay, so let me give you a timeline. A reliable measurement. Cost can be reliably measured. So let me give you a timeline over here. Let's say we were in our development phase. Okay, we were in our development phase. This is my 1st January. Up till 20th of March, all the other conditions have been met except technical feasibility. Okay, technical feasibility met on, let's say, we got a technical feasibility on, let's say, 31st of March. So any expenditure, sir, any expenditure incurred up till this date, up till 1st January to 31st March will be expensed to P&L, Any expenditure incurred after this, after 31st of March will be capitalized. So only and only when, on the date when you meet all of your conditions, only and only after that you will capitalize your development phase expenditure. So here these are the conditions that should be met to capitalize your expenditure. Pirate condition, probable economic benefit, intention to complete, and resources are available, availability to sell and use, and cost can be reliably measured. Now, understood? Yes. Researching phase. If you're researching on a medicine, you will expense it. On commercial production stage, if it meets all the criteria, then please capitalize it. What you cannot capitalize? Internally generated brands. So you remember some asset that cannot be recognized as an intangible asset, internally generated brands cannot be recognized, even if it meets all the criteria. All the criteria, internally generated, it cannot be recognized. The logic is cost cannot be measured. Can't be measured. How do you measure the cost of internally generated brand? I have been teaching for last 5-6 years. How do I measure the value of my brand? It cannot be measured. Any internally generated customer list cannot be recognized as an intangible asset, and of course internally generated goodwill cannot be recognized. So only one goodwill that can be recognized in our balance sheet, only one goodwill can appear in our balance sheet, that is as per IFRS 3. Goodwill on business combination, only this can be recognized. Subsequent measurement, cost less amortization. So this is the most preferable method. You can apply revaluation model only and only if there is an active market. Only and only if there's an active market for the asset. If there's no active market, you cannot use a revaluation model. So see, understand, for most of the asset, for most of your intangible asset, there will be no active market, so you cannot apply revaluation model. Now, finite and indefinite useful life. If your asset has a finite life, for example, licenses. You have a finite useful life. I've received a license to operate in some industry for, let's say, 10 years. Then it is a finite 10 years is the finite life. If it is an indefinite useful life, okay, I've purchased any, let's say copyright or any patents. Are you getting me? If my asset has indefinite useful life, then of course I cannot amortize it, because to amortize I will need any life, a denominator. There will be no denominator over here. So here, indefinite useful life, you will not amortize it. It will remain in your balance sheet as it is. But annually you will test for impairment annually. Irrespective of indicators of impairment, you will test for impairment. You will check if there is an impairment. So this is an area that can be asked in a question. The examiner can test you on this. Amortization is nothing but simply just like your depreciation, a systematic allocation over useful life. Okay, so when you derecognize, any gain and loss on derecognition will be transferred to P&L. Any balance appearing in your OCI, just like if you're applying revaluation model, and if there's an upward revaluation in your intangible asset and any balance in your OCI, upward revaluation will go to OCI. So upward revaluation OCI balance will not be reclassified to P&L, will be transferred to retained earnings. Now we go to the next part, that is your investment property. Investment property. What is the meaning of investment property? It is a land, building or both, or a building with land nearby. So understand, any asset other than land or building cannot be your investment property. Okay, for example, if I'm talking about machinery, it cannot be my investment property. Okay, very, very important. If I'm talking about my phone can never be my investment property. Investment property always has to be a land or a building or both. Okay, so first, this clarity should be there. So what is the meaning of investment property? It is a land or a building that is held for rental or for capital appreciation. Okay, and it is not an owner occupied property. It means I'm not occupying it for my own use. I'm using it for rentals, and I'm using it for rental or for capital appreciation. For example, Dakshineshwar sir, you have a land, you have a extra house. Okay, what do we do if we have, let's say you are residing in Bangalore, but you have a house in Tamil Nadu, for example. Okay, now till the time you are in Bangalore, you will not let that house be. You will put it on rent. You will give it on rent to your friend or whoever it is. So here, this is basically your investment property when you are using any property for your passive income. It is for either for earning rental or for capital appreciation. It is your investment property. So if office building is used by the company, it will fall under IAS 16. If your office building is given on rent to tenants, it will fall under IAS 40. Understand, there's one small crux in the definition. There's one small point in the definition of your investment property. If building is rented out to employees of building, employees of the organization, then it is treated, always treated as IAS 16. It is your owner occupied property. Ma'am, we've given it on rent to employees. Yes, still it is your owner occupied property. Owner occupied property, it has been defined in the standard itself that if you are giving it on rent to outsiders, third party, then and only then IAS 40 will be applicable. If you are giving it to your own people, your employees, your staff, then it is your owner occupied property. You are using it for your own purpose only. It is your owner occupied property. Okay, so building rented out to tenants, IAS 40. Now initial measurement cost, including your transaction cost, just like your whatever are the cost in your IAS 16, all the cost should be used. Fair value model, if you're applying, there are two options, subsequent measurement, two options, cost or fair value model. So ma'am, we are applying cost model. Okay, investment property, we are applying cost model. So ma'am, what do we do? Simple, IAS 16, exactly IAS 16, cost minus depreciation minus impairment loss. Ma'am, we are applying fair value model. Okay, fair value model. Here, my dear friends, no depreciation. Oh my God, no depreciation. And any fair value changes upward and even downward, both will go to your P&L. Both. Okay. Unlike this is the change from your IAS 16. This is the area that is changed from IAS 16. So what do we need to remember here, ma'am? Here, no depreciation. First, we will not charge any depreciation. Then secondly, any fair value gain and loss, both will be charged to P&L, will be recognized in P&L. Okay. So property value rises to 10 lakh, gain will be recognized to P&L. If you're applying cost model, apply just like your IAS 16 as it is. IAS 16, copy paste. Transfers. So far so good. Just one thing, remember one thing, a teacher's tip, you can write it and keep it somewhere. All your accounting standards, across all your accounting standards, there are only two situations where depreciation, subsequently you will not charge any depreciations. What are the two situations? Investment property at fair value model and asset classified as held for sale. Only these two situations, sir. Okay, so that's our Dakshineshwar sir. Only under these two situations, write it and keep it somewhere. Only under these two situations, your depreciation will stop. Otherwise, the depreciation will not stop. Okay. Now, transfers. Ma'am, what do you mean by transfers? Understand. You can transfer. There is a possibility that it is my owner occupied property. Now it has been transferred to I want to start using it as a rented. I want to give it on a rent to my friends. I mean outsiders. In that case, there's a transfer from normal owner occupied property to investment property. Understand, whenever you are solving a question, whenever there's a question on transfer, there is one thing that you need to write one important point. Do not miss out writing on that point. Okay, that this point will carry mark. This point will carry mark. The examiner would want to see this point. What is the point? Transfer from investment property is allowed only and only if to and from. Okay, to and from. Transfer to investment property or transfer from investment property is allowed only and only when there is a change in use. There has to be an evident change in use. Okay, management intention. Okay, just because the management intends to do this, it does not mean that there is a change in use. There has to be evidence of change in use. So ma'am, what can be the change? What can be the possible situation? Your owner occupied property becomes a rental property. So you are going from IS 16 to IS 40, or your investment property becomes your owner occupied property. So far you were giving it on rent to others. Now you are using it for your own self. So IS 40 to IS 16. So management intention, very, 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 very important. This can be tested. Ma'am, can you repeat tip one more time? Tip. Sir, which one? There are two things that I discussed, sir, right now. First one is the stoppage of depreciation. Two areas where your depreciation will stop all your accounting standards. And the second one was this point, the important line. Which one do you want me to discuss, sir? The stoppage of depreciation or this change in transfer? The transfer. Okay. So, sir, if there's a question in transfer from investment property or to investment property, you can do, okay, if there's a question, write this point mandatorily. Transfers to or from investment property is allowed only and only when there is a change in use. Just plain management intention is not enough. If the question says the management intends to do this, management intends to do that, no, that's not enough. There has to be an evident change in use. Actual change in use is required, then and only then you can transfer it. Otherwise, you cannot transfer it because the accounting will change, right? So management intention is not enough. There has to be an evident change in use. This important, very, very important point. I have put it over here. You all can just highlight it and keep it. I've put it like this important point because the questions are there. There are 2-3 questions on this where management intention is given. So management intention is not enough. The notes have been prepared considering the questions also, so that you can address the questions easily. Okay, perfect. Now what happens, ma'am? It was my owner occupied property. For owner occupied property it goes to investment property. So here, irrespective of whatever model you were applying in your owner occupied property, it does not matter. If it is your owner occupied property, you will apply IS 16 up till the date of transfer. Let's say today, what is the date today, sir? It is 18th of May 2026. I have a building that I was using as office. I was using it as my office building. Now on 20th of May, I decided that I'm going to put it on rent. I'm going to give it on rent to outside parties. So my chartered accountants understand on this date, up till 18th of May, you will apply what? You will apply IS 16. Ma'am, we were applying cost model or revaluation model, does not matter. You will apply IS 16, whatever is the model you were applying. But one important point over here. Whether, if you're applying fair value model, you will have to revalue it on 18th of May. Simply, you will have to revalue. If you are applying cost model, still on this date, on the date of transfer, you will have to revalue your property to the fair value. So ma'am, even if it is a cost model, yes, even if it is a cost model, on the transfer date, you will have to revalue. Okay, ma'am. So let's say on 18th of May, the carrying value of my PP, okay, carrying value of my PP was 9 lakh and fair value of my PP is 11 lakh. Okay, so here there is a revaluation gain. Now what did I tell you? Up till the date of transfer, you will apply IS 16. So here this 2 lakh gain will go to where? This 2 lakh gain will go to OCI as a comprehensive income. This 2 lakh gain will go to other comprehensive income. Simple. Okay. So ma'am, even if we are applying cost model, still we will have to revalue it. The answer is yes. Even if you are applying cost model, you will have to revalue it to fair value. So what is the accounting treatment? If fair value is greater than your carrying amount, revaluation rule. If fair value is less than your carrying value, your P&L loss unless there's a previous surplus. Difference is treated like revaluation, not investment property gain initially. You will not recognize this to P&L. This is not your initial investment property. Now ma'am, what happens if it goes from investment property to IS 16? So up till the date of transfer, you will apply IS 40. Up till the date of transfer, you will apply IS 40. Whatever is a fair value fluctuation, fair value gain and loss, it will go to P&L. After the date of transfer, you will start applying IAS 16. So whatever is a fair value on the date of transfer will become the deemed cost of your PP. So for example, property is transferred at fair value on the transfer date. So here I have been, let's keep the example same, 18th May 2026. We are standing on 18th of May 2026. On the state, I had an investment property. Let's say the carrying value of that property was 9 lakh. Okay. Fair value on the state 18th May. Okay, I'm talking about 18th May. On the date of transfer, you will have to revalue it. On the state, the fair value, this is my carrying value, this is my fair value. On the date of transfer, the fair value is 11 lakh. So this gain of 2 lakh, this will go to P&L. Not to other comprehensive income. Up till 18th May, we will apply IS 40. Okay, when it is going from IS 40 to IS 16. Now, on the state, going forward from 18th May onwards, your PPE will be valued at 11 lakh. Ma'am, can you just show us journal entries? That would be better for us to understand. Yes. So what do we do? On the day, on 18th May, what are we going to do, guys? 18th May. First, you are going to revalue your investment property to fair value. So we are going to debit our investment property. Okay, and we are going to credit revaluation gain. This goes to where? P&L. 2 lakh. Now, automatically your investment property will appear at 11 lakh. Yes, it was appearing at 9 lakh in the books. Now you have increased it by 2 lakh. So automatically in your balance sheet, your investment property will appear at 11 lakh. Now on this date, you will derecognize your investment property. So what is a journal entry for derecognition? Credit investment property, and you will debit PPE. Okay, 11 lakh. So this 11 lakh will become the deemed cost, new cost of your PPE. Going forward, if you apply cost model, revaluation model, it is the entity choice. Okay, so far so good. So far, are we all okay? Okay, now we go to the next part, that is your borrowing cost. Next, IS 23 borrowing cost. Now, what is the borrowing cost? Understand what is a borrowing cost. Any interest on loan, this is my borrowing cost. Okay, so if I have taken, what am I going to teach you all over here? If there is an interest on loan, it is generally interest. If I've taken a loan and if I'm paying interest on it, it is my finance cost, guys. It is my finance cost. It should be charged to P&L. It should be charged to P&L in financing section of my P&L. Simple. But understand, if this finance cost, if this interest on loan is related to my qualifying asset, if it is related to my qualifying asset, then it will be capitalized. It will be added to the cost of my qualifying asset. Okay, ma'am. So it means what? This finance cost, instead of going to P&L, instead of charging it to P&L, I will add it to the cost of my asset. Okay. So, ma'am, how are we going to do it? What is the meaning of qualifying asset? So first we understand what is a qualifying asset. Any asset that takes substantial time to get ready for its intended use. So in prepare, you can write it over here, substantial time to get, this is the English that is expected from you all, to get ready for intended use. So if any asset that takes substantial amount of time to get ready for intended use, we say it is a qualifying asset. So what are the examples of your qualifying asset? It can be either your factory, it can be your power plant, it can be your large inventory of your this wine, cheese, all of these are your qualifying asset. So what is the capitalization rule? Capitalized borrowing cost directly attributable. So any borrowing cost directly related to your qualifying asset, any interest expenditure, instead of saying borrowing cost, I would say any interest expenditure related to your borrowing cost will be capitalized. Capitalized means what? It will be added to the cost of my asset. So start capitalization when all of these situations occur. So these three situations, these three conditions, all of these conditions should be met to start my capitalization. If these conditions are not met, I cannot start with my capitalization. Okay, so ma'am, what do you mean by if these conditions are not met, I cannot start with my capitalization? Let me tell you one thing. Let me give you a scenario. So let's say there are three situations. What are the three situations? Expenditure incurred, borrowing cost incurred, and necessary activities have started. So for example, we are constructing, sir, imagine we are constructing a factory. Now factory is my qualifying asset. We have taken a loan on it. So let's say on 1st of January, we took a loan. On 1st of January, we took a loan. So can I say borrowing cost incurred? We have taken a loan, so borrowing cost will start. On 2nd of January, not 2nd of January, we'll keep it 2nd of March. We incurred some expenditure. Okay, we hired an architect. And we paid fees to architect. So expenditure incurred. And let's say on 5th of April, activities started. It means what? Architecture actually went there. He made a blueprint and all of that. So activities started. So standard says after, when all these three conditions met cumulatively. So can I say on 5th of April, all of these conditions have been met. On 5th of April, I have incurred borrowing cost. I have also incurred some expenditure, and I have taken all the necessary, I have started with the necessary activities. So it means what? Any borrowing cost after 5th of April, on and after 5th of April will be capitalized. But madam, you have taken loan on 1st of January. Bank will start charging interest from you from 1st of January itself. Bank will not say that, madam, you started your construction from 5th of April, will start from 5th of April. Yes, I know. You're very right. So it means what? From 1st of April, from 1st of January till 5th of April, any borrowing cost in this phase will be expensed. It means what? It will be charged to P&L. It will not be capitalized. Okay. So ma'am, which category of my P&L? Finance category, financing section of my P&L. It will be charged to my P&L. After 5th of April, whatever is my borrowing cost, it will be capitalized. It means what? Up till this date, my dear friends, we will debit finance costs. It will go to P&L, and we will credit bank or cash, whatever it is, finance. Okay. But after 5th of April, instead of debiting finance cost, we will debit QA. Instead of debiting finance cost, we will debit QA and we will credit bank. So this is an important adjustment that you need to remember. Tell me, so far so good? Both Siddharth sir, Dakshineshwar sir, so far are we great? Up till this point clear? Yes. Now there are two types of borrowings, guys. First one is specific borrowing and the other one is general borrowing. Now what do you mean by specific borrowing? Just 1 minute, guys. Allow me 1 minute. They're doing some work. There was a slight disturbance over here. So specific borrowings, ma'am, what do you mean by specific borrowings? Any loan taken specifically for that qualifying asset. I wanted to construct a factory and I've taken a loan specifically for that asset. It will be capitalized. All the actual borrowing cost will be capitalized. So actual borrowing cost less any investment income. Temporarily, if I've invested my fund somewhere else, I will minus that investment income. Whatever is my borrowing cost, it will be capitalized. So for example, loan interest is 10 lakh and temporary investment income is 2 lakh. So I will capitalize 8 lakh. Now general borrowing, it means what? I've taken borrowings generally. It is not specifically for that asset. I've taken multiple borrowings and some amount I can use it for my this. Here I will have to calculate your weighted average capitalization rate. Ma'am, what is the meaning of weighted average capitalization rate? You will take total interest. Okay, there may be multiple loans. Okay, I will just give you an example. Let's say we have 3 loans. Okay, one loan is a 10% loan of 10 lakh. Second, 12% loan of 12 lakh. Okay, 13% loan of 15 lakh. So these are my general borrowings. So what is the capitalization rate? How do I calculate the capitalization rate? I will first calculate my total interest expenditure. So ma'am, how do you calculate a total expenditure? 10 lakh into 10%, 12 lakh into 12% and 13 lakh into 13%. Whatever is my total interest divided by total loan. So what is my total loan? This total loan. You will sum total of this, you will divide it by total loan, multiply it with 100, it will give you some rate. This rate, let's say the rate, I will just give you some random rate. Let's say it comes to 9.3%. This is my weighted average capitalization rate. So going forward, whatever expenditure I incur on my qualifying asset, I will multiply it with the weighted average rate. Let's say I incurred 10 lakh on 1st of January. So I will multiply it with 9.3%. Only this amount will be capitalized. So here time weight, one thing that you need to remember over here is, here time weight is important. Time weight factor. Ma'am, what do you mean by time weight factor? So let's say under only general borrowing, time weight is important. Actual specific borrowing, whole borrowings will be capitalized. All of the borrowings will be capitalized. So understand, sir, on 1st of January, my financial year is 1st January to December. On 1st of January, my capitalization rate, random figure I've given you, my capitalization rate is 9.3%. On 1st of January, I incurred an expenditure of 10 lakh on this qualifying asset. Okay, so how much amount should be capitalized? This is my expenditure, 10 lakh. Multiply it with the capitalization rate into 12 by 12. Let's say on 30th of June. On 30th of June also, I incurred some expenditure. Okay, now let's make it 1st of June. July, August, September, October, November, December. Yeah, June, 30th of June. 30th of June is better. So on 30th of June, I incurred an expenditure of, let's say, 9 lakh on this asset. So here, what will I do? 9 lakh total expenditure multiplied with capitalization rate multiplied by 6 by 12. This I'm talking about. So here you will apply time weight factor. But in specific borrowing, there is no need to apply time weight factor. Oh, 9.3 into 6 by 12. Perfect. This is how we are going to apply the time weight factor. Are we okay? So this is the only point that you need to remember from general borrowing perspective. Specific borrowing, total full cost will be capitalized. Okay, sir. This is the only point that can, they can trouble you in your examination. The rest, everything is manageable. I will be back. I need to close the door. Just 1 minute. Allow me 1 minute. Now, IS 20 government grants. We'll do with government grants. So far we have completed IS this 16, 38, 40, and we've also completed IS 23. Now we go with IS 20 government grant. Very simple. Again, one of the smallest chapters you will study ever. Recognition, when you recognize the condition, only and only if there's a reasonable assurance that the conditions will be met. The government says, Dakshineshwar sir, you will have to appoint 5 people in this area. So if you are there's a reasonable assurance that you will meet those conditions, then and only then you can recognize government grant and the grant is receivable. You are sure that the grant will be received. Then and only then you will recognize. So revenue grant, simply you will recognize as a deferred income and you will transfer it to the P&L systematically over your expenditure. For example, the salary has been given to salary subsidy has been given, so you will match it against the subsidiary salary expenditure. So in the current year, if I'm charging, let's say 5 lakh, so I will either reduce it from my expenditure or that proportion will be, I will match it with my salary expenditure. Now, second one is what? Capital grant. Now, for capital grant, there are 2 methods. What are the 2 methods? Deferred income or deduct from the asset. Ma'am, what do you mean by deferred income? Whatever amount you have received, you will recognize as a deferred income as a liability. Deferred income is nothing but your liability. It is treated as a liability. Going forward, just the way you're depreciating it, just the way you're charging depreciation to your P&L, you will recognize income in the same manner as your depreciation. So ma'am, what do you mean by this? Let's say, sir, I have purchased an asset of 10 lakh. Okay, so there are 2 methods of recognizing a government grant. First method is I have received a government grant of 2 lakh. First method is what? First, I have received a government grant of 2 lakh. So there are 2 methods. First method, in my balance sheet, this is my balance sheet. My asset will appear at 10 lakh and on my liability side, there will be a deferred income of 2 lakh. Let's say the useful life of this asset is 10 years. the useful life of this asset is 10 years. Going forward, I'm going to depreciate this asset for 10 years. So let's say this is my P&L. I will charge depreciation, 10 lakh divided by 10, 1 lakh. Okay. And in the same manner, I will, transfer it to P&L. This deferred income divided by 10 years will be transferred to P&L. That is 2 lakh divided by 10, 20,000 will be transferred to P&L in the name of what? In the name of government grant. You can name it as other income. So this is how my P&L will look like. This is one of the methods of accounting for capital grant. Another method is what? You deduct it from the cost of your asset. So on my balance sheet, asset is of how much, sir? 10 lakh. I will reduce it by government grant. So on day one itself, I will show my asset at 8 lakh. Yes, perfect. Going forward, I will depreciate 8 lakh. So going forward, the charge to my P&L will be 80,000. So you see, the net impact automatically remains the same. In the first case, what was my P&L impact? My P&L was debited by 1 lakh and was credited by 20,000. So can I say net impact to P&L is 80,000 only, sir? Net impact to P&L. And here also, the net charge to P&L is 80,000. So it does not matter what method you're applying for accounting, the accounting will remain the same, the net impact will remain the same. So first you spread it across the P&L, spread it to the P&L, or you deduct it from the carrying value, that is you reduce the carrying value of your asset. So machine grant 2 lakh, either you show it as a deferred income or reduce the asset value. So here, if there is a repayment of government grant, how are you going to treat it? If it is a revenue grant, you will credit your P&L, debit your P&L, and if it is a capital grant, you will either increase the asset. If you had reduced the asset previously, you will increase your asset, and if you had treated as a deferred income, you will reduce your deferred income. Okay. Now we go to the next part, that is your IAS 36 impairment of asset. Very, very important section, very, very important standard from SBR perspective. You can expect at least one question, 5 or 2, definitely they can test you. Now, what is impairment? Impairment means what? There's a reduction, there's a significant reduction in the value of asset. So impairment of asset, first thing, understand, it is only and only for asset. It means liabilities don't impair. Okay, very logical also, liabilities cannot impair. So impairment of assets only. Now understand, there are certain assets that do not fall under IAS 36. For example, financial assets. And why financial assets will not fall under IAS 36? Because we have a separate impairment categorization. You remember, impairment of financial assets separate. A beautiful discussion, 3 stages of calculation, there are 3 stages of impairment calculation. So financial asset will not fall under your IAS 36. Any deferred tax asset, DTA, DTL, deferred tax asset, okay, will also not fall under your this. Okay. So, and if there is an asset, if there is an IFRS 5 applicable, IFRS 5 is applicable, then again subsequently we are anyways measuring it at fair value less cost to sell, then this will not be applicable. IAS 2 inventory, again you are showing it at a lower of cost or NRV, this standard will not be applicable. So if any standard has any separate method of impairment or separate method of showing the value, IAS 36 will not be applicable. IAS 36 will only be applicable to those assets where there is no special impairment treatment. So can I say in simple language, if I have to tell you in simple language, it is applicable to all the assets covered under IAS 16 and IAS 38. It is applicable to these 2 type of assets. Okay, ma'am. So what is the meaning of impairment, sir? If your recoverable value, if your carrying value means book value, where at what value you are carrying your asset, if it is greater than recoverable value, then there is an impairment. Okay. So what is recoverable value? It is higher. We generally have a tendency of lower. It is always a higher. Recoverable value is a higher of 2 values. First value, fair value less cost to sell. Fair value less cost to sell. Second, value in use. Okay, ma'am, what is the meaning of fair value less cost to sell? This is nothing but fair value as per your IFRS 13. Just a simple fair value minus if there are any cost to sell the asset. Second one is what your value in use. Value in use means what? It is the PV of future cash flows. It is a PV of future cash flows discounted using a rate. So cash flows. Yeah, NR, you can say NR. So it is a PV of your future cash flows discounted using a rate. So whatever is a higher is my recoverable value. So understand, if my carrying value is greater than recoverable value, then it is there's an impairment. So if my carrying value, let's take a numerical example. My carrying value is, let's say, 10 lakh, but my recoverable value is how much? 8 lakh. That means what? My asset is overstated. There is an impairment loss of 2 lakh. It has to be charged to P&L. Simply, it will not go to it will not go anywhere else. Simply, it will go to P&L. So I will debit your P&L. I will credit my asset by 2 lakh. I will reduce my asset by 2 lakh. Okay. Now, ma'am, when do we say that there's an impairment? See, generally, you do not do the annual testing. You do not go for annual testing. You will test for impairment only and only when there are indicators. There are two types of indicators, external indicators or internal indicators. Only and only if there are indicators, then and only then we do the impairment testing. Else we will not do the impairment testing. Okay, understood. So, understand, what are the external indicators here? Market decline, adverse economy, and increased interest rate. These are some examples of external indicators. Internal indicators, obsolescence, asset has become obsolete. Physical damage, there has been a physical damage to asset, or asset has been performing poor. If there are indicators, you test for impairment and you do the impairment testing. So what is the recoverable amount? We have already discussed this. Higher or fair value less cost to sell. So if carrying amount is greater than recoverable amount, you will go for impairment loss. One thing that you need to remember over here, sir, is for other assets, we will not do the annual impairment testing. But for three types of asset, we will always do the impairment testing. So these are three intangible assets. What are the three intangible assets? Irrespective of indicators, annual impairment test is mandatory. What is the first? Goodwill. Ma'am, why goodwill? Because you don't charge amortization to goodwill. Remember, if it is a goodwill, you will not amortize it. If you remember IFRS 3 goodwill, you just do the impairment testing. You do not amortize your goodwill. So if you're not amortizing your goodwill, annual impairment testing is mandatory. Second, any intangible asset that is with indefinite useful life. If you have any asset with indefinite useful life, intangible asset, then again I told you, if you remember I studied discussion, we do not amortize it. If you do not amortize, annually please test for impairment. And third, any intangible asset not yet ready. Okay, not yet capitalized, so not yet ready. So that even in that situation, three intangible asset, you will do the annual impairment testing irrespective of the indicators. Okay, so I don't think I've mentioned this point somewhere. Just write it and keep it somewhere as a highlighted point. Okay, this can be tested in a question. Now, value in use, simply present value of my future cash flows. Now we go to the next discussion, that is your cash generating unit. What is the cash generating unit? It is the smallest identifiable group able to generate independent cash flows. So any identifiable group in my organization that is able to generate independent cash flows, then it is my CGU. So for example, if I have to talk about this classroom, if you ever attend physically, you see in a classroom there are multiple things. Okay, sir. There's a television, there's a camera, there's a mic, there's a laptop, there's a tab. Now see, understand, if I have to tell that this television or this tab or this pencil is a CGU, I cannot say it because these things are not able to generate independent cash flows. Coming together, these all set of assets, if they all come together, then and only then they will be able to generate independent cash flows. So any smallest group of assets that is able to generate my cash flows or independently generate my cash flows, then I will say it as my CGU, otherwise it is not my CGU. So for example, a retail store chain, each store may be a separate CGU. Now, testing CGU on the asset basis, I mean on a CGU basis, then I will allocate impairment loss to first CGU. Sorry, not CGU, sorry. If I'm testing impairment on a CGU basis, first the impairment will be allocated to goodwill. Eat up your goodwill, completely eat your goodwill. Then on the other assets, other eligible asset, my dear friends, other eligible assets. Okay, so for example, your IAS 16 asset, IAS 38 assets. Do not allocate impairment loss to financial asset, deferred tax asset, inventory and all. Do not do that. Okay, they are not eligible assets. Only PPE, any patent, copyright, any of these assets that you see, only these assets are eligible assets. So first you will eat up your goodwill. Second, any intangible asset, any impairment loss will be allocated to other assets on pro rata basis. Goodwill. Now, one important point, goodwill impairment never reversed. In future, whenever there's a betterment of situations, still you can reverse the impairment loss recognized on the other asset, but on goodwill you will never reverse. Goodwill once impaired, forever impaired. Goodwill will never be reversed. Now, reversal of impairment. Reversal of impairment. Previously, you had recognized impairment loss, but in future situations get better. So, for example, right now the war-like situation is going on. So all the assets are impaired. You see, war-like situation is going on. For example, I have an asset in Dubai. Now, because of all of this war-like situation, what has happened? The value of my assets over there has gone down. So right now, I would have recognized impairment. But let's say 1 year later, everything gets better. The situations get better. Situations have now improved. So I need not recognize impairment. So see, the standard says you can reverse impairment loss. Allowed if estimates improve. But it is not allowed for goodwill. If you have impaired your goodwill, let it be. You do not reverse it. You do not reverse it back. On other assets, you can reverse your impairment loss. On other assets, you can reverse impairment loss. Provided it does not exceed, provided subject to maximum of carrying value had there been no impairment. So other assets, you will reverse it, you can reverse it, but subject to maximum. Had there been no impairment. So if there, whatever is the value, had there been no impairment, you can reverse it only to that part. You cannot reverse the complete impairment loss. Okay. Now we go to the next part, that is IFRS 5 criteria of held for sale. So far so good, sir. Any doubts, any questions for me? Okay, so now IFRS 5, we'll discuss IFRS 5 classification criteria. Classification. When do you classify your asset as a held for sale? So asset is classified as held for sale if following criteria are met. So for example, what are the conditions that we need to check? Available for immediate sale. Sale is highly probable. Active sale program has started. Sale price is reasonable and unlikely major changes or withdrawal. So if these conditions are met, we can classify the asset as held for sale. So when you classify your asset as held for sale, you will measure it at lower of two values, carrying amount or fair value less cost to sell. So whatever is a lower value of these, you will measure your asset at lower of these values. So for example, carrying value of my asset is 20 lakh, fair value less cost to sell is 18 lakh. So lower is what? 18 lakh, you will measure it at 18 lakh. So ma'am, it means what here? I will have to charge impairment? Yes, I told you all. IAS 36 impairment is not applicable over here. Yes or no? So this 2 lakh is nothing but my impairment loss. But this is as per IFRS 5, not as per IAS 36. So here you will measure it at 18 lakhs. So you will do what? You will debit your impairment loss and you will credit your asset. 2 lakh. This is as per IFRS 5, not as per IAS 36. Depreciation, I told you all, stop depreciation. Only two situations, IAS 40 fair value model and IFRS 5 held for sale. In these two situations, you will stop your depreciation. So here you will stop your depreciation. Now discontinued operations. So if it is a major component, disposed or held for sale, it is presented separately. Discontinued operation, very important. Firstly, it has to be a major operation. Okay, a discontinued operation is a component of an entity that has been disposed or classified as held for sale. It is a major component. And it represents sale of a major line of a business, a geographical area, or a single coordinated disposal plan or subsidiary acquired exclusively for resale. Ma'am, I did not understand any single point. What are you trying to say? See, understand, logic, example, okay. ArivuPro Academy has three branches, yes or no? We have one in Bangalore, we have one in Chennai, and other one is in Coimbatore. If I sell Coimbatore branch, if I sell my Coimbatore branch, it can be treated as a discontinued operation when this is a major, it is a component of entity. Yes, it is a component of entity. How? It is a geographical, it represents a separate geographical land, a geographical area. It has either been disposed of or it has been classified as held for sale. I have put it upon sale. I have put it upon sale. I've said that if you want to purchase it, you can purchase it. So if it represents any of these, I can say it is my discontinued operation and I can treat it and the accounting can be done that way. What is the meaning of component of entity? Component of entity means what? A component is operation and cash flows can be distinguishable operationally and financially. It means what? Can I identify separate cash flows of Coimbatore branch? If the answer is yes, it is my component. So a separate division, a separate a subsidiary, a major branch, or a geographical segment, then it is my component. So for example, the company has an automobile division, a pharmaceutical division. If you sell pharmaceutical division, it is likely a discontinued operation. What is not a discontinued operation? A single sale of machinery or a small store. It is not major, then it is not a discontinued operation. So what is a condition for discontinued operation? It has to be disposed or held for sale as per your IFRS 5 conditions. All those conditions should be met and it has to be major. First, it should represent a significant line of a business. So ma'am, if it meets my held for sale condition, if it is my discontinued operation, so you know these conditions: available for immediate sale, sale is highly probable, the active program to locate the buyer has been started, most probably has to happen within 1 year, and selling price is reasonable, and unlikely major changes in withdrawal. If it meets this condition and it is my major component, then accounting will be different. Once you classify it as a held for sale, you will stop depreciation and you will measure at lower of carrying value and fair value less cost to sell. So accounting treatment measure at lower of these two values. So journal entries, you can go through it. We have just had a discussion. Stop depreciation. SOFP. Now in my statement of financial position, how am I going to present it? I am going to present it separately. Asset held for sale, I will present separately, and liabilities directly associated with this asset will be presented separately. For example, under my current asset held for sale. Why current asset? Because it will be sold within 1 year. Current liabilities associated with the held for sale asset. In my P&L, very extremely important. I've highlighted it, extremely important from SBR perspective. A separate presentation is mandatory, important, mandatory separate presentation. Discontinued operation will be shown separately, but below continuing operation. You remember the 5 classification of your P&L: your operating, financing, investing, then tax, then discontinued operation. So if there is a discontinued operation, it will be shown separately. So how do you show it separately? You will show first profit from continuing operation. Under profit from continuing operation, you will show profit or loss from discontinued operation, then you will show your total profit. So discontinued operation will be shown separately in my P&L. What is to be included in my discontinued operation figure? I will include post-tax profit and loss after tax and post-tax gain and loss on remeasurement. I will have to remeasure it, you remember? Lower of carrying value and fair value less cost to sell. So this plus any post-tax profit and loss will be shown here separately. Now see, this was very important. In my notes to accounts, see, on my face of P&L, I'm not showing anything. I am not showing revenue. I'm not showing cost of sale. I'm just showing a single figure about post-tax profit and post-tax remeasurement gain and loss. But under my notes to accounts, I will have to give a separate analysis. What is my revenue? What are my expenditure? What is my pre-tax profit? What is my tax expenditure? Disposal gain and loss? All of this has to be shown in my notes. In my cash flow disclosure, a separate disclosure is required for what are my operating cash flows of this asset, what are my investing, and what are my financing category related to my discontinued operation. So for example, a discontinued subsidiary operating cash outflow is this, investing cash outflow is this you will have to disclose separately. Now, impairment of a disposal group. If you have sold any disposal group, and how do you impair it? How do you test the impairment loss? So group of assets and liabilities disposed together. So impairment allocation order, just that way you will first allocate it to your goodwill, then on the other assets on a pro rata basis. Now, important rule, you cannot very important rule, you cannot reduce your carrying value below your individual fair value less cost of sale. If my asset has an individual fair value less cost of sale, you cannot further reduce it below that. Value in use or zero. It cannot, your value of your asset can never be negative. Subsequent increase. If there is a subsequent increase in the fair value less cost to sell, reversal is allowed. You can reverse the asset, but I told you all, it cannot exceed the carrying value had there been no impairment. Now, disposal of a subsidiary, very common, very important SBR issue. If subsidiary is disposed, usually it is a discontinued operation. Usually you will treat it as a discontinued operation if it is major. Okay, so what are the accounting the accounting effect if you have disposed a subsidiary? You will derecognize a subsidiary, you will recognize disposal gain and loss, and you will recycle OCI where items are allowed to be recycled. So for example, foreign subsidiary disposed, any FCTR balance in P&L will be recycled to P&L. FCTR balance in OCI will be recycled to P&L. Are we okay with this, sir? Tell me. Yes. So sir, we take a small break, sir. 10 minutes break. We take a small 10 minutes break. Now let's take a 15 minutes break. I'll just have a tea and coffee, come back. It's 12:05. I'll meet you at 12:20. And then we will complete then after this we'll complete IFRS 13, then financial instruments. Okay, then leases. This is the target for the day. That's how I'm going to continue with our discussion. We'll complete our financial instruments, leases, then the IFRS 13, then this. If time permits, we'll go for IFRS 2 and IAS 19 as well. So we had completed till this, no? Sale and repurchase. This is on non-current assets. The last part of your non-current asset, IFRS 13, we are left with. Held for sale done. Okay, now we start with IFRS. Ma'am, can you send? Yes, sir. Today I will send it. I've prepared whole bunch of important chapters and the notes, and I've also prepared the the area that you all found it difficult. I received text from some of you all, 2-3 people asking about what goes to which category of P&L. So I've prepared a small revision list for you all. What goes where? What goes to OCI? A simple revision list. What is recyclable? What is non-recyclable? And what goes to operating category. I've prepared everything. I will share it once we're done with today's time. I will send the notes to you in the group. Tomorrow I'll discuss some questions also. So we'll take those. I will send those Excel files also in the group itself. So just 1 or 2 days before exam, you just go through these notes and you're done. Okay. Now let's eat up this IFRS 13. Very small and very easy standard. IFRS 13, ma'am. What is the meaning of IFRS 13? Fair value measurement. Here we will measure the fair value. Guys, what is the fair value? It is always the price received to sell the asset in an orderly transaction and price paid to settle a liability. Okay, so it is always the exit price. Always remember, fair value is always the exit price. There are 2 types of prices: entry price and exit price. Entry price means to enter into the transaction, and exit price means to exit the transaction. So how do you exit an asset? How do you get rid of an asset? By selling the asset. So price received to sell the asset, and for liability it is a price paid to settle a liability. That is my fair value. Okay, this I forgot to mention over here. You can write it and keep it somewhere. So what are the valuation techniques? How do we value our fair value? First one is market approach. Whatever is the market value, you take it accordingly. Income based approach, if the you follow your cash flow method. And cost approach, it is your replacement cost. Now fair value hierarchy, guys, there are 3 levels of your fair value hierarchy. First one is level 1 is quoted prices. Reliance shares quoted prices. Today I want fair value for Reliance share, I can get it. You go to the online, you find what is the price of Reliance today, because it is quoted on market. It is a quoted price. Level 2, observable input. For example, ArivuPro Academy is not listed. So I cannot find out share price of ArivuPro Academy. But can I find out share price of a similar industry? So for example, let's say Physics Wala. Physics Wala is listed. Okay. Now can I find out share price of a Physics Wala? Yes, the answer is yes. I can find out the share price of Physics Wala. And I will do some more or less adjustment. Then it will be my observable input of similar items. Okay. Level 3, unobservable. For example, I have some specialized asset whose fair value cannot be measured. There is no observable input. There is no quoted prices. Then what do? We find out just the way we do in your value in use. You find out the fair value like as if it is a value in use. You find out the future cash flows and you discount it using the present value. Using the rate. That is your unobservable this. Now there are 2 types of markets here: principal market and most advantageous market. Ma'am, what do you mean by principal market? Any market with highest volume and level of activity of the asset or a liability. So if I have to tell you about principal market for shares, you will say what? Share market. Where is the highest volume of shares happen? Share market. So share market is a principal market. So if principal market exists, very important rule, there may be a 2, 3, you can expect 2, 3 or 5 marks question. If principal market exists, if there is a principal market, then use the price in that market even if another market gives a better price. Very important. Usually there's a tendency, we all get confused at principal market, most advantageous market. No. If there's a principal market, even if the another market gives us a better price, doesn't matter. The principal market value will be taken. Okay, ma'am. So for example, we have 2 market A, highest activity, and market B, there's nothing mentioned. So if highest activity happens in market A, it gives me the selling price is 100. If I sell it in the market A, I will get 100. If I sell in the market B, I will get 105. So since market A is my principal market, because there's the highest activity happening over here, then fair value will be this, not this. Even if it gives me better results, still I will not take the fair value this as this. So use 100 because market A is a principal market. Ma'am, what if there is no principal market? Ma'am, what if we are not able to identify principal market? Then you will have to find out most advantageous market. Use only if principal market does not exist. If there is no principal market, find out most advantageous market. Ma'am, what is the most advantageous market? Market maximizing the amount received. So whichever market gives me the most benefit, that is my most advantageous market. So after transaction cost, after transportation cost. So let's say selling price minus transaction cost minus transportation cost. Whichever market gives me the most benefit, that is my most advantageous market. So for example, we have market A and market B. In market A, my selling price is 100 minus cost 10 minus this transaction cost and transportation cost, it gives me 90. And market B, selling prices is the transportation cost and transaction cost are 2. So here it gives me net benefit of 93. So here my most advantageous market is this market B. So use market B because higher net proceeds. So very important rule, transaction costs are not calculated in fair value itself. So transaction costs are only used to calculate your most advantageous market. Whenever you want to calculate the most advantageous market, you will deduct the transaction cost, but you will not deduct the transaction cost to calculate the fair value. They only help us to identify this most advantageous market. What is the fair value over here? Fair value is selling price minus the transportation cost. So let me give you one example, sir. We have market A, we have market B. Selling price 100, again 100. Transaction cost is 10. Here transaction cost is 12. transportation cost is 10. Here transportation cost is 10. Okay, so tell me, sir, what is my most advantageous market? We don't have any principal market. So here I am getting how much? Can I say here I'm getting 80 rupees and here I'm getting 78 rupees. Yes or no, sir? So can I say my most advantageous market is market A because it is giving me the highest proceeds. So ma'am, we have figured out market A is your most advantageous market. But if you want to find out fair value is not 80. Fair value is not 80. Fair value is 100 minus transportation cost. Let me change the transportation cost over here. Let's make it transaction cost is 10 and transportation cost is 5. So here I'm getting how much? 1585. So here my fair value is how much? 100 minus transportation cost 5. So my fair value is 95, not 85. Are we okay with this? Now we go to highest and best use. Highest and best use is applicable only and only for non-financial asset, land, building, machinery, meaning fair value based on assets used that maximizes the value. For example, we have a building. If you ever come to Bangalore, so we have a building over here in Koramangala. Koramangala is one of the corporate areas. Okay, here you will find a lot of offices. It's one of the areas where you will find a lot of offices and all. Okay, so let's assume we have a building over here where that is used as a teaching. We are using it for teaching. But highest and best use, let's say a lot of offices are there. Okay, now you can see this is also office. Let's take it as a clubs. There are a lot of clubs over here, gaming clubs and all. So as per the value, I mean, the area is surrounded by a lot of clubs. So the value, I mean, what value will fetch the maximum value to this building? Club value. I mean, if I want to sell this building as a club, then and only then I will get a value. I mean, I will get the maximum value. So irrespective of how it is used, I will give you some different example now. See, you have a house over here. Let's say you have a house in Koramangala. The area is a fully corporate. The value, if you use this house as a residential purpose, you will get 50 lakhs. But if you use this asset as a commercial building, you will get 80 lakhs. Okay, so you are living in the house. You will say, madam, fair value is 50 lakhs because I'm living. The answer is no. As per IFRS 13, it does not matter how you are using the asset. It matters what would be the value if you use it to the maximum potential. So if you use it to the maximum potential, you will fetch 80 lakhs rupees. So fair value is 80 lakhs, not 50 lakhs. Are we okay with this, sir? Highest and best use. So, or if I put it into your words, sir, your potential is to score all world rank. Your potential is to score all world rank. But you scored all India rank. You scored AIR 1. Sir, but if I see you, I will see you as your highest and best use, as your highest potential. Your potential is to score all world rank. So I will treat you like this. I will treat you like all world rank rather than all India rank. Are you getting me, sir? I was just trying to give a stupid example. But did you understand the meaning of highest and best use? It does not matter how the asset is used, but it does matter what is the maximum value it can fetch from utilizing it to the maximum value. Make sense? So, highest and best use. When you say highest and best use, it must be physically possible. It means what? This house should be able to physically get converted into a corporate building. Legally permissible, the law allows me, and financially feasible. Only and only when these three conditions are met, we say that the highest and best use of this house is not a residential premises, but a commercial building. So for example, a land currently used as a parking lot, but legally permitted and financially feasible for a shopping mall, then highest and best use is shopping mall. Therefore, fair value will be based on shopping mall, not on the basis of a parking lot. Okay, so with this, we finish our IFRS 13. Do you have any questions, any doubts? If no questions, then I will go to financial instruments. Very, very important discussion, financial instruments. Doubts, questions? Okay, we will start with financial instruments, one of the most important, one of the most tested topics You can skip any chapter, I am telling you, but do not skip group accounting and all the chapters that I'm covering today. Do not skip it, because there's definitely a possibility that you will be tested on these topics. Examiner's favorite. Financial instruments is examiner's favorite because this is the area that can, give a lot of variety of questions. So ma'am, what are we going to, let's go through the mind map of our financial instruments. First, we are going to understand basic financial instruments. What is a financial asset? What is a financial liability? Initial recognition and initial measurement. Then classification and measurement of a financial asset. How do you classify a financial asset? You remember fair investment in debt instrument, investment in equity instrument. So business test model, your SPPI test, then amortized cost, fair value through other comprehensive income, fair value through P&L, then equity instrument, and then we'll go for reclassifications. Then classification and measurement of financial liabilities, generally at amortized cost only. Then what are the liabilities that can be classified as a fair value through P&L liabilities and own credit risk? These are the areas that we need to cover. Then effective interest rate. What is the meaning of effective interest rate and what is the application? Then impairment. Then we'll go to the next discussion that we'll have is about impairment. Then derivative accounting. How do you account for a derivative? Then hedge accounting. How do you account for a hedge? Then debt modification, substantial 10% test, substantial modification or non-substantial modification, extinguishment accounting or modification accounting, derecognition of a financial asset, and then some key important words that you can go through. So basics of financial instruments. We will start with basics. What is a basic financial asset? Is an asset that is a cash, equity instrument of another entity, or contractual right to receive cash or any other financial asset. This is a basic definition of your financial asset. Cash, equity instrument in another entity, or a contractual right to receive cash or any other financial asset. So what are the examples of my financial asset? Generally, trade receivable, loan given, bank balance, bond, and shares. These are your generally shares in another company, okay, not my own shares. These are what my financial asset. What is a financial liability? Financial liability basically means a contractual obligation to pay cash and to deliver any other financial asset. That is my contractual liability. There has to be an obligation to deliver cash. Now, what are the examples of financial liability? Trade payable, bank loans, debentures, and bonds payable. These are the examples of my financial liability. Initial recognition. How do you recognize your financial liability? Initial. When do you recognize your financial asset or a liability? When you become a party to the contract. For example, Surbi, this is Surbi. I sold goods to Dakshineshwar sir. Okay. So whenever we entered into this contract, when we become the party to this contract, when I sold you this asset, I will recognize, if I've sold it on credit, I will recognize a receivable and you will recognize a payable. So whenever you become a party to a contract, then and only then you recognize this. Usually it is traded whenever you enter into the contract. Initial measurement, always and always at fair value. Initially you will measure your financial asset or a financial liability at fair value. Now, transaction cost treatment, we are talking from financial asset perspective. If your asset is measured at amortized cost, going forward we are going to revise it. If your asset is measured at amortized cost method, you will add the transaction cost. If your asset is measured at fair value through other comprehensive income, again you will add the transaction cost. But if your asset is measured at fair value through P&L, you will expense it, you will charge it to P&L. Now, for example, you purchased shares of 1 lakh, you paid a brokerage or commission of 5,000. If you are measuring at FVTPL, 5,000 will be charged to P&L immediately. Otherwise, you will capitalize it. It means what? Otherwise, if you are using amortized cost method or fair value through other comprehensive income, this 1 lakh, I mean, you of course, amortized cost method will not be applicable over here. Here only, since we have purchased shares, so you will capitalize 1 lakh plus 5,000. You will show your asset at 1 lakh 5,000. Okay. Now, classification and measurement of financial asset. How do you classify and you subsequently measure your this? So there are two tests, guys. First one is business model test. What is my business model? To hold the contractual, I mean to collect the cash flows and hold till maturity or to trade. And SPPPI test. SPPPI test means what? Solely payment of principal and interest. So business model, if my business model is to hold and collect contractual cash flows, I will apply amortized cost method. If my business model is to hold and collect, hold to collect and may sell if beneficial, then fair value through other comprehensive income. If I want to trade in my financial asset, debt instrument, okay, this is applicable for debt instrument, then FVTPL accounting. I will apply FVTPL accounting. What is SPPPI test? Solely payment of principal and interest. That is why this test is not applicable for your equity instrument. Why? Because there is no SPPPI. SPPPI means solely payment of principal and interest. So interest includes what? Time value of money, credit risk, and lending margin. So if SPPI fails, if there is no SPPPI, then fair value through P&L compulsory. That is why, if you remember, for equity instrument, there is a default measurement using FVTPL. Default. By default, you apply what? FVTPL accounting. Now, amortized cost method. What is the condition? Hold to collect and SPPPI should be passed. So you will apply using what? EIR method. You will apply amortized cost method. You will apply EIR and you will measure your investment like this. So if there is an interest income, it will go to P&L. No, I mean, of course, there will be an interest income. Interest income will go to P&L. Impairment will also go to P&L, and disposal and of gain and loss will also go to P&L. You will not remeasure it. You will not remeasure. There will not be fair value gain. So, for example, trade receivables collected, over time. It is your amortized cost method. Fair value through other comprehensive income, debt instrument. If you are measuring your debt instrument at, if your condition, if your business model is to hold, to collect and sell, and SPPI has passed, in that case, you can measure your debt instrument at fair value through other comprehensive income. In this case, interest income will go to your P&L. Impairment will also go to P&L. Fair value changes will go to your other comprehensive income. Here, any fair value gain and loss will go to other comprehensive income. Disposal, on disposal, whatever is a balance in your other comprehensive income, you will recycle it to P&L. You will recycle it to P&L. So any fair value gain and loss, other comprehensive income, and whatever is a balance, investment in debt instrument, balance in OCI is recyclable to P&L. So for example, government bond occasionally sold for liquidity, fair value through other comprehensive income. Now fair value through P&L, it is a default category. When you apply it, when SPPI fails, when your asset is held for trading, and when it is designated at FVTPL. So all fair value gain and losses will go to P&L here. Every fair value gain and loss will go to P&L. So for example, shares held for short-term trading, fair value through other fair value through P&L. But equity instrument, by default there is a fair value through P&L. But there is an option given to us in the standard that you can elect to measure it at fair value through other comprehensive income. Entities can elect to measure their equity instrument at fair value through other comprehensive income, allowed only and only if it is non-trading in equity instruments. You are not trading in equity instruments, then and only then you can apply this. So what is the treatment over here? Fair value changes will go to other comprehensive income. Disposal gain, you cannot recycle it. Disposal gain, it is not recyclable. On disposable, whatever is a gain and loss will go to your from OCI, it will go to retained earnings. Dividends will go to P&L. So no recycling of equity instrument at fair value through other comprehensive income. It will never go to P&L. Reclassification. See, reclassification is only permitted in what? Investments in debt instrument. Fair enough. Investment in debt instrument. Ma'am, why investment in debt instrument? Why not investment in equity instrument? Why reclassification is only in investment in debt instrument and why not in investment in equity instrument? Because in equity instrument, if you're opting this fair value through other comprehensive income, it is an irrevocable. It is an irrevocable option. Ma'am, what do you mean by irrevocable option? It is an option that you cannot revoke in future. Once chosen fair value through other comprehensive income, forever other comprehensive income. In future, you cannot go back to P&L. In future, you cannot choose to measure through P&L. So it is an irrevocable option. Hence, we do not have reclassification option in fair equity instrument measure any investment in equity instruments. But we do have reclassification option in investments in debt instrument. So allowed only if business model changes. If your business model was to collect contractual cash flows, now it is collect contractual and may sell, then you can change it. It is very rare and you apply prospectively. Going forward, you change it. Classification and measurement of financial liabilities. So sir, so far so good. Are we understanding? Are we on the same page? Do you find any difficulty, any point that you did not understand, sir? Just 1 minute, I'll drink some water. quality. Great. I hope this revision is fruitful. I mean, I hope you're just listening to me. You're able to recall the points. If you're able to do that, then the efforts are worth it. Now, classification of your financial liability. How do you classify your financial liability? Initial measurement, always fair value. Subsequently, amortized cost. By default, default treatment of your liability, amortized cost method. You will measure using EIR. You will apply you will prepare amortization schedule. Simple classification. But so what are the examples here? Trade payables, bank loans, and debentures. These will be treated as amortized cost method. By default, ACM method we will apply. But fair value through P&L is available. So in financial liability, no fair value through other comprehensive income, only fair value through P&L. So fair value through P&L is option is available only and only if under these three liabilities. What are the three liabilities? Held for trading. If your financial liability is held for trading, you are trading in day-to-day purpose in your financial liability, then please go to P&L. No amortized cost method. Derivative financial liability. We know derivative financial liability will always go to your P&L. And accounting mismatch. Accounting mismatch means what? I have taken a loan from you, sir. Okay, I will prepare a mind map over here. I have taken a loan from you, sir. So can I say this loan for me is a financial liability? The same money I used, this 1 lakh rupees that I've taken from you, the same money that I've used, this money I have used to give as a loan to, let's say, Anas sir. Okay, I've used the same money. So here, this is an investment in debt instrument. I've given as a loan to Anas sir. It is an investment in debt instrument. So the standard says, if you are measuring this transaction, if you are measuring this transaction at FVTPL, if you are measuring this at FVTPL, then even this transaction has to be measured at FVTPL. Accounting to avoid accounting mismatch, because the same money you're going to P&L and here the same money you're applying through amortized cost method, then it is not allowed. If it is an accounting mismatch, then this financial liability can be measured at fair value through P&L. This is what nothing but accounting mismatch. Now see, if there's an accounting mismatch, if these three conditions are there, if these three situations are there, then you do what? You measure your financial liability using what? You measure your financial liability using fair value through P&L. So if there is a fair value fluctuation due to own credit risk, sir, if there's a fair value fluctuation due to own credit risk, it will go to other comprehensive income. And remaining will go to P&L. Own credit risk, if there's anything related to my own credit risk, it will go to other comprehensive income, and remaining will go to P&L. Now, effective interest rate. What is the meaning of effective interest rate, sir? It is a rate discounting future cash flows to initial carrying value. What is the application of it? To spread premium and discount. See, understand, sometimes I've purchased a bond for 95,000, but it will be redeemed at 1 lakh. So I need one rate. I need to discount 1 lakh using a rate. I need to discount it so that today it becomes 95,000. 2 or 3 years later, whenever I settle it, I need a rate. Whenever I settle this redemption, whenever I settle this bond, this should automatically become 1 lakh. So I find out EIR. I find out effective interest rate. So this is nothing but your effective interest rate. Usually in the question it will be given. In finance term, if you ask me, ma'am, in finance term, it is nothing but IRR, internal rate of return. It is nothing but whenever you learn your finance AFM and FM, at that time you will learn what is IRR. So effective interest rate is nothing but your IRR only. It is a rate used to discount. I want to know a rate. So today I have purchased a bond for 95,000. 2 years later, it should become 1 lakh. The rate that we used to discount is nothing but your IRR. So you spread discount and premium to calculate finance income and expenditure. Okay. Now we go to the very, very important discussion of your impairment of your financial asset, ECL, expected credit loss, ECL model. So you apply ECL. Loss is recognized before the actual default. Loss is recognized before the actual default. Basically, you're making a provision. It is nothing but a kind of a provision for bad and doubtful debts. So here, my chartered accountants, there are 3 stages. There are 3 stages of your ECL model. Stage 1, stage 2, and stage 3. Stage 1, normal. Okay, for example, sir, I will give you one example over here. You have given me a loan of 1 lakh. Okay. So 1 lakh loan, for you it is a financial asset, for me it is a liability. So now you will have to check, it is a financial asset for you. So you will have to check if Surbi has job and she's doing well, she's paying you the interest and principal on time, then the normal you will apply what 12-month ECL. Whatever is the expected loss within next 12 months, you will apply, and interest will be on gross amount. Now imagine I have lost my job. I lost my job. ArivuPro Academy says, Surbi, we no longer want to work with you. I've lost my job. So here my credit risk has increased. Okay, impaired, not impaired. Credit risk has increased. There is a possibility that I may make a default in future. There's a possibility that I may default in future. So in that case, you will apply what? Lifetime ECL. Now, what is the meaning of lifetime ECL? All the probable future losses, or you will recognize your ECL at all your future possible losses. And interest is again here also at gross amount. But, stage 3, credit impaired. I have defaulted. I owed you 1 lakh rupees. I did not pay. I went bankrupt. Here there's an objective evidence that Surbi has defaulted. So here the asset has become credit impaired. You will again apply lifetime ECL, and the interest will be on net amount. Very, very important. The interest will be on net amount. So customer normally pays, stage 1. Customer is facing a financial difficulty, stage 2. And customer likely bankrupt, so stage 3. Okay, so simplified approach. Now, this was simple ECL accounting, but the standard says there are 2 types of assets where we need not go for the stage 3 classification. All the you need not do the classification of stage 1, stage 2 and stage 3. You can simply go for lifetime ECL. What are those? Trade receivable and lease receivable. So for these 2 assets, you need not do. I mean, see, imagine a company like Reliance, ArivuPro, and we'll have a lot of data, right? So every day, every month, we cannot sit and see which stage is it in, right? What is the possible default within 12 months? What is the possible default for lifetime? So we need not do that. Okay. So for trade receivables and lease receivables, we can simply go for lifetime ECL. No staging required. Now, what are the indicators that the credit risk has impaired? What are the indicators of credit risk has impaired? Missed payments. I missed some payment. Downgrade, credit downgrade. My credit rating has gone down. Financial distress. I'm going through any financial distress. And economic downturn. If I'm going through any economic downturn, the situation going on right now is what? Economic downturn. So IFRS 9 forward-looking impairment model. Now we go to the next and very, very important accounting, derivative accounting. What is a derivative actually? What is a derivative? 3 conditions has to be met. Derivative, to conclude it is a derivative, it has to meet the 3 conditions. What are the 3 conditions? Value changes with respect to underlying variable. For example, I bet on Virat Kohli's performance. So here, if Virat Kohli performs well, my value will go up. If Virat Kohli does not perform well, the value will go down. So it is on the basis of what? Underlying variable. Little or no initial investment. Initially, I will have no investment. I mean, I need not pay anything, or maybe just few rupees, very little. And the amount will be settled in future. If these 3 conditions are met, we say it is a derivative. So, sir, if there's a question on derivative, please do not forget to write this definition. Without this definition, your derivative question will be incomplete. So what are the examples of derivative? Futures, options, swaps, and forward contracts are nothing but your examples of your derivatives. Initial and subsequent measurement. I will just drink some water, sir. Okay. So initial and subsequent measurement. Initially, all the derivatives are measured at initially, and future also all the derivatives will be measured at FVTPL. I told you all, FVTPL, always at FVTPL. For example, forward exchange contract, fair value gain and loss will be recognized in P&L. Now, very, very important. So all that you need to remember for derivative is every gain and loss will go to your P&L. Now we go to hedge accounting. Very, very, very important. Hedge accounting. What is the meaning of hedge? Hedge is basically a technique. Hedge is basically a technique to mitigate the risk, future risks. Hedge is basically a technique to mitigate the risk. So what is the objective of hedge accounting? To mitigate the accounting mismatch, to mitigate the future accounting mismatch. So without hedge accounting, what will happen? Without hedge accounting, what will happen? If you have any derivative, it will go to FVTPL. If you have any hedged item, it may be amortized. It may be measured at amortized cost or fair value through other comprehensive income. This creates artificial volatility in P&L. So what happens because of this? For derivative, we will recognize gain and loss in P&L, but hedge item will remain as it is. So that is why we do hedge accounting. So what is a hedged item? Understand there are two terms over here: hedged item and hedging instrument. Hedged item is it can be an asset or a liability or a firm commitment or forecast transaction, future forecast transaction exposed to risk. What is a hedging instrument? A hedging instrument is a financial instrument used to offset risk. It is usually a derivative. Now, hedge effectiveness. What is the meaning of hedge effectiveness? It is the extent to which hedging instrument offset the changes in your hedged item. If your hedged item is exposed to any risk, what is the extent to which your hedging instrument will offset that risk? Now, what are the conditions for hedge accounting? What are the conditions you apply for hedge accounting? There are three conditions, very, very important. You can apply hedge accounting only and only if these three conditions are met. If these three conditions are not met, ma'am, then what accounting we will apply? You will apply normal derivative accounting. If these three conditions are met, then and only then you can apply hedge accounting. What are the three conditions? Formal designation and documentation at inception. At inception, you will designate it as a hedge, whatever hedge it is, fair value hedge, cash flow hedge, and you have a documentation in place. You should have all the documentation. Second, eligible items. Your hedged item and your hedging instrument should be your eligible item. And third one, your hedge is effective. Your hedge should be effective. It means what? Your hedge should be able to mitigate the risk. Your hedge should be able to mitigate the risk. So important documentation is required at the start of the hedge. So there may be some questions you may find where we do not have, documentation, proper documentation in place. So two types of hedges. There are two types of hedges covered in your syllabus: fair value hedge and cash flow hedge. I will just be back. So there are two types of hedge accounting that is covered in our syllabus. Fair value hedge, that is changes in fair value. Here your risk is item, that is the fair value changes in my item, hedged item. And cash flow hedge, here my risk is variability in my future cash flows. Okay. So what is a fair value hedge, guys? What is a fair value hedge? Here, hedge exposure changes in fair value of a recognized asset or a liability. What am I exposed to? What is the risk am I exposed to? Changes in fair value of my asset or a liability. So what is the objective? Changes in fair value, offset the fair value changes. So initial measurement, very important here. Initial measurement of a hedging instrument, that is a derivative, is measured at fair value. Initially, you will measure your hedging instrument at fair value. So usually initially there will be a nil or small amount initially. You remember those questions where we pay something for options, to purchase options or all of that. So usually there will be nil or some amount. Okay. Hedged item initially is measured under relevant IFRS. So amortized cost, OCI or whatever. If it is an inventory, your inventory lower of cost or fair value. So whatever is the hedged item, whatever is a relevant accounting treatment, whatever is a relevant accounting standard, you will measure it at that only. Subsequently, at every reporting period, you will remeasure your hedged item. You will remeasure your hedged item, and any fair value fluctuations will go to P&L. Oh my God, yes, you will remeasure it, guys. See, it is here hedge accounting, fair value hedge accounting will override. Hedge accounting will override your accounting treatment of normal IFRS and IAS. So you will have to remeasure your hedged item also, and any gain and losses will also be recognized. It will go to P&L. Derivative gain and loss, whatever is your hedging instrument, any derivative gain and loss will go to P&L. So both goes to P&L. Therefore, accounting mismatch is reduced. Now, hedged item adjustment. Very important rule. I told you all this is a very important rule. Okay. adjust the carrying amount of hedged item. You will always adjust the carrying amount of your hedged item. Change in fair value is attributable to the adjusted risk. Even if an item is normally measured at amortized cost or IS2, whatever it is, still you will adjust it. Now, fair value hedge equity instrument. If your hedged item is your equity instrument measured at fair value through other comprehensive income, then fair value through other comprehensive income, OCI changes are never recycled. Therefore, it will go to your OCI. I mean, even this here also, here your fair value changes will go to your OCI. Okay. Now we go to cash flow hedge. We will go to what? Cash flow hedge. What is a cash flow hedge? Here, what is the hedge exposed to? What are we exposed to? We are exposed to variability in our future cash flows. So what is the objective? To protect future cash flows from volatility. Initial measurement, here you will initially remeasure your derivative. Hedged item initially either it is recognized or not recognized. So important point, cash flow is usually used for your forecast transaction. Subsequent measurement of your hedging instrument only. Subsequently, you are remeasuring your hedging instrument only. So any changes, fair value fluctuation, any effective portion will go to other comprehensive income and ineffective portion will go to OCI. So for example, there is a gain of 10 rupees in my hedging instrument. Okay, and there is a loss. Of course, there's a hedge, there has to go to the opposite direction. There is a loss of 8 in my hedged item. So in that case, what will happen, sir? The gain up till 8 in this case. Hedging instrument, we will recognize only hedging instrument. So gain up till 8 will be recognized in other comprehensive income, and extra 2, gain of 2 will be recognized in P&L. This 8 is effective because I was able to offset till 8. Extra, whatever is extra, that will go to P&L. So effective portion, it means what? It is stored in cash flow hedge reserve under OCI. And effective versus ineffective. Effective means any offset achieved successfully, OCI. Ineffective, excess mismatch will go to P&L. So for example, there's a derivative gain of 10 lakh. There is a effective means what? In your hedging instrument, in your hedged item, there is a loss of 8 lakh. So 8 lakh gain is your effective. Up till 8 lakh your gain is effective, 2 lakh is your ineffective gain. So this goes to OCI and this goes to P&L. So 8 lakh goes to OCI, 2 lakh goes to P&L. Okay. Now recycling of other comprehensive income. When hedged item affects a P&L, when it is an item that affects a P&L, then any item in your OCI will be transferred. Any balance in my cash flow hedge reserve will be transferred to P&L. It will be reclassified to P&L. But if your hedge item is for non-financial asset or a liability, it is a non-financial asset or a liability, then OCI may be whatever is the balance in my OCI, we will adjust to the carrying value. We will adjust the carrying value of our asset or a liability. For example, forecast and inventory purchase is hedged. We have a future inventory to be purchased. We have hedged that. So it will result in purchase of a non-financial asset. Then OCI will be added to the inventory cost. There's one question in BP material. I think second question, we can go through that. Very interesting. So that was our hedge accounting. That was a basic revision of our hedge accounting. Now we go to derecognition. When do you derecognize a financial asset or a financial liability? Okay. Derecognition of a financial asset or a financial liability. You derecognize a financial asset if rights have expired or you have transferred the asset. If the rights related to that asset has been expired or you have transferred that financial asset. So transfer of a risks and rewards. If risks and rewards have been transferred, you derecognize the financial asset. If risks and rewards have been retained, you continue to recognize the financial asset. So receivable sold without recourse, you derecognize. Receivable sold with a guarantee retained with recourse, then you continue recognizing. You do not derecognize your financial asset. Derecognition of a financial liability, guys. When do you derecognize a financial liability? You derecognize an obligation when it is discharged, or it is cancelled, or it has expired. Any difference goes to P&L. Now, so with this we complete our what we say. It did not. IFRS 9, I mean financial instruments revision. Just 1 minute. Okay, so now just last part that we are left to discuss with is your debt modification. If there's a modification in your debt instrument, debt liability, not debt instrument, debt, I mean liability. If there's a modification in your debt, then ma'am, how do we do the accounting of it if there is a modification? So understand guys, debt modification. Very simple, 2 minutes point discussion. Within 2 minutes, we should be able to complete this debt modification. If you have modified your debt, see, understand, you will calculate PV of new cash flows. You will compare two amounts. PV of new cash flows. Ma'am, what do you mean by PV of new cash flows? It means what? When you have modified, when you have, let's say, I was going through any financial difficulty. Okay. I went to the bank and I said, sir, I am not able to pay anything to you right now. Please modify my debt. Please modify my debt. So bank gave me maybe an extended period, or maybe it extended my period and it increased my interest. So there will be a new cash outflow. So you will calculate present value of your new cash flows. Very, very important point over here, using original rate. You will calculate it using what? Original rate. You will also calculate PV of original cash flows. Okay. Now understand guys, if original cash flows, it is basically nothing but your carrying value of your liability. It is nothing but carrying value of your liability. So understand guys, if the difference between these two is more than or equal to 10%, if it is more than or equal to 10%, the liability has been substantially modified. You will derecognize your original liability. You will derecognize original liability and you will recognize new liability. Okay, understood now. But if the difference between these two is less than 10%, if it is less than 10%, then you will apply what? Modification accounting. Modification accounting means what? The difference between these two will be charged to P&L. That's it. Very, very simple. So that was all about our modification accounting. Okay. Now we quickly revise our IFRS 16, that is leases. Very, very simple, very easy chapter. Very the probability of this being tested is again very high, because again, one of the examiner's favorite. So ma'am, what is the mind map here? Identification, lease identification. You will identify what is a ROU asset. I mean, not whether it is a lease or not. Okay. So identified asset, control of use. Then there are some exemptions. Then lessee accounting, we know lessee accounting, initial measurement at ROU asset and a lease liability. How do you calculate lease liability? How do you calculate ROU asset? Subsequent measurement. Then we'll talk about variable lease payment, lease term reassessment and presentation. Then we'll go to finance, lesser accounting. Lesser accounting, there will be a finance lease or operating lease. So what is the difference between these two? How the accounting will vary. Then we'll go to sublease, and then the last part and everyone's favorite, sale and lease back. Then lease modifications. Okay, now let's understand what is a lease identification. When do you say that IFRS 16 is applicable? See, IFRS 16 is applicable only and only when there is an identified asset. Only and only when there is an identified asset. A lease exists only if there is an identified asset. Only if there is an identified asset. So asset may be explicitly specified. I may say that phone with the value this, I mean batch number this, or whatever is a number, identifiable. Or implicitly stated. Implicitly stated means what? I may implicitly say that I will give my phone on rent to Dakshineshwar sir. It is implied. I have only one phone and I will give it on rent to Dakshineshwar sir. So if it is explicitly stated means what? I have mentioned which phone and which asset. Implicitly stated means what? Surbhi has only one asset and you know only that asset has leased. So no identified if supplier has no identified asset, if supplier has what? Substantive substitution right, SSR. You remember SSR discussion, substantive substitution right. If supplier has SSR, it means what? It can substitute the asset in future if needed, if beneficial. Then there is no identified asset. So for example, a specific warehouse mentioned in the contract, it is an identified asset. Now, Non-lease, a supplier can replace a truck anytime. I have so many trucks and I can replace it anytime. Then it is not an identified asset. There is no lease. Now, second, first we understood there has to be an identified asset. Second, there has to be control of use. The lessor. There are two parties here, lessor and lessee. First, there has to be an identified asset. Then lessee should be able to control the use of the asset. If lessee is able to control the use of an asset, then we say there is a lease. So customer must obtain substantially all of the economic benefit from the use of that asset, from the direct use of that asset. For example, customer decides how machine will be used, what will be the production timing, and what will be the output level. Then there is a control exists. Then we say that there is a lease. What are the exemptions, guys? Here there are two exemptions. You can skip applying IFRS 16 if your asset falls within these two. If your lease term or if your lease transaction is within these two. First, if it is a short-term lease. Short-term lease means what? It is less than 12 months, less than or equal to 12 months. Whatever is expenditure, you will expense it to P&L immediately. Low value asset. If your asset is a low value asset, small asset, you will expense it to P&L. Okay. Now understand, low value asset, there is one special point over here. There's one special point. If it is a low value asset, you will see the value, first hand value. Okay. First hand value. Ma'am, what do you mean by first hand value? See, I have this asset. This may cost 50,000. Okay, 50,000 may not be a low value asset. But second hand, it may cost me just 10,000 only. So 10,000, second hand value, 10,000 is a low value asset. But the standard says no. You will not apply low value exemption if you purchase it on a first hand. Okay. If you purchase this asset on a first hand, it would cost you 50,000 rupees. Then it is not a low value asset. Second hand value is not considered. The first hand value is considered. So example of a low value asset, laptop, tablet, or office chairs are your, small assets. Now, lessee accounting. Lessee, very simple accounting. This was there in our financial reporting as well. Lessee accounting, initial measurement. Lessee will recognize a lease liability, initial measurement, present value of future lease payment. You will recognize that a PV of future lease payment. What is included in my lease payment? Fixed payment, any RVG, residual value guarantee, any purchase option price, or any termination penalties. All of this is included in my, when I'm calculating the PV of my future lease payments, all of this will be included. Discount rate. What is the discount rate that I'm going to use over here? Implicit interest rate. If it is there, if I can identify rate implicit in the lease, I will use that. Or if I cannot identify, I will use incremental borrowing rate of a lessee. I will use incremental borrowing rate of lessee. So, ma'am, what is the meaning of incremental borrowing rate? The rate at which lessee would, the rate at which lessee will get the similar borrowings. So, for example, annual rent is of 10 lakh for 5 years. So, present value is 4,20,000. So, your lease liability will be 4,20,000. Next, we go to ROU asset. What is my ROU asset? How do you calculate ROU asset? Initially, PV of your lease liability, initial measurement of your lease liability, initial direct cost, any restoration cost, any prepaid lease payment, and lease incentives. So all of this will be included. This will be included in calculating of your lease ROU asset. So for example, lease liability is 4,20,000, initial direct cost 20,000. So ROU asset will be 4,40,000. So this is how we are going to do it. So what is the journal entry we are going to pass over here? ROU asset 4,40,000, lease liability 4,20,000, and cash of 20,000. Subsequent measurement, lease liability will increase by your interest expenditure and will decrease by any lease payments made. So lease liability subsequently it will increase by interest expenditure and decrease by lease payment. So for example, opening liability, you will add interest cost, you will less lease repayment. This will give you your closing lease liability. Now, ROU asset will be depreciated over useful life of the asset or lease term, whichever is shorter unless the ownership transfers. So, ma'am, what do you mean by unless ownership transfers? See, if there is an option given for ownership transfer from lessor to lessee, in that case, you will measure it using you will depreciate over the useful life. Otherwise, you will depreciate it over the lease term, whichever is shorter, whichever is shorter. So, for example, ROU asset is 4,40,000, lease term is 5 years. So you will depreciate it over, lease term. Now depreciation will go to your which category? Operating category of your P&L, and finance cost will go to your financing category of your P&L. Now, under IFRS 16, rent exception expense disappear. We know this already, because we no longer recognize a rent expenditure, even though it is a rent only, but we do not recognize it. It is replaced by depreciation and finance cost. Now we go to variable lease payment. Ma'am, what do you mean by variable lease payment? Okay, what is the meaning of variable lease payment, guys? What is the meaning of variable lease payment? It is any payment that is linked to CPI or index. It is included in liability. Any variable payment linked to sales or performance, that will not be included in my lease liability. So for example, 5% of sales payable as a lease rent expense when incurred, you will not include this in your, or anything related to the market will not be included. Okay. Now, lease term. Lease term includes what? Extension option if exercised, and termination option not exercised. And what do you mean by this? So for example, my normal lease term is 5 years. I have an option to extend by my lease term by 3 years. So here my lease term will be, and I'm likely going to exercise it, so my lease term will be 5 years plus 3 years. Termination option not exercised. I have an option to terminate my lease and I'm not going to exercise it. That will also be included in my lease term. Now reassessment. Ma'am, what do you mean by reassessment? You will remeasure the lease liability when lease term changes, or the option is exercised, or payments changes. So adjustment is usually made to what? ROU asset. Adjustment is usually made to your ROU asset. So presentation, ROU asset in your balance sheet will be shown as a non-current asset. Lease liability, non-current plus current liability, we will show it. Now in my cash flow statement, principal amount will go under financing, and interest paid will go to operating or financing depending on the nature of business. Lesser accounting. Now we go to the lesser accounting. Very, very simple and very interesting discussion. We know lesser can account for a lease using two methods. Okay, I mean, you will have to identify, not using two methods, these are not options given. You will have to identify what lease it is, whether it is a finance lease or it is an operating lease. So ma'am, what do you mean by finance lease? Substantially all the risks and rewards have been transferred. So what are the indicators of finance lease? Ownership transfers, lessee gets the asset. Bargain option, you have an option to purchase the asset at a cheap price. Major life of the asset has been used. PV is equals to fair value. And specialized asset, only lessee can use. So these are the indicators of your finance lease. These are the indicators of your finance lease. So what is the accounting treatment over here? You will derecognize the asset. You will derecognize the asset. You will recognize a net investment in lease. And you will recognize finance income. You will spread it using the effective interest rate. So for example, asset fair value is 10 lakh. Lessor will remove the PPE and will record a receivable. You will derecognize the asset and you will recognize net investment in lease. Operating lease, it is nothing but risks and rewards have been retained by the lessor. Under operating risks and rewards have been retained by the lessor. So you will you will not derecognize the asset. So asset will remain in the book. Depreciation will continue and lease income will be recognized on SLM basis. So for example, a 2-year building is leased out for 40 years. It is an operating lease because the useful life is 40 years and you have leased it out only for 2 years. It is an operating lease. Now finance lease versus operating lease. See, risks and rewards in finance lease have been transferred. Here we do not transfer the risks and rewards. Asset shown by lessee. Here the asset will be shown by the lessee because lessee will recognize the asset and lessor will, in operating lease, lessor will continue to recognize the asset. Lessor will record a receivable and here lessor will continue to record the PP. Income, finance income, here it will be a rental income. A simple classification. Now ma'am, what is the meaning of sublease? Sublease is nothing but here I have, let's say, I'll explain this to you all. Sublease. Very simple. In 2 minutes, we can finish this sublease accounting discussion. This is Surbhi. Okay, Surbhi has given an asset on rent to, let's say, Mr. A. So here, Surbhi is what? Surbhi is what? Can I say Surbhi is a head lessor? Okay, first transaction, our first transaction. Surbhi is a lessor and Mr. A is a lessee. Now what happens? Mr. A subleases this asset to Mr. B. So this transaction between Surbi and Mr. A, is what? Head lease. Okay, this transaction between Mr. A and Mr. B is called what? Sublease. Okay. So ma'am, here we are okay with Surbi's accounting. We are very clear with Surbi's accounting, lesser accounting. Surbi will apply lesser accounting. Surbi will check whether it is a finance lease or an operating lease. If it is a finance lease, Surbi will derecognize the asset and will recognize net investment and lease. And if the risks and rewards have not been transferred, Surbi will continue to recognize the asset and will recognize rental income. We are also okay with Mr. B. We are also okay with Mr. B's accounting. Okay, because Mr. B is nothing but a lessee, simple lessee. So Mr. B does not have any option. He will have to do what? He will have to recognize ROU asset. He will have to recognize lease liability. But madam, we are a little bit confused about Mr. A accounting. And what do you mean by ma'am, how are we confused here? Mr. A is a lessee in one transaction and Mr. B A is a lessor in one transaction. So see, here Mr. A will continue to recognize, first step, Mr. A will continue to recognize lease liability. Okay, lease liability. Ma'am, what do you mean by he will continue to recognize lease liability? See, understand, in one case, in one situation, he is a lessee. Okay, he owes me some money, guys, so he cannot understate his liability. He will continue to recognize lease liability. The accounting treatment of lease liability in his books will remain as it is. Okay, so what about ROU asset? Now ROU asset, depending on if risks and rewards relating to ROU asset, okay, not the underlying asset, relating to ROU asset, if risks and rewards relating to ROU asset have been transferred by Mr. A from Mr. A to Mr. B, then derecognize. It is a finance lease. This sublease is a finance lease. You derecognize the asset and you recognize net investment lease. But ma'am, if risks and rewards relating to ROU assets have not been transferred by Mr. A to Mr. B, then it is merely an operating lease. You will continue to recognize your lease. Okay, you will continue to, not lease, you will continue to recognize your ROU asset. Okay, so for example, if head lease is for 10 years and sublease is for 9 years, then most ROU asset life has been transferred, then it is a finance sublease. You will derecognize ROU asset. Okay, so students will incorrectly use underlying asset life. So here this is a trap. Okay, trap. I have seen a lot of students falling into this trap. You will continue to use it as your underlying, you will recognize it, you will measure it using your underlying asset. Now we go to the next part, that is a lease modification. When do you treat it as a separate lease if both the conditions are met? The scope has increased and consideration has increased proportionately. You will treat it as a separate lease. For example, additional floor leased at a market lease is a separate lease. Non-separate lease, you will remeasure a liability, depends on lease type, and any adjustment is there to will be adjusted to your ROU asset. Now the last part of your sale and leaseback. Sale and leaseback, you remember your IFRS 16 and IFRS 15 combination. So it is based on both IFRS 15 and IFRS 16. Now, what is the meaning of sale and leaseback, guys? A company sells an asset but leases it back. I sold an asset to you. Let's say I sold an asset to Dakshineshwar sir and I leased it back. So here, understand, there are two parties. Seller and buyer. So can I say I am Surbi? Okay, yeah, of course I am Surbi, and this is Dakshineshwar sir. Okay, now Surbi has sold an asset to Dakshineshwar sir. Let's say I sold this phone to Dakshineshwar sir, and I immediately leased it back from Dakshineshwar sir. So can I say in this transaction, Surbi is a seller lessee. Surbi is what? Seller lessee. And Dakshineshwar sir is buyer lessor. Dakshineshwar sir is what? Buyer lessor. So it is a sale and leaseback transaction. So it gets the cash. The seller, Surbi, will get the cash, but it will continue to use the asset. So first and the most important question is, has the control transferred? Has the control transferred from Surbhi to Dakshineshwar sir? If the answer is yes, it is a sale. If the answer is no, it is not a sale. It is merely a loan. Okay. So we are only concerned with this part. If it is a sale. See, if it is a sale, then it is a sale and leaseback. Okay, understanding my point. If it is not a sale, then it is merely a financing arrangement. It is merely a loan. Okay, ma'am. So we conclude that transfer is a sale. The transfer is a sale. Then, ma'am, what do we do? Transfer is a sale. It means what? Surbhi has sold a part of this phone to Dakshineshwar sir and she has leased it back. So, ma'am, it means what? Surbhi will have to derecognize the asset. Yes, Surbhi will have to derecognize the asset. So if the transfer is a sale, you will derecognize the asset. Okay. Now you have leased it back. So first point we are okay, ma'am. We have sold it. So I will derecognize the asset. But I have also leased it back. Then I will recognize ROU asset. Ma'am, how do you recognize ROU asset? The formula is very simple. Carrying amount of your asset, whatever is the carrying amount, multiplied by PV of lease, divide by fair value. Mind you, guys, here you all will make a mistake. I'm telling you, this is a mistake I made. I'm sure you all will make a mistake. You will divide it using selling price. Please don't make that mistake. I know you all will do this. I have been through this. I have seen a lot of people making this mistake. So please don't do this. Do not divide it using selling price. Divide it using fair value. There may be a possibility. I mean, there will definitely be a possibility that your selling price is different than the fair value. So you will divide it by what? Fair value. Okay. Now it represents what? This represents what? It represents the rights that has been retained by Surbhi. It represents rights retained by Surbhi. You will recognize a lease liability, PV of future lease payment. Whatever is the PV of my future lease payment, that will be my lease liability. Okay, ma'am. Recognize gain and loss partial only. You will recognize partial gain and loss only. So what is the 3-step rule? Total gain. First you will calculate the total gain. What is the total gain? Fair value, fair value, fair value. Do not compare it. Do not reduce. Do not calculate your gain by selling price. Fair value minus carrying value. Retained gain. What is my retained gain? Total gain minus PV of, multiplied by PV of lease divided by fair value. This will give you your retained gain. And recognized gain will be the balancing figure. So for example, my total gain comes here 5 lakh. Okay, retained gain comes here 2 lakh. So here, what is the amount of gain I will recognize? I will recognize the gain on the asset transferred. So what is the gain on asset transferred? 3 lakh. The balancing figure will be recognized in my P&L. Only gain on rights transferred will be recognized. So presentation. Asset operating category, if it is your operating asset, it will be recognized in operating. If it is your investment asset, it will be your investing section. You cannot recognize the profit for the assets you shall use. Now second, if it is not a sale. Ma'am, what if the transaction is not a sale? You said it is at the first point only. You said we will have to check first thing whether it is a sale or it is not a sale. So if it is not a sale, guys, if it is not a sale, then asset will be you will continue to recognize the asset in your balance sheet. Cash received will be a financial liability. ROU asset will not be recognized and lease liability will not be recognized. This is simply a financing arrangement. Bank account debit to financial liability. That's as simple as that. So bank account debit to financial liability. It is not a sale. It is a loan in disguise. Now, some important SBR level discussion, special cases where your selling price is not equal to fair value. I told you all will make a mistake. Selling price. You will divide it by selling price. You will calculate the gain by selling price. Please don't make this mistake. Please make me proud. Don't make this mistake. So first situation, your selling price is less than the fair value. The selling price is less than the fair value. It means what? The difference is nothing but your prepaid lease. So for example, my selling price is 9 lakh, but my fair value is 10 lakh. So here, this difference of 1 lakh is nothing but my prepaid lease. I will add it to the ROU asset. I will add it to my ROU asset. If selling price is greater than my fair value, it means what? I've sold it for 10 lakh, but fair value of this is 9 lakh. So here my selling price is greater than my fair value. This difference is nothing but my additional financing. This is nothing but financial liability. This will be treated as my financial liability. So asset removed, yes. If it is a sale, asset is removed, yes. If it is not a sale, asset is not removed. ROU asset, yes. If it is not a sale, no ROU asset. Liability, yes. Here it is a financial liability. Gain, partial. Here no gain will recognize because it is not a sale, no gain. So price difference, if it is a low price, prepaid lease. If it is a high price, it is a financial liability. You will add ROU asset here. You will add, increase your liability. So with this, we finish our ROU as we finish our lease liability accounting treatment also. So I will now start with your IAS 19. Okay, so now we'll cover our IAS 19 last discussion. I mean, today I'll be able to cover this much only, IAS 19 discussion. Tomorrow we'll do group accounting completely and we'll solve some questions. Okay, so I'll try to cover maximum syllabus in these 2 days. So what is the meaning of IAS 19, guys? What did we learn in this? This is important, and I feel a lot of you all find it difficult. So I've picked up the difficult chapters and the most important chapters from your SBR perspective. So what is IAS 19? Here we are going to learn employee benefits, accounting of employee benefits. What are the types of accounting benefits? Employee benefit that we learned: short-term employee benefit, then defined contribution plans, then if you remember, defined benefit plan, then defined benefit working notes that I'm going to teach you all, then other long-term benefits, termination benefit, presentation and disclosure, and some exam focus area. These are the points. With this, we'll cover about this whole IAS 19 discussion. So introduction to IAS 19. What is the objective here? What is the objective of the standard? To prescribe accounting treatment for your employee benefits. So here you recognize a liability when employee provides service and you expense it when the benefit is consumed. So for example, my salary expenditure. So till the time I am teaching over here, till the time I'm providing services to the organization till the time it has not paid to me, it will recognize a liability and debit expenditure, debit employee benefit expenditure to liability. Whenever the company will pay me, they will reverse the liability and they will credit back. So what are the types of employee benefit expenses that we are going to cover? Short term, so for your salaries and bonuses. Post-employment benefits, your pension plan. Now it can be of 2 types, your defined contribution plan and defined benefit plan. Then other long-term benefit, any long-term services, jubilee benefits and all of that. And any termination benefits means what? Redundancy benefit. When you're removing the employee from the organization, how are you going to treat it? So recognition. Employee provides service, you recognize the expenditure. Payment is due, you will recognize a liability. Simple accounting. Short-term employee benefits. Any short-term employee benefit expenditure means what? Benefit payable within 12 months after the reporting period. So what are the short-term benefit examples of short-term benefit? Salaries, wages, any paid leave, the accumulating and non-accumulating leaves, bonus, and any medical benefits. Now what is a recognition and measurement criteria? Not discounted. You will not discount it unless the amount expected undiscounted amount. Here, since it is payable within next 12 months, we are not going to do the discounting feature over here. We're just going to recognize whatever is the amount. So what is the journal entry over here? Very simple accounting treatment over here. Debit employee benefit expenditure, credit cash or credit cash or payable. So salary payable 5 lakh, the expense will be recognized immediately. Debit salary, credit cash or credit payable. Now accumulating paid absences. What is the meaning of accumulating paid absences? Employees accumulate their unused leaves. So there can be of 2 types. Accumulating, it means what? You can carry forward it to the next year. Non-accumulating, it means what? Unused leaves will lapse. So what are the examples of accumulating leaves? Your sick leaves, your casual leaves, and your earned leaves. All of these are the examples of your accumulating leaves. Accumulating leaves means what? If I do not utilize those leaves in the current year, I can carry forward it to the next year. Non-accumulating leaves means what? Unused leaves will lapse. For example, maternity leave. If I do not utilize my maternity leave in the current year, I cannot carry forward it to the next year. Are you getting me? Every organization gives 6 months of maternity leave. If I do not use that in the current year, I cannot carry forward it to the next year. Are you getting me? So if I do not use it in the current year, it will lapse. Next year, new leaves will be there. So recognize expenditure for future expected obligation. If I feel like my employee will will utilize the leaves in the next accounting period, I will recognize an expenditure. So for example, unused expected leave is 2 lakh. So what I'm going to do, I will credit I will debit employee benefit expenditure. I will credit leave liability. Now we go to the profit sharing or bonus plan. Ma'am, what do you mean by profit sharing or bonus plan? It is like if I have a right in the profit sharing of the organization, or if I have a bonus linked to the profit. So in this case, I will recognize a liability only and only if there is a present obligation, IS 37, and amount can be measured reliably. So bonus based on current year's profit, recognize expenditure during the current year. Now what are the journal entries? Debit, employee benefit expenditure, credit, cash or payable. So whenever you pay it, whenever you create a liability, bonus provision, debit employee benefit expenditure, credit bonus liability. So whenever you pay it, what do? You debit your payables and you credit your bank, cash or bank. Very simple. Now, defined contribution plan. Ma'am, what is the meaning of defined contribution plan? Here, employer's obligation is limited to fixed contribution, no obligation to future shortfall. It means what? Here, I will only contribute to your fund. Let's say we have created a fund, I will only contribute. If in future that fund fails, my liability is not there. I'm no longer liable. It is your risk. So, for example, employer contributes 10% to the pension fund, then risk is borne by employee. If fund fails in future, you will bear the risk. Accounting treatment, very simple. Accounting, expense, contribution, payable. You will just recognize your expenditure. That's it. No headache here. There is no headache. Journal entry, debit, payable, pension expenditure, credit, cash or payable. So for example, contribution is of 10 lakh. Recognize 10 lakh as an expenditure. Here, there are no actuarial calculations because it is not our risk. It is a risk with the fund. Now journal entries. What is the journal entry you will pass? Debit pension expenditure, credit pension payable. Whenever you make the payment, you will credit the pension, debit the pension payable, and you will credit the cash. So DCP, what is the key feature of this? It is a fixed contribution. No future obligation, very simple accounting, no actuarial gain and losses. Now we go to the next very important discussion, the heart and the mind of this chapter or the standard, that is defined benefit plan. Defined benefit plan. Here employer promises specified retirement benefits. Okay. Employer bears the actuarial and investment risk. Whatever are the changes in actuarial assumptions, everything is borne by employer. So example, employee receives 50% of the final salary after retirement. It is your defined benefit plan. So defined benefit obligation means what? A present value of your future obligation owned to the employees, or not owned, owed to the employees. So measured using actuarial valuation. Actuaries will give us this value. So DBU is discounted using, we know this already, is discounted using present value. Then we have plan asset, any asset set aside to pay the employee benefits, to fund the employee benefits. So it can be pension funds and insurance policies. So net defined benefit liability and asset, how do you recognize it? DBU, fair value of your plan asset, defined benefit obligation, minus fair value of your plan asset will give you your net asset or a liability. For example, your DBO, defined benefit obligation is 100, your plan asset is 70. So you will recognize a net liability of 30. You can set off, you can offset it and recognize it. Components of defined benefit cost. What are the components of our defined benefit component? We have something called as current service cost. It will always be recognized in P&L. Which category? Operating category. Past service cost. Again, it will be recognized in which category of operating, which category of P&L? Operating category, past service. And net interest cost, again, it will go to P&L. Which category? Financing category. Now, actuarial gains and losses will go to your other comprehensive income. Return on plan asset, any gain on plan asset will again go to your other comprehensive income. These are what your actuarial measurements that will go to your other comprehensive income. Important rule, remeasure always OCI. Remeasurement benefits will always go to your OCI. So actuarial assumptions, what are the actuarial assumptions? It is the estimate used to measure your defined benefit obligation. So for example, salary growth, any life expectancy, employee turnover and discount rate, all of these. See, we as a normal person, you and I as a CA cannot make the assumption. It requires a lot of calculations and all. So actuaries do it, we just take their value, we just pick their value, we just have to rely on their value. So remeasurement includes what? Actuarial gain and losses, actual versus expected return. So it is always recognized in what? OCI, and it is never recycled to P&L. Now past service cost, ma'am, what do you mean by past service cost? It is and changes from plan amendment and improvement. So for example, employer improves the pension fund. It is a changes in your pension fund. It is treated as a past service cost. So what is the treatment? Just like your current service cost, you will recognize to your P&L immediately. Any curtailment and settlement. Curtailment means what? Reduction in employees. Settlement means what? Obligation has been settled. So here again, it will be recognized to P&L immediately. Now, defined benefit, some working notes will do. This is the most important area. I've highlighted it. I've put it so that you all can focus on those areas. So first, DBO movement working. Start with opening defined benefit obligation. Add current service cost. Add interest cost. Add any actuarial gain and losses. Add any past service cost and minus any benefits paid. This will give you your closing liability. So this will give you your opening benefit, opening liability and closing liability. Now, for example, my opening liability is 100. It will increase by current service cost. It will increase by interest cost. If there are any actuarial losses, it will increase by this. Let's say I paid benefits of 8. It will reduce by this. Now, my closing DBO will be 110. Now, plan asset movement. How do you do the plan asset? Opening fair value of your plan asset. You will increase it by contributions paid to the plan, increase it by interest income, increase it by any actuarial gain and minus by benefit paid. So this will give you your closing fair value of your plan asset. So for example, your opening asset is 70. It will increase by any contributions made to the plan. It will increase by any interest income. It will increase by any actuarial gains. And if you've paid the benefit, you will reduce your plan asset. This will give you your closing assets. Now, net liability, how do you recognize your net liability? Closing DBO, closing plan asset, this will give you your net liability. So your closing liability was 110, closing asset was 79, so you will recognize a net liability at 31. 110 minus 79, 31. OCI working notes. So how are we going to do the OCI working? Actuarial gains and losses and any loss on your obligation will be charged to OCI. Any gain, actuarial gain on plan asset will be credited to your OCI. Your net gain and loss will be shown in OCI. For example, your actuarial gain, actuarial loss was 3 in your obligation and you made a asset. You made a gain of 3 on your actuarial gain on your asset. So in your OCI, there will be nothing will be shown in your OCI. SOPL, your P&L movement, you will recognize a current service cost, you will recognize a past service cost, you will recognize a net interest cost. Ma'am, just let me change it something for you all here. Let's assume something like this. Let's assume here I have made an actuarial gain of 2 rupees in this case. So in this case, net OCI will be of how much? 1 million, whatever, 1 million or 1,000, whatever it is, 1. So net on net, here everything will be treated on net. This will be recognized. So ma'am, how do you calculate the net interest? Opening liability multiplied by the discount rate. Take the discount rate at the beginning of the year, guys. Interest rate, there is a very high possibility that the examiner may trick you. So always take rate at the beginning of the year. They may give you 2 rates, beginning and the closing. Don't take the closing rate. Okay. Now, other long-term employee benefit expenditure, any other long-term benefit, accounting is simple. Just as like your defined benefit plan, the accounting is just like that. Benefits not payable within next 12 months, it is your other this. So, for example, long service cost, any sabbatical leave, any deferred compensation. So, accounting treatment similar to defined benefit plan, but all the gains and losses, here it will go to P&L. Even actuarial gain and losses will go to your P&L. So OCI is not allowed here, no OCI, actuarial gain and losses will go to your P&L. So differences from DPP, remeasurement under defined benefit plan will go to other comprehensive income, here it will go to other long-term benefits, it will go to P&L. Complexity, of course we know defined benefit obligations are very highly complex, here less complex. Now ma'am, the last discussion for the day, termination benefit. Ma'am, what is the meaning of termination benefit? Benefits paid due to termination before retirement. So what are the examples here? Redundancy payment, any voluntary retirement schemes. So recognition criteria, when do you recognize it? When entity cannot withdraw the offer or recognizes the restructuring cost under IS 37. So if you cannot withdraw it, you will have to recognize the expenditure. Whatever are the termination benefit, you will have to recognize it. Measurement, if payable after 12 months, you will discount the obligation, you will recognize accordingly. So for example, a company announces a redundancy plan, recognize a liability immediately. Journal entries, debit termination expenditure, credit termination liability. Presentation and disclosure. SOPL, you will include current service cost, past service cost, and like this. We know this already. It is a small summary of your this. So what are the exam focus area that I want to discuss with you all? Exam focus area is this DBO movement, plan asset movement, this net liability movement, OCI and all. Please take care of this. There are some common adjustments that they will definitely ask you, very common. Current service cost, it will always go to P&L. Interest cost P&L, past service cost P&L, actuarial gain and losses, again it will go to OCI. Benefits paid, it will reduce both obligation and asset, and contribution will increase the asset. So this is something, this this adjustment, if you understand this table, your IS 19 is done. So we will be, if you understand this, IS 19 will be in your pocket. So with this, we complete our today's marathon session. That's what we planned. That's what I had planned for you all. I will see you all tomorrow. The target for tomorrow is to complete group accounting and discuss some questions on group accounting. If time permits, I will also discuss your IFRS 18, and I also want to discuss IFRS 2. If time permits, we will plan it accordingly. But the main focus is this. So in these 2 days, if you watch these 2 days and if you go through these notes and the questions that I discussed in the tomorrow session, if you diligently, honestly, with your whole heart, if you follow these 2 videos, trust me, you will be, if you study on your own, in these 3, we have spent like 3 hours and 30 minutes. 3 hours and 30 minutes, you cannot revise these big chapters, okay? So watch it whenever you have a time, whenever you have covered your, revision, whenever you are done revising on your own. Watch these videos and make the most of it, guys. I've planned it in a way that you cover within like 8 hours, so that you all can cover at least 80 to 90% of your syllabus. That was my target. That was my plan. So target for the day is, guys, I want to take some important standards today. First target would be to take IFRS 18. You all know IFRS 18 is one of the important standards. Just 1 minute. I'll just discuss the plan for the day. So IFRS 18 is what I want to discuss. Then I want to discuss with you all IFRS 2. And then I want to go with your basic group accounting. Then I want to discuss the small chapters of your group accounting, just like your joint arrangements, joint operations, then your this group cash flows. And then in the last 45 minutes of this class, I will discuss one sum with you all from your exam kit, Peony. There's one sum. Some of you all have you all reached out to me asking about discussing this sum. So I realized that few people were finding this difficult. So 45 minutes I will discuss this with you all. Now I will share these updated notes with you all, guys. The notes that I had shared with you all yesterday. These notes I've made some amendment. As you all know me, I keep on changing my notes. So I've made some changes in the notes. So you all can refer the updated one. I will share with you all after this marathon session. Yeah. And if at all you need anything else from me, feel free to reach out to me. I will try to record another videos for you all if I can. But if there's something like, one of your friends reached out to me asking about Peony, and 2 of them were finding it difficult. So I thought I will discuss this with you all. Anyways, I wanted to discuss pre-populated sheet with you all. So I will discuss this with you all. Now, let's start without wasting our time. Let's start. Okay, so let's discuss IFRS 18, one of the important chapters, and it has amendments, So this amendments itself make this chapter a very important. This chapter was introduced in the last September session from your, this amendment was introduced. Now, you all know, if you're watching this for the first time, or if you're trying to understand this chapter for the first time, this standard IFRS 18 has replaced IAS 1. IAS 1 got replaced by IFRS 18. We no longer have IFRS, just 1 minute. We no longer have IAS 1, IFRS 18 has replaced it. So ma'am, what were the changes being introduced by this chapter or by this standard? Why IAS 1 got replaced? Why, IFRS 18 becomes more important? Now, first thing that we need to understand is this chapter, this standard will be applicable from periods starting on or after 1st January 2027. This standard is not yet applicable. Okay, this will be applicable after this. Ma'am, can companies adopt this before 1st January 2027? The answer is yes. Early adoption is possible, but it is not yet applicable. So, ma'am, so right now all the financial statements that we see, the public financial statements available in public domain, we will not find P&L and balance sheet in this format. The answer is yes. The P&L and balance sheet has changed. Now, no longer, hi Dakshineshwar sir, how are you doing? So now you're new. Anyways, okay, now that you've joined, I was not sure if you all will join. So I will discuss the plan for the day, sir, with you. The plan for the day today is, I will discuss, sir, IFRS 18. I will discuss IFRS 2. I will discuss, sir, group accounting, the basic questions, the basics of your group accounting. I will discuss group cash flows with you, and the small chapters like joint arrangement, joint venture, all of that. And then last 45 minutes, before we wind up 45 minutes, I will discuss one exam kit sum with you. One of your friends had reached out to me discussing this sum. This is a second question of your consolidation, peony. Okay, so I will discuss this with I've prepared notes for you. Okay, and I have made amendments in these notes. Yesterday, the ones that I shared, there are some more changes that I made. So sir, I will share the revised notes with you because I've added question in this. In the last yesterday's notes, you did not have this question that I'm going to discuss today. So what I'll do is I will share these notes updated ones and you share it with your friends. Okay, works? Yeah, thank you. Okay, Dakshineshwar sir, we will start with our discussion. Now, first is IFRS 18 is what I want to discuss with you today. Why am I taking this? Why this is one of the discussions of marathon sessions? Just because, sir, this standard was newly introduced and this is not yet applicable. This standard will be applicable from period starting from on or after 1st of January 2027. Now, what has changed because of this standard? Your P&L has been completely revamped. Your P&L is completely changed because of introduction of this standard. So just like the new thing that I've added in my notes is this mind map. Okay, so you know what are the things that we need to learn, what are the things that we need to cover, what are the topics that we need to cover when we are learning this standard. So once you have this, I mean, not for this subject, make this as a habit for every subject. You should have an index for every chapter that you're studying, so that okay, if I am studying this, I know this area is my difficult area. Okay, this area is my strong area, so I should know like this. Okay, so let's understand what are the areas that we are going to cover. First, the basics that we are going to cover. Second, your revised categories of your P&L. Third, we will discuss each of this category, operating, investing, and financing in detail. Then there's something called as total and subtotals. What are my mandatory subtotals and all the other subtotals. Aggregation and disaggregation principles we are going to learn. Then analysis of operating expenses by nature, by function, one of the important areas. Now you can expect questions on this standard. This standard will affect a lot of your other standards. A lot of, if you remember, a lot of discussions when we have, I keep on asking you which category of P&L, which category of P&L. So this standard will actually affect a lot of your standards. Now, materiality and measurement uncertainty, even this affects a lot of your disclosure requirements. You would have seen a lot of questions. If you have started solving questions, you would know in some of the questions they mentioned, if it is material, it should be separately disclosed. So this standard actually affects. Then there's new thing called as MPMs. What are MPMs? How they are different. Then what is impact on our statement of cash flows, and some exam keywords that you all can use. So let's start with our IFRS 18. Now, what is the objective? It is a little bit theory, but very interesting. The reason why this standard is important, because the P&L, the presentation of my P&L is dependent on this standard. Now, what is the objectivity? Why the standard was introduced? Why IAS 1 was removed? To improve comparability. Now, you just simply give me a P&L, I will not understand. When I have a classification of where this income is coming from, what is the category of this income, the comparability increases. Transparency. Now, companies cannot merge different income and different names, other income and all of that. Now, it has made P&L more transparent. And consistency. Now, what are the main focus areas of this standard? What has changed because of this standard? First one is your SOPL structure. Your P&L has been completely changed. Subtotals, I told you all, now we have been introduced some mandatory subtotals, some MPM disclosures, and some aggregation and disaggregation principle. Now it applies to your general purpose financial statements. Now, what are the key changes from IS1 to IFRS 18? IS1, we had a very flexible P&L. I mean, just however you all like, you all can do it. But here we have some defined categories. There was no guidance on subtotals. What are the subtotals that companies should give? So every company used to give their own subtotals, but here we have mandatory subtotals. Your P&L should have these subtotals. Now, there was nothing called as MPM. Here we have some MPM disclosures. Now, you see, these are the 5 main categories of your P&L. These are the 5 main categories. What are the 5 main categories? First one is operating, investing, financing, income taxes, and discontinued operations. Ma'am, our P&L should follow this structure only. The answer is yes. It should start from operating. Second one will be your investing. Third, financing. Then income taxes and discontinued operation. You cannot shuffle your P&L structure. Now, revised categories. By default, we will first start with operating. By default, your default category is operating. So, ma'am, what do you mean by the default category is operating? See, the standard has defined operating as your income and expenses from your core business. But if anything does not fall under financing and investing, even that is operating. It means what? It is a residual category also. It is main category, I mean default category. If something doesn't specific, it is the standard is very specific about investing and financing categories. Okay, but operating, it has mentioned if it does not meet the definition of investing and financing, it will go to your operating category. So all income and expenditure, unless they go to investing, financing, taxes, and discontinued operation. If they are specifically going there, put it there. If they are not meeting that definition, please go to operating category. So what are the examples of operating items, ma'am? Revenue, cost of sale, admin expenditure, depreciation, and trade receivables impairment. So anything that does not fall under any other category will fall under this category. So as I told you all, it is a residual and a default category. Now, investing category, ma'am, what is the meaning of investing category? Returns from investments, generating returns independently. Here, this word is very, very important. Independent generation of returns. If any investment is able to generate returns on its own, okay, I need not do anything about it. So that will fall under this. For example, money. For example, your financial assets. I have purchased shares of Reliance Industries Limited. So they will be able to generate return on its own. I need not do anything. So that is why it will fall under this category. So what are the examples here? Investment property, because rental purpose and capital appreciation. So by default, it becomes here this category. Dividend income, fair value fluctuations on your investments, share of profits of associates and JVs. So these are some of the examples of my investing category. Now, financing category, it includes income and expenses from liabilities involving financing. So anything that involves financing will fall under this. See, it need not include only those financing categories. Not only those liabilities that sound like a loan. It also includes your lease liability. It also includes our lease liabilities. It also includes our provisions. Okay, so any income and expenditure on lease liabilities and provision will fall under this category. So what are the examples, ma'am? Your loan interest, bond interest, and lease liability interest. So if I have to generalize this, anything that has liability in its name will fall under this. Anything that behaves like liability, for example, provision, will fall under this category. Now, income taxes are presented separately, we know. your current tax and deferred tax. Discontinued operations presented separately as per IFRS 5. You remember yesterday's discussion, discontinued operation. After continued operation, you will show a separate line item of your discontinued operation, your post-tax profit. Now let's learn these categories in detail. I will spend some time because I want you all to score maximum marks in this. If this standard is being tested, we should secure our marks. So default category, anything not classified elsewhere will go to your operating category. So employee salaries, operating category, inventory write down, operating category. Now what are my operating assets and liabilities? Income and expenditure from trade receivables, inventory, trade payables are your operating category. Now understand one thing, main business activity. For me, generally, for normal business, trade receivables, inventory will fall under this operating category. But if my main business is something else, for example, my main business is to invest in investment properties. I'm a bank. I'm an insurance company. So here, my main business principle I will have to apply. So anything, if my main business is to give loans, I'm a bank. So then anything that would have otherwise been classified as investing category will now be classified as operating category. So if entity's main business activity is investing or financing the customer, the classification will change. For example, bank, interest income is operating, not financing. Okay, sorry, it should be investing. Interest income is always investing because providing of the finance is the main business activity. Now example, investment entity. I'm an investment entity. Investing income will be operating, not investing. Now, what falls under my investing category? Investments. The first one is investments in associates and joint ventures. So what is the separate presentation is required for? Share of associates profit and joint venture investing, share of JV profit and loss. So you remember, right after our operating profit, we will write share of profit and loss of associate or share of profit and loss of joint ventures, equity method. Now it is separate from your operating profit. Right after your operating profit, you will write. Now investment income. What is included in our investment income? Returns generated independently from main business operation. So for example, rental income from investment property, dividend income, interest from investments, all of this will go to your investing category. What are my non-operating assets, guys? Investment property, financial assets and passive investments. These are all my non-operating assets. Operating assets are what? Trade receivables and all. So separate presentation rules, you will have to joint associates and joint ventures will be split into equity accounted and non-equity accounted investments. Very, very important. See, if I am in my separate financial statements, if I have associates, investments in associates, joint ventures and unconsolidated subsidiary, if I am applying equity method, sir, if I am applying equity method of accounting to account them, then by default, blindly, whether my main business activity is to invest or not to invest, it does not matter. If I am following equity accounting, equity method of accounting, then investment in JV, associate and unconsolidated subsidiaries will go to which category? Investing category. Ma'am, my main business activity is to invest. Still, it will go to investing. It will not go to operating category. So see, here, if it is equity accounting, it will go to investing. If it is non-equity accounting, you have a choice. If it is a non-equity accounted investment, if you're not applying equity method of accounting for this, then you have a choice. Either you go to investing or you can go to operating. I mean, there's no choice. So for example, let me rephrase my word. If it is a non-equity accounted, then you will have to check whether my main business activity is to invest. If my main business activity is to invest, then it will go to operating. If my main business activity is not to invest, then it will go to investing category. Did I say right? Yes. My main business activity is not to invest. Now financing category. Financing liabilities. Now it includes what? Liabilities arising from raising of finance. For example, bank loan, debentures and bonds payable. Now interest, income and expenditure. Understand. If I have an interest expenditure, it will always go to financing. If I have interest income, it will go to investing categories. Now, financing to customers. If my main business activity, understand, if financing to the customer is a main business activity, then interest income and expenditure will be classified as operating. Okay, this is an exception that we know. Now, for example, a manufacturing company, interest classification is financing, but for a bank, it will be operating. Now, lease liabilities, we know it will always go to your financing categories. So understand these are small things that we need to remember. One thing that can bother you is equity accounted investments. So what are my equity accounted investments, sir? Your JV, associate, and unconsolidated subsidiary. Okay, now I will just split it so that we are okay with this. If I am applying what? Equity method of accounting, then it will always go to which category? Always investing. Non-equity. Now what do you mean by non-equity? Either it is cost or fair value model. So here, if non-equity, main business activity, here you will do the main business activity test. Main business activity test. Remember, what is a main business activity? If is main business activity to invest, if the answer is yes, it will go to which category? Operating. If the answer is no, it will go to which category? Investing category. Are we okay, sir? Is this okay? Tell me, are we on the same page? Yes. So this is the area that can bother you. Now, totals and subtotals, mandatory subtotals and subtotals. What are the mandatory subtotals? IFRS 18 has introduced some mandatory subtotals. These are the three mandatory subtotals. You can have any other subtotal. For example, you can have a gross profit, you can have net profit, anything else, but these are very, very important. You cannot skip your P&L. These subtotals cannot go away from your P&L. So what are those? Operating profit, profit before financing and tax, and profit before tax. These are some mandatory subtotals. Now, what is my operating profit? Simple, operating profit minus operating expenditure. So it is now mandatory. What is profit before financing and tax? You will take operating profit plus investing category, whatever are your investing category, income minus expenditure. So it is before financing and taxes. Now, profit before tax will include what? Operating, investing plus financing. So three, first simple operating, then second operating plus investing, then third operating plus investing plus financing. This is your before tax. Now, aggregation and disaggregation principles. What are my aggregation and disaggregation principle? Group items sharing similar activities. So if it is similar, you aggregate them. If it is not similar, you disaggregate them. So similar admin expenditure, aggregate together. Similar inventory items, aggregate together. For example, I have a lot of laptops. Let's say ArivuPro Academy has a lot of laptops. So I will aggregate them. Disaggregation principle, separate material items with different characteristics. If your items are sharing different characteristics, they are not similar, you separate them. So separate disclosure is required for this restructuring cost and impairment losses. Now, material information, very important. If information is material, when do you say information is material? If omission and misstatement affects the decision of the users of financial statement, the information becomes material. Now here, entity specific judgment is required. Something can be material for a normal tea shop owner, that might be immaterial for Mukesh Ambani. So for example, I lost 5,000 rupees. It is very material for me. 5,000 is very important. But for Mukesh Ambani, 5,000 might not be that important. So it is specific. 10 lakh loss may be material for a small company, immaterial for a large company. So entity specific quantification, and this is very required. Group, using grouping, you will disaggregate. How do we apply disaggregation principle? By nature, by function, or by measurement basis. avoid, this is very important, avoid excessive aggregation. Excessive aggregation means what, ma'am? Do not aggregate unnecessarily to hide any of the important information. Now, analysis of operating expenditure, you can apply by nature and by function. Ma'am, what do you mean by nature? Expense grouped by nature. What is the nature? For example, depreciation is my nature, the nature of expenditure. Salary is the nature of expenditure. Okay. So salaries, depreciation is a nature. Function means what? Grouped by function. What is a function in the organization that you are operating? So for example, cost of sale, distribution expenditure, admin expenditure. For example, if you talk about ArivuPro Academy, we can have multiple expenditure like marketing, we can have teaching, we can have sales. All of these are what? Different functions within the organization. Now, if you are following function by function method, if you are applying function method, then you must disclose these examples by these expenses by nature. Very, very important. Okay, so ma'am, if I am following what? Let's imagine ArivuPro Academy is disclosing their expenditure by function. So if you are disclosing your expenditure by function, then depreciation will be hidden in some. So depreciation will go under cost of sales, and impairment losses will be hidden. All of this will go under cost of sales. Yes or no? So in that case, the standard says these are some mandatory disclosures that you will have to give: depreciation, amortization, employee benefit, impairment losses, and there is one more I forgot to mention over here. You all please update this in your notes. Okay, I will myself update it and share it with you all. There's one more, that is your inventory write-off. Inventory write-off. These are the 5 expenditure for which we require mandatory disclosures. Now, what are the important rules? Functions require supplementary nature disclosure. This you all remember for your examination. Now, materiality and measurement uncertainty. Ma'am, what do you mean by materiality and measurement uncertainty? If any information is material, if anything, any information that can influence the decisions of user, then it becomes automatically material. Now, it depends on what? It depends on size, nature, and circumstances. Now, entity-specific materiality. Ma'am, what do you mean by entity-specific materiality? Materiality is specified by entity. See, I cannot generalize 5% of revenue is material. Ma'am, why you cannot generalize? See, my revenue, let's say I am Surbi Private Limited. I'm running a coaching institute. My revenue is 1 lakh per month. My revenue is only 1 lakh per month. But, so 5% of this will be material for me. 5% of this will come to how much? 5,000. 5,000 will be material for me. But let's imagine Reliance Industries Limited. They have 2,000 crore of annual revenue. Okay. Now, for them, 5,000 will not be material. So we cannot generalize. We cannot have a benchmark also. Okay. It depends on entity to entity. There is no fixed percentage. Now, what is measurement uncertainty? It occurs when estimates cannot be measured precisely. There may be for example, if I have somebody has sued me, if I have a legal claim, if I cannot measure it with certainty, then this will come into picture, measurement uncertainty. So what are the areas where this will be applicable? Your fair values, provisions, and ECL. You all know that we cannot measure them with precisely. I mean, how do I measure? When I'm measuring, let me give you an example. I am measuring my 12-month ECL or lifetime ECL. How do I precisely measure? How do I measure it with accuracy that this much loss will only be there, or only this much of provision should be made for a legal claim? I cannot measure it, right? So these are the areas where I cannot measure the estimates accurately. So here, if there are some items that have measurement uncertainty, I will have to disclose what are the assumptions that are used, what are the estimations method, and what is the uncertainty source. For example, impairment testing assumptions should be disclosed. Now, MPMs, what are management defined performance measures? See, these are subtotals. Understand, first word is subtotal. The keywords that you should use in your examination. The first one is subtotals. defined by management outside IFRS requirement. Okay. So ma'am, we know operating profit is a mandatory subtotal required by IFRS 18. Profit before tax is a mandatory subtotal. So it means this will not include these three mandatory subtotals. Yes, the answer is yes, because those three are already defined by your IFRS. It is used in public communication. Okay, ma'am. It means it is not used in IFRS, your financial statements. The answer is yes. So first thing, it has to be a subtotal. And it should be outside of your IFRS requirement. I mean, not your operating profit, not your profit before tax, not your profit before financing and income tax. Okay. So it means subtotal outside of IFRS requirement and used in public communication. Now, what are the examples? Adjusted EBITDA, adjusted operating profit, core earning. Now, one important keyword that you need to remember over here is MPM. Sorry. What is wrong? MPM is always a subtotal of income and expenses. So ma'am, purely income subtotal is not my MPM. The answer is yes. Purely expenditure subtotal is not my MPM. The answer is yes. So it has to be a income and expenditure subtotal. So ma'am, it means what? If I'm giving GP ratio, if I am giving any current ratio, so it is not my MPM. The answer is yes, it is not your MPM. Why? Because it is not a subtotal of your income and expenditure. So what are the main characteristics? It should be specified. It should not be specified by IFRS requirement and communicate management's view. Why management feels, for example, adjusted profit and all of that. So what are the disclosure requirements? Entities must disclose why this measure is useful. So if entity has given any adjusted profit, the entity must disclose why this is useful, how it is calculated, and reconcile it to IFRS subtotal. You will have to reconcile it to IFRS subtotal, the nearest IFRS figure. So for example, I have given adjusted EBITDA. So I will take operating profit, I will add back depreciation, I will add restructuring, adjusted EBITDA. So here I will have to give a reconciliation impact. Now tax and NCI effect. Disclose your tax impact. What is your impact on NCI if it is in your group financial statements for each reconciling item. Now transparency is required to avoid misleading. We know this. Now statement of cash flows. IFRS 18 aligns with your SOPL category, but understand one thing here in your this investing category. One thing is this one update over here. In your, as per your IS 7, cash flow from disposal of PPE will go to which category? Investing category, but that's not the case in your IFRS 18. That's the one thing that you need to remember. So these are some areas. What are the common mistakes you all can make? Check the main business activity. Check, is it mandatory operating profit and all requirement, confusing nature and function. So separate approaches are there. Excessive aggregation. The question may ask you about excessive aggregation, treating MPN and IFRS subtotals. So they are management defined. So these are the areas that you all can probably, get confused and goof up. So don't do that. Okay. So with this, we finished this. Now, you all know if your second question, this one person called Hustle. Hi Hustle sir and ma'am. May I know who you are? May I know if you are Hustle? Oh. Why would you change your name as Hustle, ma'am? Tejaswani, ma'am. Just came to check how is it all going? It's all going great, ma'am. Oh, okay. Hustle. Nice. Now let's have a discussion. When I think let's take it towards the end. Let's go to your this basic group accounting. I was confused. Who is Hustle? I have no student named Hustle. So we just did IFRS 18, ma'am. If you want to, Tejaswini ma'am, if you wish to watch for peony recording, if you want to do that, I will pick that up at 1:15, ma'am. So if you wish to just come for that, 1:15, I will pick. Last 45 minutes will be solely dedicated to that peony question. I realized it is an important question. So I'll do one thing. I'll text you before discussing that question. You can ask your friends also to join. So all your doubts will be taken at that point. 1:15, because 45 minutes I will need to discuss that question. So around 1:15 I will pick this up. So drop a text to your friends also if at all they wish to join. Amal ma'am, I think she had a doubt in that, no? So ask her if she wishes to join, and Anas sir and all, if you're in touch with any one of those, just let them also know. So you can you can watch the recorded one, because your time is very, very important. I'll drop your text. Either I'll do or Dakshineshwar sir do if he's joining. Okay, just 1 minute. We start with group accounting, basic group. First we'll do basic group. Okay. Now what is group accounting, sir? Introduction to group accounting. Sorry, I have this habit of asking the question. I forgot that we are having a revision session. So group accounting. So I've kept it like very basic. When you're just reading these notes, you should be done one day before exam. So parent, who is a parent? The parent is an entity that is controlling the another entity. Okay. Subsidiary, who is subsidiary? Entity that is controlled by parent. What is the meaning of associate? Who is associate? Who is associate? Any entity over which investor has significant influence but not control. If I can influence you but I cannot control you, then it is my associate. Now what is the definition of control? What is the meaning of control? Control exists if you have these three conditions. Okay, these are the three important conditions. Very, very important, sir. If you are solving a case study on control, please do not forget to write this. Do not forget to write this. A case study should include this. If I am, let's say the question has asked me if it is a parent or subsidiary relationship or not, then my answer should have these three areas. Okay. So what are the three areas? What are the three conditions? First, power over investee, exposure to variable returns, and ability to affect those returns. I should have power over investee, I should be exposed to variable returns, and I should have ability to affect those returns. If these three conditions meet, then I can say that there is in that case, I can say that the entity is being controlled by another entity, that I have a control over another entity. So generally with 50% of the voting rights, it is assumed, okay, if I have 50 or more than 50%, it is assumed that I have a control. Okay, but if I can rebut this assumption, then I can. Ma'am, what do you mean by rebut this assumption? What I mean by this is, sir, I assume every entity will assume that if I have more than 50% stake in any company, I will have a control. But even with more than 50% stake, if I don't have these, I don't have power over investee, I am not exposed to the variable return, or if I don't have ability to affect those returns, then I need not consolidate. So ma'am, you mean to say that if even with more than 50% stake, I need not do the consolidation? The answer is yes. The consolidation requirement is control. Okay, this is an assumption. Okay. Now, ma'am, even with less than 50% stake, I can do the consolidation if these requirements are met? The answer is yes. So this is a very, the basic clarity that you should have, that if I can prove it that even with less than 50% stake, I have a control over another entity, then I will have to consolidate. If I can prove that even with more than 50% stake, I am not able to control the another entity, I need not consolidate. Now, significant influence. What is the meaning of significant influencer? Here, I should have a power to participate in financial decisions. I should have power to participate in operating decisions, but I cannot control it. But I cannot control the another entity. So generally with 20 to 50% of the holding, we say that we have a significant influence. If it is more than 20, we say we have a significant influence. Now, what are the indicators? What are the indicators? Board representation. These are the indicators. One of my directors is representing in your board. I have a participation in policy decisions. I have a right to participate in your policy making. There are material transactions between me and you, and interchange of management. My director is your CEO. So if there's an interchange of management, then we say what? There is a significant influence. These are some indicators. Now, non-controlling interest. Ma'am, what do you mean by non-controlling interest? Equity in subsidiary is not attributable to parent. Equity in subsidiary not attributable. So, ma'am, what do you mean by this? Say, for example, I'll go a little bit slow with this so that just this video, just 40 minutes that you spend with me should be enough for you to revise it. So, ma'am, for example, let's say I have 100% stake in Dakshineshwar sir. Okay, not 100%. This is Surbi and this is Dakshineshwar sir. Now I have 70% stake in you. So I told you with more than 50% stake, it is assumed that there's a control. So remaining 30% is our NCI. What is group structure? Group parent plus subsidiary is equals to group. Here in your consolidated financial statements, you will have to merge both the entities and present as a single economic entity. Now very, very, very important. These, just to go through these, the rest of the notes, your consolidation will be done. So what is a consolidation principle, guys? What is a consolidation principle? Assets, you will add 100%. Liabilities, add 100%. Income and expenditure, add 100%. Investment and subsidiary, eliminate. So this is my balance sheet structure. I will add all of this. So this is the basic consolidation principle. I will take all the assets, I will take all the liabilities of my subsidiary and add it. Just one thing, in parents individual financial statement, there will be an investment in subsidiary that has to be eliminated. Now equity, if I have to talk about equity, you all can add a line over here. Equity, tell me whose equity do we take? Whose equity do we take? Equity share capital. On consolidation, whose equity share capital do we take, sir? Do you remember by any chance? Or you've gotten? Yes, parent, solely parent, only parents. You take only parents' equity share capital. Now group retained earnings, okay, retained earnings. You take parent 100% you will take, but group you will take, for a subsidiary, you will take only group's share. So this is a basic consolidation principle. So in this two line items can be added if something while preparing notes, if I forget something, and while teaching, if I have some points, I will add it over here. So in your notes, I'll do one thing, I'll add it and I'll put it over here. I'll update this part also. Now, ma'am, what is my pre and post acquisition profit? Very, very important treatment. A lot of people get confused in this. See, the question will mention you two types of reserves. I will strictly speak with question perspective. Let's say I acquired control. This is my January and December. My financial year end is this. I acquired control of any company. Let's say ArivuPro Academy acquired control of Lakshya Academy on this date, on 1st of January. See, understand, on the state, retained earnings of Lakshya Limited were 1 lakh. Okay, and on 31st of December, retained earnings of Lakshya Academy were 3 lakh. So see, retained earnings, can I say these are my reserves? Retained earnings are my reserve. So understand, these reserves, this 3 lakh will be split into two parts. Ma'am, what do you mean by this will be split into two parts? Now, retained earnings on the date of acquisition, on the date of acquisition. On the date of acquisition are your pre-acquisition reserve. It is added to what? It is added to your assets, net assets. It is added to your net asset calculation. Now, pre-acquisition. So what are my pre-acquisition reserve in this question? Can I say 1 lakh on the date of acquisition? Now, retained earnings. Yes, perfect, sir. Amazing. So 2 lakh is your what? Post. Now, what is the treatment of your post-acquisition retained earnings? This 2 lakh. Now here, this will be added to what? The accounting treatment of this is what? Adjustment is what? Added to group's share, group's retained earnings, So can I say only post acquisition belongs to group? So only post acquisition, this belongs to group. This will be added in my goodwill calculation, net assets calculation. Now this fair value adjustment, this is the area that bothers a lot of students. What is my fair value adjustment? See, IFRS 3, there are two standards, IFRS 3 and IFRS 10. IFRS 3 will talk about business combination. And what do you mean by business combination? Day one accounting. Whenever you acquire the control, how are you going to account for it? So day one accounting will be discussed by your IFRS 3. So a subsidiary's identifiable assets and liabilities will be measured on fair value. IFRS 3 says subsidiary's identifiable assets and liabilities should be measured on fair value at the date of acquisition. Okay, so see, understand where this problem can be created. Let's say Dakshineshwar sir, we'll take our example, sir. We have Dakshineshwar sir and we have Surabhi over here. Dakshineshwar sir acquired 70% control in Surabhi. Okay, 70% stake of Surabhi. So with this, he got a control over Surabhi. Now understand, sir, Surabhi will have its own financial statements. You will have your own financial statements. Surabhi's book can follow cost method, and Dakshineshwar sir, your book, doesn't matter. But Surabhi's book can follow cost method also. We have two options: cost or fair value model. So my net asset, my assets can be at cost also. But the standard says Surabhi mandatorily you will have to take at fair value. Whenever you're consolidating, you will have to take Surabhi's assets at fair value. Even if it is appearing at cost, you will have to do a fair value adjustment. So let's assume in my books of accounts, I have a PP of 1 lakh. It is, I am following cost model of valuation. So on the date of acquisition, the fair value of this PPE is, let's say, 2,50,000. So it means what? I will take net assets plus I will take one more fair value adjustment of 1,50,000. I will increase the net assets acquired on the date of acquisition by 1,50,000. So for example, land, the book value of land in subsidiaries book is what? 10 lakh. The fair value on the date of acquisition is 15 lakh. So there is a fair value uplift of 5 lakh. It should be added to the net assets. Now goodwill calculation. The basic goodwill calculation, you will take consideration transferred. You will add in share. You will add in fair value of previous holding. This will be helpful in what? Step acquisition. When you're doing the step acquisition, minus fair value of identifiable net assets, this will give you goodwill. So let us analyze this. Let us analyze each of this. Consideration. Now consideration can be of 4 types, sir. Consideration can be of 4 types. You remember what are the 4 types of consideration? First one is what? Cash consideration. Second, consideration in the form of shares. Then third, consideration can be in the form of deferred consideration. Third, it can be a contingent consideration. Okay, now share cash. If I've given cash to acquire any entity, cash remains cash. Yes, sir. If you have a doubt by any chance, cash at cash only. Shares, you will take shares value of what? Share per share value of what company? I am acquiring you. Let's say ArivuPro Academy is acquiring Lakshya Academy. So shares value of what? Per share price of what? Can I say? Acquirer. When I'm issuing my own shares to acquire another company, yes, parent company, acquirer. Perfect. Then deferred consideration will be taken at what? Present value. So here, if they're giving you a deferred consideration, they will definitely give you a rate. Okay. So deferred consideration in my question, if you remember in the question, the recent test, the question that I had given, there was a rate missing, So that was the drafting error. But in your exam question, definitely they will give you a rate. Now contingent consideration will always be taken at what value, sir? It will always be taken at fair value. So NCI. Now NCI we know already. NCI, there are two methods. There are two methods of valuing your NCI. What are the two methods, guys? What are the two methods of valuing your NCI? Do you remember by any chance? Full goodwill method, full goodwill, and partial. Yes, PSNA, partial. I'll write PSNA the way we do. PSNA, partial, full goodwill and partial. So full goodwill, here NCI is measured at what? NCI at fair value, and here NCI at PSNA. So ma'am, what do you mean by NCI at fair value? You will say, let's say here we have a company. Here we have a company called ArivuPro, and we have another company called Lakshya. Now Lakshya Academy has 1 lakh shares. Out of this, ArivuPro Academy acquired 75% stake, 75% of Lakshya company. So can I say 75,000 shares are acquired by Lakshya Limited? ArivuPro Academy Limited. Can I say the remaining 25,000 shares are with NCI? Do you agree with this, sir? Do you agree on this point, sir? Yes. So this, now when I'm measuring my NCI, see, sometimes they will give you NCI value. Sometimes they will give you NCI value, not an issue. Sometimes they will tell you the fair value of NCI is this. But if NCI, they have not given you NCI value, this here they can trick you. They will ask you that your NCI, number of shares held by NCI is 25,000, and fair value of NCI's, your Lakshya Academy's share, fair value per share, MPS, they might give you market price per share is 20 rupees. So ma'am, can we calculate NCI at fair value with this information? The answer is yes. You take number of shares held by NCI and market price per share of Lakshya Academy acquiree. See, when I was talking about share consideration, I took MPS of what? Acquirer. When I'm measuring NCI, here I took share consideration of what? MPS of what? Acquiree. So this is the point that you all, sometimes in the question they will give you both the share prices. Okay, share price of parent as well, share price of subsidiary as well. So we need to know if I'm measuring my NCI. See what happens now when we are doing right now, it will make sense, a lot of sense. But a lot of times what happens when we are under pressure, exam pressure, we get confused. So write a simple formula over here. Tip, or however you all like to write. Just take a printout of these notes when I give you the updated ones. Don't take the printout of the yesterday's notes. I will give you one updated this notes. Take a printout of that and write it, whenever you make a note of it. If consideration, share consideration transferred, share consideration, then you will take what? MPS, market price or fair value per share of what? Acquirer. And if it is NCI calculation, then MPS, market price per share of what? Acquiree. Okay, cool with this point, sir? So NCI, NCI fair value method means what? Simply you will take NCI's share, multiply with the fair value. NCI at PSNA. So the name itself suggests whatever are the net assets, of acquiree, the subsidiary on the date of acquisition, on the date of acquisition. Net assets on acquisition date. Let's say Lakshya Academy's net assets on the date of acquisition were how much? 10 lakh rupees. So you will multiply it with NCI's share. Let's say NCI's share is how much? 25%. You will multiply it with NCI's share of 25%. This will give you your net assets on the date of acquisition. This will give you net assets on the date of acquisition. NCI on the date of acquisition measured using what? PSNA. Measured using what? PSNA. So ma'am, fair value, you will take NCI, just the shares held by non-controlling interest, multiply it with the fair value of an acquiree. And is it training? Sir, where are you from, sir? So by any chance, you're from Bangalore, any chance? Are you from Bangalore by any chance, sir? Oh, Coimbatore. I just heard very, I'm just taking a class and you see thunderstorm when there's a, very huge noise. I heard that. Maybe there's a thunderstorm. Window is closed. Okay. How's the weather in Coimbatore? Pleasant or hot? So multiply your net assets on the date of acquisition. Very sunny. Oh, here it's good. Bangalore, it's good today. Multiply the net assets acquired by us, multiply with the NCI share. This will give you your PSNA. Now understand, when NCI is measured at fair value, we call it as full goodwill method. The question will not say it is a full goodwill. There is no standard, has also not mentioned anywhere full goodwill and partial goodwill method. It's just we, for our understanding, we do that. So then full goodwill method means what? Full goodwill method means here you are doing what? In your full goodwill method, in your full goodwill method, what are we doing? We are taking NCI at fair value. So if NCI is at fair value, it means what? The goodwill that whatever goodwill we calculate, goodwill will belong to NCI as well. But if NCI is at PSNA, goodwill will belong to only to parent, only to group. It will not belong to NCI. Okay, ma'am. So let's complete this discussion. Add fair value of previous holding if it is a step acquisition minus fair value of identifiable net assets. So here there are some areas that you need to take care of. Minus fair value of your this identifiable net assets. So if you're making your own notes also, no sir, make a note of this also. Minus fair value of identifiable net assets. And what do you mean by minus fair value of identifiable net assets? You will take just a simple formula I'm giving you. You will take share capital of subsidiary. I will use a different colored pen over here. Share capital. You will take first share capital of subsidiary. Net assets minus total liabilities. You will take equity. Other equity. Other equity means what, ma'am? Other reserves. Other equity. So it will take into consideration all your reserves. You will take all the other equity. It means what? Your any revaluation reserve, your retained earnings, any reserve. If there's any other reserve in the books of subsidiary, you will take it. Third, you will add. You will take add. You will add what? Fair value uplift. Now you will add one more thing. I will use a red colored pen for this. Add one more thing. Sir, as per your IAS 38, we are not allowed to capitalize internally generated brand. Yes, sir. Do you agree with me? IAS 38, we discussed yesterday. We are not allowed to capitalize internally generated brand. But when you are acquiring subsidiary, and the subsidiary has some brand, that it did not capitalize because of IAS 38 restriction. But you as a director of parent company, you feel this brand can generate future economic benefits to us. If you feel that way, then please capitalize it. Then please take. So any internally generated asset, and whatever is a spelling, internally generated asset. At what value, sir? At fair value. Yes. Perfect, sir. Then there is one more thing that you need to take care of is one more thing, another color. Yes, we'll take this. If not add, minus. If there is a contingent liability, okay, contingent liability. You remember contingent liability, IAS 37, we're not allowed to recognize contingent liability. What is the accounting treatment of a contingent liability? We merely disclose. So subsidiary may have any contingent liability that is not recognized in its balance sheet, that is not recognized in its financial statements. But if there is a present obligation, sir, if there's a present obligation, you will reduce our net assets by contingent liability also. Contingent liability also. So what is the one point that you need to take care of this when you're just dealing with contingent liability? Understand there has to be a present obligation. There has to be a present obligation. Are we okay with this? Any question on this? Now contingent liability again at fair value. So this will give you your goodwill. Now goodwill can be full or partial goodwill. Full when NCI at fair value, partial when NCI at PSNA. So what is the example? Consideration is 100 lakh, NCI 20 lakh, net assets 90. So this will give you your goodwill. Now non-controlling interest, we have anyways had a good discussion on NCI non-controlling interest. What are my non-controlling interest? Two methods: fair value method, it is called full goodwill; proportionate method, partial goodwill. Now at reporting date, every reporting date, this is what my at acquisition. NCI can be measured at full goodwill or partial goodwill at acquisition whenever I'm acquiring. Now this was with the help of what? IFRS 3. Now at every reporting date, sir, whenever your financial year ends come, what will you do? You will take NCI at acquisition. There will be a working note formula for your NCI. You will take NCI at acquisition. You will add NCI's share of post-acquisition profit. So whatever are my post-acquisition profit. So you remember in the previous question, 3 lakh was my retained earnings at the year end. Retained earnings. Retained earning means your post-acquisition profit only. So retained earnings out of this 1 lakh is what my, at the date of acquisition, 2 lakh was what my post-acquisition. Now this post-acquisition is not completely mine. This 2 lakh will have to split. This will be divided into two people. Group. This will be divided into group and this will be divided into NCI. So ma'am, what do you mean by this group? So group share, what is it? Let's say my share is 75%. Sir, can you help me with the number? 25%. 2 lakh into 75% gives us how much, sir? Can you help me with the numbers, sir? Numbers would be helpful. Yes, 1,50,000. 1,50,000 will be added to group retained earning. Okay, and this 25%, that is your 50,000, will be added to NCI. So this is a complete split. This is a complete balance sheet treatment that I've shown you, minus NCI's share of impairment. Now here, one very important point over here. I will highlight this part that a lot of you all will make a mistake. A lot of you all have been making a mistake while we discussed our exam question, classroom questions. See, very important. NCI's share of impairment. Ma'am, what do you mean by NCI's share of impairment? See, understand, when I'm dealing with NCI's share of impairment, I am talking about impairment loss. I'm talking about what? Impairment loss. Impairment loss on what? Goodwill. See, when you calculate goodwill at step number 1, when we calculate goodwill will never be amortized. It will only be impaired. That we know. So whenever there is an impairment, impairment, this impairment loss on goodwill will be allocated. Let's say my impairment loss is 1 lakh. Now this impairment loss again has to be split between two people. What are the two people? Now if I'm sharing my profit, I will share the loss also with you. So let's say 75% and 25%. Yes, 70,000 and 25,000. Now understand, this impairment loss will be split between group and NCI. Again, group retained earnings and NCI. I will reduce NCI. This will be split, but there is one condition over here. What is the condition over here? Condition, your NCI. The condition over here is NCI should be measured at what? Fair value. Only and only if NCI is at fair value, you will split the impairment loss. If NCI is at PSNA, no splitting. Full loss will be allocated to parent. Full loss will be allocated to your group retained earning. You will not split between parent and NCI. Okay. So ma'am, it means what? If NCI is at fair value, the loss will be split. Okay, perfect ma'am. If NCI is at PSNA, any impairment loss will be charged to parent only, will be debited in the group retained earnings only. The answer is yes. Why? Because ma'am, in full goodwill, the goodwill belongs to both parent and subsidiary NCI. But in partial goodwill, goodwill only belongs to parent. Goodwill does not belong to subsidiary. Are we understanding, sir? So in that case, what do? You do not split between parent and subsidiary. So just for exam purpose, just remember one thing, sir. Just only one thing, that if it is your full goodwill method, NCI at fair value, split the impairment loss. If NCI at PSNA, do not split the impairment loss. Fully give it to parent. Okay, ma'am. Now here there's a confusion. A lot of students get confused. Ma'am, if my NCI is at PSNA, then I need not split this post-acquisition reserves also. The answer is wrong. Post-acquisition reserves will be split between NCI and parent, irrespective. Whether your NCI is at fair value or NCI is at PSNA, it does not matter. Post-acquisition retained earnings will always be split between parent and subsidiary. Are you getting me, sir? Between parent and NCI. But only impairment loss. Only one thing, that is, just write it and keep it somewhere. Only impairment loss will be impacted by your NCI measurement. That's it. So all the areas that can confuse you, bother you, I'm trying to address it. I'm trying to address all the areas that can possibly impact this. Now, group retained earnings. Ma'am, what do you mean by group retained earnings? What is the formula for group retained earnings? You will take parents retained earnings fully, 100%. So before I get into group retained earnings, sir, did I confuse you, or are we clear, sir? Are we okay with the step wise? Clear, yeah. So this is something important that we should not make mistake. Now, group retained earnings, another important working note. Just allow me 1 minute, sir. I'll turn on the AC and come. It is getting suffocated. Just 1 minute. Only 1 minute break I bring. Parents retained earnings, 100% we will take. Okay. Parent plus subsidiaries post. Now, when I'm talking about subsidiaries post acquisition profit, you will take only parent share. You will reduce it by goodwill impairment, and you will reduce it by URP, unrealized profit adjustment. I will come when we reduce your parents adjustment, when we reduce subsidiaries adjustment. So this is a simple formula. This is a simple structure. Don't write a GRE in exam. Okay, this is a simple revision purpose. For revision purpose, in your exam, when you're preparing a working note, please write group retained earnings. Do not write a GRE. They will deduct marks. Group retained earnings full. NCI you can write. NCI is something that you can write, but group retained earnings, GRE is not a keyword used by the standard. NCI is a keyword used by the standard. So don't just write GRE and come. You will then say, ma'am, we lost marks because of this. So write full group retained earnings. So you will take parents retained earnings. You will add parents share of subsidiaries post acquisition minus goodwill impairment minus if there are any URP, unrealized profit adjustment. Now let me show you how your consolidated statement of financial position should look like. There are some main working notes. Net asset calculation. How do you calculate your net assets? Simple. You will take subsidiaries post acquisition. You will calculate post acquisition will go to your group retained earnings, and pre acquisition will go to your net assets calculation. So net assets, pre goodwill working note, and post GRE working note. Goodwill we know how to calculate, NCI we know how to calculate, and GRE we just calculated. So these are some working notes, very important. Now, what are some consolidation adjustment? Very important consolidation adjustment. This is an area where people find it a little bit difficult. I've tried to, put all the journal entries and all, so that at least you just go through it. No, you're able to attempt it. You're not scared of this chapter anymore. Just you read this and you should be able to attempt. Now, some intra-group trading. Intra-group trading means what? Sales within the group must be eliminated. Sales within the group must be eliminated. So what are the journal entries? What is the journal entry? You will debit revenue, credit cost of sales. So let's say parent sold goods to subsidiary. Now ma'am, here do we need to check whether parent has sold or subsidiary has sold? The answer is no. So here I will write teacher's tip over here. No need to check. No need to check who sold to whom. In both the cases, whether parent sold to subsidiary or subsidiary sold to parent, the accounting entry will remain the same. It does not change. The accounting entry, the accounting treatment will remain the same. Whether parent has sold to subsidiary or subsidiary has sold to parent, the accounting treatment will remain the same. You will debit the revenue and you will credit sales. You will debit revenue and you will credit sales. Now, unrealized profit adjustment, PURP adjustment, very, very important. Profit included in unsold inventory must be removed. So, for example, parent sold inventory. So, cost to parent is how much? 80,000 and selling price is 1 lakh. So, closing inventory still held at 50%. So, here you will remove. What is my URP? Here, unrealized profit is how much? 20,000. Cost to me was how much? 80. I sold it for 1 lakh. So the cost to me is 20,000. Now this should be removed, 20,000. Now 50%, only the inventory. Now important tip. Profit only on unsold inventory. Only on unsold inventory must be removed. So this is a tip. So if I have 50% inventory in my books, I will remove PURP 50% at the rate 50%. So 20,000 into 50% gives us 10,000. This profit should be removed. So what is my adjustment entry, sir? Here you will debit group's retained earning and you will credit inventory. So this is a journal entry here. Now see, understand, remember, here you are multiplying only with the unsold inventory percentage. When I will teach you associate, there will be some important adjustment. So I need you to have a very crystal clarity that how do we adjust our URP. In parent to subsidiary, you just simply take your unrealized profit and multiply it with the profit percentage or whatever it is. But in associate, there will be a different adjustment. Now see, if my seller is a parent, this is a I would say Brahmastra that you can use. As a Brahmastra that will help you to attempt all your question. If my seller is a parent, so can I say the profit, unrealized profit will be there in parent's book only? Yes or no, sir? Understanding? If let's say Surbhi and Dakshineshwar sir, okay, I am parent and you are my subsidiary. Logic I will make and then I will make you understand this table. If Surbhi is a parent and Dakshineshwar sir is a subsidiary, what will happen over here? This unrealized profit will be appearing in Surbhi's balance sheet, Surbhi's P&L only. There will be no profit in your book. Yes or no? So if Surbhi is a parent, then adjustment will be against what? You will debit only group's retained earning. There will be no NCI adjustment. Why, ma'am? Because it's in my book. NCI is in subsidiary's book, right? So in my books, only group retained earnings are there. So adjustment will be only and only in group retained earning. But if Dakshineshwar sir is telling me, sir, you sold something to me and you made a profit of 20,000, sir. And you made a profit of 20,000. Now this profit of 20,000, unrealized profit, this I will also have some share. And NCI will also have some share. Yes or no? So here can I say NCI's share will also be overstated and my share will also be overstated because it's not a realized profit. We have not really realized this profit. So if subsidiary is a seller, then adjustment will be in group retained earnings. You will reduce it from the retained earnings, the unrealized profit, but from subsidiaries column. Okay, but from subsidiaries column. And you will add NCI and you will also, not NCI, you will also reduce from your NCI. You will also reduce from NCI's share. Are you getting me? Now, ma'am, we didn't get this point. We did not understand this. So let me show you a bifurcation, the way we do working notes. That should be very much clear. See, when I'm talking about balance sheet, if they ask you to prepare consolidated balance sheet, COSP, consolidated statement of financial position. Okay, if they ask you to prepare consolidated statement of balance sheet. So what are you going to do? How are my group retained earnings going to look like? Group retained earnings. Can I say we take parent, we take subsidiary. Now see, understand over here, when parent is a seller, let's say I will take parent's group retained earnings, and here if parent is a seller, I will minus URP over here. If parent is a seller, that's it. I will reduce your URP over here, unrealized profit, and I will take it. Subsidiaries post acquisition will be normally calculated. I will take my share. That's it. I will do that. But if subsidiary is a seller, so my group retained earnings working note, I will take both parent, I will take subsidiary, I will take subsidiary's profit minus pre-acquisition profit. This will give me your post-acquisition profit. Here I will minus URP, okay, unrealized profit, and this will give me your adjusted profit. This will give you your adjusted profit. You will take your share, parent share. Are we okay, sir? Till now, are we okay? Yes. So let's say, I will give some number. I will allocate some number to this URP. After this, I will allocate some number. Let's assume your subsidiary's profit after adjusting URP. After adjusting URP is 5,000. And we will keep that 75 and 25 ratio. So what will be parents' share in post-acquisition profit? 5,000 into 75%. What will be parents' share in this? What will be parents' share? 3750. Simple. I will take. Now I will calculate your NCI working note. I will calculate my NCI working note. How do I calculate my NCI working note? I will take NCI at acquisition. Yes, I will add NCI's share of post acquisition profit. Yes, so here can I say this 5,000, this 5,000 automatically has impact of your URP. I've reduced it from URP. Yes, I've automatically reduced it from URP. So 5,000 into 25% after adjusting the URP. What is it? How much? 1250 will be adjusted. So this is how my balance sheet will look like. This is how my balance sheet working notes will look like. When URP is when the parent is seller, simply parent's share will be adjusted. Do not adjust it over here. If parent is a seller, subsidiary's profits won't be touched. Subsidiary's profits won't be touched. Okay, this won't be touched. But if subsidiary is a seller, this will be touched. Subsidiary's profits will be touched and your NCI's profit will also be impacted. Are we good with this, sir? Is it crystal clear? Okay, now understand. One more thing that you all can make a mistake. You are preparing. Now they may ask you to prepare P&L also, COPL also, consolidated statement of P&L also, COPL. Imagine they have asked us to prepare COPL and here they have put in this group share of this, unrealized profit. Ma'am, how do we do in this case? If they have put this unrealized profit in COPL question. So understand, everything will remain same. What is the journal entry that we pass, sir? You debit COGS and you credit inventory. Yes or no? So inventory, now they have asked us to prepare COPL. So inventory won't be there here. Inventory won't be there over here. I will debit my COGS, group COGS, whatever are my COGS, I will increase it with the unrealized profit if they have asked me to prepare it. So let's say my unrealized profit is of how much? 1,000. So I will debit my COGS, the normal journal entry. But see, you remember in my COPL, whenever we calculate profit, the profit has to be split to group and NCA. Are you getting me? To owners, profit allocated to the owners of the group and to the NCA. So understand, if it is a P&L question and seller is who? Parent is a seller. Then while you are calculating the working note of allocation of profit to NCA. If parent is a seller, no adjustment. If parent is the seller, no adjustment. You will make no adjustment. Why? Because the profit is with parent. So subsidiary's profit won't be impacted. So no adjustment. Whatever is the subsidiary's profit, you will take, you will multiply it with the NCI's share. Okay. But if subsidiary is the seller, you will here adjust in your NCI's working note. In your NCI's working note, see, you will take what? This is my profit to be allocated to NCI. So you will take subsidiary's profit. So here I assume that we remember our working note calculation. Okay. You will take subsidiary's profit. Whatever is a profit given in the question, they will give you a subsidiary's P&L. You will pick, you will just pick subsidiary's profit. Subsidiary's profit minus URP. Minus URP. Now this profit, let's say this profit comes to 5,000. This profit is to be allocated to NCI in multiply with NCI's share. Let's say NCI's share is 25%. So this 5,000 is to be allocated to NCI after adjusting URP. So ma'am, if parent is a seller, this adjustment will not come into picture in my P&L. But if subsidiary is a seller, this adjustment will come into picture. Are we clear, sir? P&L and balance sheet both clear? Guaranteed clear? If it is, I mean, if you are understanding, so I feel others will also not find it difficult. If you find any difficulty, I mean, think it from your other friends' perspective also, the ones who are appearing in just few days later. So will this help? Will this working note calculation help? Did it help you? 100% clear. Perfect. So this is how, I'm just mechanically putting it into words so that at least you are sorted for exam. At least we know that there's a mechanical process. Logic is there sometimes, but in 3 hours you cannot use logic and you cannot, use everything at one time. Brain has a little capacity. So we good with this. Where were we? Yeah. So this is an important area. Just draft working notes. I'll do one thing. Instead of doing this, I will give you a draft working note also. Allow me some time. Today is time. I will update these notes and I will give you the updated notes. Now, intra-group balances. If there are intra-group receivables and payables, please eliminate them. If there are intra-group receivable and payable, eliminate them. So journal entry, debit payable, debit credit receivable. Ma'am, subsidiary is a payable or and parent is a receivable, but there may be a situation where subsidiary is a receivable, parent is a parent. I mean, doesn't matter. It does not matter who is payable, who is receivable. It does not matter. You simply debit, payable, credit, receivable. It does not matter who is a creditor, who is a debtor. It does not matter. So just like your sales and COGS adjustment, even in this, there will be, it will not be relevant who is the seller and who is the debtor or who is the creditor. Now cash in transit. Cash in transit means what? The cash has been sent but not received. Now in today's time you will say, ma'am, how is this possible? You just Google Pay, you receive immediately. Yeah, but the adjustments are there, so we will have to take care of it. So what are we going to do? What is the accounting adjustment over here? You will increase the cash. You will increase the cash. You will reduce receivables or payable mismatch. So if it is in transit, it means what? It has to be there. It is a group's cash. For example, sir, you and I are a family. I sent you a cash, but it is somewhere in between. You have not received it. But can I say it as a family's cash? I would have reduced it, but you would not have added it. Yes or no? I sent you a cash, but I would have deducted it because I paid to Dakshineshwar sir. I would have reduced it, but you would not have added it. Why you would not have added it? Because you have not received it yet. So here you will increase the cash because I have reduced it, and it is subsidiary's cash. Some or the other day you will receive it, and you will reduce any receivable and payable mismatch, whatever is a mismatch. Now goods in transit. Goods in transit means what? Goods sent but not received. So you will adjust inventory and payable. You will increase your inventory and you will adjust your payable also. Now if there are intra-group dividends. Intra-group dividends means what? You are my subsidiary and I'm your parent. You will give me dividend. Let's say you paid dividend to me. You will cancel. This will get cancelled on consolidation. Important. Dividend from subsidiary is not a group income. Eliminate against the investment income. Whatever is your investment income, you will eliminate it. Now preference shares and dividend, rarely you will find preference shares and dividend in any question, but if at all there are there, I'm just looking from all the broader perspective, if at all there are there, intra-group balances must be eliminated. So for example, I have issued loans to you. So for you it is a debenture, for me it is an investment in debt instrument. So I will remove that investment in debt instrument, you will remove your debentures. Fair value depreciation adjustment. Very important. You remember the previous example that I took? You remember this previous example that I took? This fair value uplift. Now, what did I teach you? If the fair value is this 15 lakh and the book value in subsidiary's book is how much? 100 lakhs. So we are going to add 5 lakh to the net assets. This will increase my goodwill. This will reduce my goodwill calculation. Yes or no? This will increase my net assets and reduce my goodwill. Now, ma'am, this is on the date of, this is as per IFRS 3, on the date of acquisition, we are going to do this accounting treatment. But ma'am, what after going after that? So you remember here, my fair value uplift was 5 lakh. My fair value uplift was 5 lakh. So what after that? So in my previous example, your fair value uplift was how much? 5 lakh. Now your remaining useful life of your machinery is how much? 5 years. So you will charge extra depreciation of, yes, depreciation will increase, no? Depreciation will increase, no, sir? Are you getting me, sir? So you will increase your depreciation by 1 lakh. Extra depreciation. Subsidiary would not be charging that depreciation. Are you getting me? Subsidiaries book. In your book, let's say you are my subsidiary and I am your parent. You will depreciate 10 lakh only, but I will have to depreciate 15 lakh. I have taken the value at 15 lakh. You will continue to depreciate at 10 lakh. So in your book, in your individual book, what will be your depreciation? 10 lakhs. Just help me with the numbers. I really am not good with numbers. 10 lakh divided by 5 years. What will be the depreciation charged by you, sir? In your individual books? 2 lakh. Yes or no? But ideally, I should charge what depreciation when I take your P&L, when I take your group retained earnings, when I take your profit. What will happen? I will take your profit will be reduced only by 2 lakh. But I will have to reduce in my balance sheet the depreciation. In my balance sheet, your machinery is appearing at 15 lakhs. So what will I do? I will have to charge depreciation at 15 lakh divided by 5 years. So it is 3 lakh. So I will adjust, I will increase your depreciation by 1 lakh. I will increase depreciation by 1 lakh. So it will reduce what? If I increase my depreciation, can I say it reduces my profit? If I increase my depreciation, can I say it reduces my profit? I'm increasing my expenditure, I'm reducing my profit. So it will reduce my group retained earnings. It will also reduce my NCI. Why NCI? Even NCI share. Now this is your extra depreciation. It is your balance sheet, your PN, your machinery. So your depreciation should be shared by both me and NCI. Are we okay with this, sir? So just like reduction in your group retained earning, group share of profit, extra depreciation you will minus in your group retained earnings, you will minus in your subsidiaries column, and that profit will be allocated after doing the fair value adjustment. You will do this. Ma'am, P&L, same P&L. You will take subsidiaries profit minus fair value adjustment, whatever is the subsidiaries profit minus your extra depreciation, that profit will be allocated to NCI. Okay. So I've tried, I've tried. I mean, just tell me, sir. I mean, I just want to know, did it help? Like the working notes are helping, the way we are discussing these working notes, will it help this discussion? I mean, since we are not solving question right now, no. So my point is, are we understanding? Are you able to catch with what I'm trying to say? Okay, so I will discuss something next. Just I was taking 1 minute break to my throat. Now we go to goodwill calculation and working note. We'll discuss something called as goodwill calculation and working note. So what is my working note? Here, simple consideration, NCI, previous holding less NCI, and this full goodwill method, NCI at fair value. So you goodwill includes your parent share and NCI share. We have anyways had a discussion. So I just had a discussion up only. Partial NCI is measured at proportionately. So goodwill includes only parent share. Now goodwill impairment. How do you do the goodwill impairment? You will reduce the group goodwill. You will reduce group retained earnings. Reduce NCI only in full goodwill method. NCI will be impacted. NCI will get its share of impairment only and only if it is a full goodwill method. Do not. Quick recap. Just and perfect. Thank you, sir. So this will not in PSNA. So write it. I'm telling you, I've seen a lot of my students, they're making the same mistake. Even after having this discussion, what happens in the exam, we're just used to it, So just write it, your brain should feed it in your brain that if your NCI is at PSNA, do not reduce this. Now we go to the important discussion of associates. What is the meaning of associate? Here you have what? Significant influence. Here you have a significant influence. Usually it is 20 to 50%. Now, what is the meaning of significant influence? What are the indicators? We have anyways had board representation. So if you see in a question, board representation, policy participation, and material transaction, it is your what? It is an indicator of significant influence. So equity accounting, you will apply equity method. Very, very simple. Just pay attention to this. Equity method of accounting you will follow. So ma'am, what do we do in equity method of accounting? Initially, you will recognize at cost. Initial recognition at cost. Ma'am, what do you mean by cost? Let's say I acquired 30% stake. I acquired 30% stake in Rachna Limited. So let's say Here I purchased, to acquire that 30% stake, I paid 10 lakh rupees. So this is my cost of acquiring associate. So initially always at cost. Subsequent measurement, tip, important, very, very important. Increase your investment in associate by share of profit. Whatever is my share of profit, I will increase my investment in associate. Decrease by any dividends received. Decrease if there are any dividend received. So what is a formula? What is a carrying amount formula? You will take cost, add share of profit of post-acquisition profit, minus dividend, minus impairment. That's how we do it. So simple. This is a working note for your investment in associate calculation. Just 1 minute. Investment in associate working note formula. That's it. You follow this structure. Now, for example, 30% associate acquired for 50 lakh. Post-acquisition profit is how much? 10 lakh. So what am I going to do? This is my cost. This is my profit. So what is my share? My share. 10 lakh into 30%. So can I say 3 lakh? My share is how much? 3 lakh. So in my balance sheet, in my group balance sheet, my investment in associate will appear at what? 50 lakh plus 3 lakh. Can I say 53 lakh? So investment becomes 53 lakh. Ma'am, what is the journal entry over here? You will debit, you will increase your investment in associate and you will credit group share of profit. You will take your profit, share of profit, and this will increase your investment in associate. So what is my main working note? The only main working note is cost of investment. Add share of post-acquisition profit, less any dividend. This will give you your carrying amount. If there are any impairment loss also, minus impairment loss. Impairment. If your investment in associate has been impaired, you will adjust for that also. Now this is the heart of this chapter. Associate, the only thing that bothers students is group adjustments, intra-group adjustments. So we will just kill it. We'll try to kill it so that it no longer bothers us. All our balance sheet and P&L should be clear. So intra-group adjustments. What are my intra-group adjustments, sir? Intra-group balances not fully eliminated are not fully eliminated for associates. Okay, ma'am. So it means what? What do you mean by not fully? So let me tell you one thing. Let's say I have purchased something for 80,000. First we talk about parent and subsidiary relationship. I sold it to you for 1 lakh. Can I say I made a profit of 20,000? Yes or no? And assume this whole I have 75% stake in you. Okay, assume this whole inventory is in your balance sheet. You have not sold any single inventory. So can I say, what will I do? What is the journal entry I will pass? Can I say I will debit COGS and I will credit inventory 20k. Simple. Parent and subsidiary will eliminate full profit. Whatever is the profit, whatever is the unsold inventory profit, we will eliminate it. But associate, you do not eliminate full profit. Ma'am, what do you mean by this? Now, same situation, everything keeping same. Here in my first scenario, you were my subsidiary. In my second scenario, you are my associate. So ma'am, how is it going to change? You will multiply with associate share. Oh, okay. So here you will not debit 20,000. You will not reduce your profit by 20,000, but rather you will reduce it by how much? 6,000 if I'm not wrong, sir. 6,000 is what we will get, right? If my maths is okay. So 6,000, you will not reduce full 20,000. You will only reduce 6,000. Are we okay with this? Yes. So this is the important area. This is where a lot of you all will make mistake. I'm guaranteed, I'm telling you. A lot of you all will make mistake because we are so used to calculating the profit. We are so good with calculation of profit that we forget. A lot of time, often we forget when it is associate, we have to multiply with associate share. So don't make a mistake over here. Do not forget to reduce your profit by this. Okay, ma'am, we have understood this. We have understood. Only investors' share of unrealized profit will be eliminated. So it means what? You will take PUP multiplied by investors' percentage of holding. First mistake, are we okay? So first, don't make this mistake. Don't make this mistake. Now, if it is a downstream transaction, see, journals will change. And my recommendation as your friend, as your mentor is give journal entries. Whatever, if the question is talking to you about accounting treatment, what will be the accounting treatment? Please talk about journal entries. Do not forget to give journal entries. I'm telling you, you give journal entries and see the marks going up. marks shooting. Only if it is right, okay? Do not give a wrong journal entry. Journal entry is the heart of accounting. If you give journal entries, the examiner will be super impressed. Oh my God, this person knows journal entries also. So downstream transaction. Here our journals will change, accounting will change. So understand, logic is also important over here. Parent and associate. Parent has sold goods to associate. So what is the normal journal entry that we pass, sir? What is the normal journal entry that we pass when it is an unrealized profit adjustment? Can I say we debit COGS and we credit inventory? Yes or no? Now, parent sells goods to associate and associate still holds the inventory at the year end. So tell me, can I credit my inventory in this case? Can I credit inventory in this case? The answer is no. Ma'am, why you cannot credit inventory in this case, ma'am? What is the logic? See, you are my associate, sir. In associate, I'm not taking all your assets, sir. Right? Are you getting me, sir? I'm not taking all your assets. I am only taking my share of profit. I'm only asking you, sir, just give me my share of profit. I will not take your assets. So here, I'm not taking your asset. It means your inventory is not overstated. I will not take your inventory. Yes or no? So here, unrealized profit sits in associates inventory. It does not sit in my books. It will not impact my book. Since associates inventory is not line by line calculated, reduce investment in associate. Are you getting me, sir? So you will debit cost of goods sold. You will reduce your retained earnings of parent by PUP multiplied by A minus investment in associate. Are we okay with this, sir? So here the corresponding credit, instead of going it to inventory, it will go to your investment in associate. Okay, please tell me, are you okay or not okay? This is an area where a lot of people make mistakes, so I just thought I will have to discuss this with you all. So why? Parent has already recognized a profit. Portion of unrealized is removed from group perspective, therefore parent profit and investment carrying value. So for example, parent owns 40% of associate. Unrealized profit is how much? 20,000. So adjustment is 20,000 into 40%. Debit cost of sales 8,000. Investment in associate 8,000. Now upstream transaction. Upstream transaction means associate sold to parent. Now you are my associate. You sold something to me. Now here inventory will come into picture because my inventory is affected, right? Your inventory is not affected. So associate sells good to parent and parent still holds it in inventory. So ma'am, what will happen over here? Unrealized profit sits in parent's inventory, sir. It is sitting in my profit. So since parent inventory is not fully consolidated, reduce the inventory directly. So you will reduce my inventory. So what is the journal entry over here? You will debit share of profit, credit group inventory. So here this journal entry will come into picture. Unrealized profit included in associates profit. Investor recognizes through equity accounting. So investors group accounts are overstated. Are we okay with this? So parent owns 30%, PUP is 15,000. So multiply. Don't take simply 15,000. So adjustment is 50% into 30%. 15,000 into 30%. You will debit share of associates profit. You will credit inventory. So a quick comparison. Direction parent to associate. Then associate, it is sitting in associate inventory. So you will debit cost of goods sold. You will credit investment in associate. Investors share only. Mandatory. If associate is selling to parent, it is sitting in parent's inventory. So share of associate's profit. Here you will credit inventory because my books are overstated and investors share only. Are we okay? Shall we? Are we okay, sir? Yes. So can we take a 15 minutes break? Can we take 15 minutes break, sir? It's 41 almost. We meet at 12 around. I just need to have that same energy, to shout at the top of my voice. So step acquisition we'll discuss. Then first I will take the question. After doing step acquisition, first I will take the question because that is more important. And then I will do what? I will go discuss whatever is the time left. We'll go with the remaining discussions. Okay, I will see you at 12. If there are any other friends who wish to learn that, because I got 2-3 people mentioning that question is tough. So I thought I'll have a discussion, and with that we'll be able to deal with your pre-populated balance sheet also. Just inform your friends that they can join us in some time. Now, the last point that I want to discuss with you all is about step acquisition. Once we complete this, then we'll go to that sum. So that at least towards the end, we are not like we have to rush things, ma'am. We don't have enough time. We did not understand that question. I want to give all the respect that that question deserves. Okay. Step acquisition. So, ma'am, what is the meaning of step acquisition over here, sir? Step acquisition means from a normal investment to a subsidiary. It is a normal investment. It was a normal investment. Then it goes to my subsidiary. The step I'm acquiring in a step. It can either be from associate to subsidiary, from normal investment to subsidiary, or from subsidiary to subsidiary. So, ma'am, what do we do? There are three types of questions that can be asked to you. Either it is your associate. There are three situations. Okay, I mean, there are two situations where control is gained. Control is gained. Second, control is retained. Ma'am, what do you mean by control is gained? It was my normal investment, sir. It was my normal investments. IFRS 9 I was applying. So from normal investment to subsidiary. Then it was my associate. It was my associate. From associate to subsidiary. Then control is retained. It means what? It was my subsidiary and it is still my subsidiary. I've acquired more share. So we need to understand what is happening where. Okay. Now step acquisition. What do we do? What is the accounting treatment? What should be impacted? First, you remeasure your old investment. You remeasure your old investment at fair value. Whatever is the value of your investment, please bring it to fair value. Gain and loss will go to your consolidated P&L. You will recognize a subsidy. For example, I had a 10% investment. This was my normal investment. The fair value of this investment is 5 lakh. Old carrying value is 3 lakh. So first, I will recognize this gain in P&L, and this 5 lakh will be added in my goodwill calculation. You remember? Consideration add fair value of previously held interest. So this 5 lakh will be recognized over there. Now from associate to subsidiary, existing associate becomes my subsidiary. So how am I going to do it? Here your equity accounting will stop till the date of step acquisition. You will apply equity accounting. After that, the equity accounting will stop. Your old holding will be remeasured at fair value. Your old holding will be remeasured. Gain and loss again will go to P&L, and your full consolidation will now start. Now goodwill includes what? New consideration, fair value of old holding, NCI, less any net assets at fair value. Now subsidiary to subsidiary, control is retained. Here associate to subsidiary, your investment to subsidiary. Are we okay? Now we go to associate to associate. So tell me, are we okay till this point, sir? Okay. Now subsidiary to subsidiary, how do we account for when it is my subsidiary and it becomes my subsidiary? Accounting treatment in group financial statements. So what is the meaning of step acquisition over here? You already own some shares and you are purchasing another share while the control is still maintained. It means what? I had 60% stake. I acquired further 10%. It became my 70% stake. Now, what will be my statement of P&L? Statement of P&L, what will be the treatment over here? I will continue to consolidate subsidiary fully for the whole period. My P&L will not change. Only NCI calculation will change. Only NCI percentage changes after the additional acquisition. Okay, ma'am. So what do you mean by this, ma'am? See, I will give you a rough draft working note for you. Sir, assume Jan to December is my financial year end. Now in the middle of the year, up till Jan to June, my NCI was measured at 30%. Now from June to December, my NCI decreased. I acquired further stake, so my NCI decreased to 20%. So what will happen, sir? Let's say the subsidiary's profit during the year is how much? 1 lakh. So 1 lakh into 6 by 12 into 30%. First 6 months you will give 30% stake. 1 lakh into 6 by 12 into 20%. For next 6 months you will give 20% stake. So only NCI's percentage will change after additional acquisition. So here only this will change. Remaining everything, P&L will remain everything. P&L will remain the same. No changes in P&L. Just what I taught you so far. everything will be followed just as it is. Only this thing will change. So before additional acquisition, old NCI, give old percentage, let's say 30%. After additional, give new NCI percentage. Okay, sir. So for example, before parents holding was how much? 60%. So NCI was how much? 40%. After parents holding increased to 70%, so NCI's holding got decreased to 30%. So whatever date, till the date of step acquisition, you will give NCI its share of 40% profit. After acquisition, you will give NCI 30% share in the profit. Now, statement of financial position. How will my statement of financial position look like? Subsidiary will continue to be consolidated fully. All the consolidation will be done like this only. Only equity will change. Here, there's an adjustment in equity. No P&L impact. See, in my associate to subsidiary, normal investment to subsidiary, my P&L was impacted. The gain and loss goes to P&L. Here, nothing will go to P&L. Only NCI's working note will change. So, in this case, what will happen, sir? Subsidiary will be consolidated fully. Everything will remain same. Only your equity will change. So, how are you going to calculate NCI? You will first calculate step number 1. I'm trying to just put this into steps. Step 1, calculate NCI at the rate of acquisition. So whatever is your NCI, they will give you, either they will give you or not. NCI at the rate of step acquisition. Step acquisition. Whenever we are doing the step acquisition, you calculate. So ma'am, how do we calculate it? You take NCI, add NCI's share of profit, the normal working note that we prepare. Add NCI's share of profit up to, step 2, add NCI's share of post-acquisition profit. So this will give you NCI at the rate of step acquisition. So we call it as A, where NCI is before the additional purchase, or can I write NCI at step acquisition? NCI at step acquisition. Ma'am, how are we going to do it? Now see, I have acquired additional stake. I have acquired additional stake. So it means NCI's share will get reduced. In disposal, it will happen reverse situation will happen. So here, and I have acquired additional stake, NCI will get reduced. So ma'am, how do we calculate NCI? Simple formula. You will take NCI, whatever is NCI, you will find out what is the decrease in NCI. You will find out, you will multiply it with the percentage purchased, divide it with the old NCI. So for example, parent stake increases from 60 to 70%. So you will take, what was my old NCI? 40%. What is my additional purchase? 10%. So what is the formula? A multiplied by 10 divided by 40. This simple formula. So this will give you decrease in NCI. So ma'am, what after that? NCI after step acquisition will be what? NCI before step acquisition minus decrease in NCI. This will give you your decrease in NCI. So add. If it happens mid-year, you will take new percentage. Take most post-acquisition profit after step acquisition. Then you will calculate your closing NCI. Okay. Are we okay till now? So far, so good. So ma'am, what is the adjustment to parent equity? Difference between consideration paid and reduction in NCI. Let's say I paid 1,000 and my NCI got reduced by 80,000. So this 20,000 will be adjusted in equity. No goodwill arises, no changes, because anyways, goodwill will come in your life only once in your lifetime. That is on the date of acquisition. Rest of the times, goodwill will not come into picture. So fair value of consideration paid less reduction in NCI. This will be your adjustment to equity. So what is a double entry? You will debit your NCI because you're reducing your NCI. So NCI has a credit balance. You debit your NCI. You credit your group retained earnings. Credit your cash. Debit, credit, whatever is your situation. Okay. Now, important, when ownership changes but control is retained, treat it as an equity transaction. No gain and loss, no goodwill is recognized. This is a heart. This is a crux of this whole discussion. This is very, very important. Now, subsidiary to associate. When it was my subsidiary and it becomes my associate, control is lost, but significant influence is retained. So you will do what? You will de-recognize your subsidiary. You will recognize retained investment at fair value. Gain and loss will go to your P&L. Okay. Now, this is disposal. Disposal I will take a little later because small only. Now I want to talk about this question. Very, very important question. Let me take that. I have adjusted files in that. Okay. Ma'am, Tejaswini ma'am, now I'm discussing that question. Before I discuss that question, I want to have one discussion with you, ma'am. Would you like to meet me? Not meet me as a meeting. Would you like to meet me on 30th of May? We conduct a meeting, a Zoom meeting, or however it is here only. We meet for, see here, marathon was all about revising concepts because concepts are very important. If you wish, I've had a discussion with sir. If you guys are, okay. Now we discuss this question purely. This only, no ma'am, this question you had doubt, right? So I've discussed, I know this very good question, but very simple. Don't worry. Now the way we solve, I've solved it. I've not picked up right away the book solution. I've put it into steps. Okay, you all can also in your exam also put it into steps. That will help us a lot. Okay, don't blindly follow the exam, the exam kit method. If you have better steps, you put it into that way. Now we discuss one by one. Now here, even though I did not revise this foreign currency translation part, foreign currency, but a little bit of expectation will be there from my side that you have some knowledge of foreign currency. Okay. So Peony company is a parent company of group with one overseas subsidiary and financial year end is what? 31st of December 2002. The functional currency of Peony companies and presentation currency of Peony company is what? Dollar. So simple. So far we are good. So we have here 4 exhibits. The following exhibits provide you with the relevant information. First one, functional currency. We have to determine some functional currency. There are 3 issues in the book. Then 4th, changes in government regulation. And the last one, and your favorite, the area that you all find it difficult, that is your investment in your draft consolidated statement of financial position. So I'm not going to read that exhibit. It's anyways going to give you what are the exhibits all about. So first exhibit is about functional currency. So here, please communicate with me so that we know how your preparation is. We have one company called Nomstara, whatever is pronunciation, a foreign subsidiary of Peony company with functional currency of NY. So we have one company, foreign subsidiary. We have a foreign subsidiary. Ayo, what's wrong? One minute, I cannot function without this. So Nomstara, a foreign subsidiary of a Peony company, the functional currency is NY. Now Nomstara's sales and related costs are predominantly denominated and settled in NY. So what are they trying to say? See, when you read the question itself should tell you, okay, probably what is the kind of a question they're going to ask. They say sales and cost are predominantly settled in NY. So in this currency, NY currency. So it means they will definitely ask us what is the functional currency of Nomstara. Okay. Peony company had previously provided a supporting loan in dollars. Oh my God, dollars. We have given loan. The parent has given a loan to subsidiary in dollars to Nomstara company, which had been settled during the year. So we gave a loan in dollar, Peony parent, and Nomstara is a subsidiary. So Peony gave loan in dollars. So you remember there was one more condition, your fundings are in which currency. Even that is one of the important area to determine your functional currency. So we know sales and costs are in NY, but my fundings are in dollars. Has been settled during the year, and funds from financial activities are currently generated in NY. So it means what? My other fundings are in NY. This loan has been settled, the dollar loan has been settled but my other fundings are in NY. Nomstara's board of directors are free to determine its decision independently. So it is an autonomous means it is an independent subsidiary. So I mean Peony does not fully control its operating decisions. So with this the probably one question would be that you determine the functional currency. Now you all only tell me. This is a very simple question. You all only tell me, what do you think is the functional currency of Nomstara? Is it dollar or is it NY? NY, simple. Because my fundings are retained. Yeah, Dakshineshwar sir. Yes, NY, simple, very simple. Sales are in this, and your this is also fundings are also generated with this information. We can determine that it is your NY possibly. So be diplomatic over here. Be very diplomatic. I will show you how they have solved the question. Be diplomatic. Tell them that my fundings are in NY, so probably my this would be a NY. But when we look, this has been settled. New loan is in what? NY. New fundings are in NY. So we say your functional currency is NY. Now, second is what? Second, now we go to the three issues. 1st January 2002, Peony Company acquired 75% of 1.5 million NY$1. So can I say share capital? This is share capital. See, I will need this. A lot of times we get confused. Why do we need shares? So it is NY1. So 1 rupee. Think of it NY as a rupee. Okay. Ordinary shares of Nomstara for 1.1 million. So can I say this is my consideration? They are giving me acquisition part. So definitely they will ask us to calculate goodwill. When retained earnings of Nomstara were how much? 4.8 million. So can I say this is my pre-acquisition retained earnings. Pre-acquisition retained earnings. Perfect. There were no other components of equity. So my net assets are sorted. 1.5 million into 1.5 million shares into 1, and your this retained earnings 4.8. So this will give you a can I say this will give you your net assets. This will give you your consideration. There are no other components. Now determined, Peony Company has determined that NCI has had a fair value of 2.7 million at acquisition date. So you had a fair value. NCI had a fair value. So we have NCI also, we have consideration also, and we have net assets also. But only one thing that you need to take care of is here your this net assets and your NCI is in what? NY currency, and your this consideration is into dollars. So we will have to convert it. They will give you a dollar rate. Now during the year ended 31st of December 2002, Nomstara company reported a loss of NY $9,000. So you reported a loss. So can I say it will impact my group retained earnings? No dividends were paid or proposed. On 31st December 2002, Nomstara company reported total equity of 5.4 million. Okay, so this is my closing equity. Now exchange rates were given as follows. Exchange rates were as follows. 1st January, can I say this is my opening? Can I say this is my opening? Can I say this is my closing? And can I say this is my average rate? Now my chartered accountants, tell me, when I'm calculating, if I have to ask you about this, goodwill at acquisition will be calculated using what rate? Goodwill at acquisition will be calculated using what rate? You will see the rate and tell me 12, 18 and 15. What rate we should calculate the goodwill at? Opening 12. Yes, opening rate 12. No, not fair value, not fair value. Rate of conversion rate, sir. So can I say when did I acquire? 1st January 2002. So I will take this rate. So goodwill will be translated. You know, you will have to calculate goodwill, no? Because this is at NY, this is at NY, this is at NY. So you will have to translate it to dollars. So you will have to take what rate? Opening rate. Simple. Now there are some issues. What are the issues over here? Goodwill arising on the date of acquisition was calculated incorrectly at $7,25,000. Okay, not an issue. This amount is included into draft consolidated statement. So they have given us a draft SOFP. In arriving at this figure, acquisition was NCI at acquisition was translated and recognized using the exchange rate at 31st December. So they have made a mistake. What mistake they have made? Ideally, your NCI. What was my NCI, sir? 2.7 million. So this 2.7 million should have been translated using what rate? Opening rate. But they have translated using what? Closing rate. So can I say 2.7 only, no? So 2.7 NY divided by what at what rate did they translate? 18 NY. So same currency you divide. So what is my NCI? What NCI they would have taken? Please help me with the numbers. Numbers I am not good with. So help me with numbers. 2.7 divided by 18. What million it will come? 0.15 million. They have taken NCI at 0.15 million. But ideally, what should have been our NCI? 2.7 divided by 12. Opening rate, because date, no? So 2.7 divided by, sorry, not this, 12. So my NCI should have been what? 0.225. So can I say here my NCI is understated? Can I say my NCI is understated? Are you getting me? So one issue we have figured out. I will tell you, we'll solve the question, but understand 0.225. What mistake they have made? Because of this, what mistake has happened? So they took what? This is how they have calculated. They took consideration dollars. They took NCI at acquisition 150, 2.7 divided by 18, 150 million, and fair value anyways it has been given, and goodwill at acquisition they got 7.25,000. So this is an important issue we figured out here. My NCI is understated. So can I say if my NCI is understated, can I say my goodwill is also understated? One more logic. Where did that go? Okay, not marathon account. Yeah. Can I say now logic? Think about it. Can I say in my balance sheet, if I go to draft balance sheet, let me show you draft balance sheet. In the question, they have mentioned in the question only. So here it is a draft consolidated. This will be given in the question. This will be a pre-populated sheet given to you all in the question. How do we address it? I'm going to discuss this. So you see here goodwill in your draft balance sheet, they have taken goodwill at 7.25. And what is my NCI? 137.5. So can I say if my goodwill, if my NCI is understated, sir, can I say if my NCI is understated, can I say my goodwill is also understated because we add it to the consideration while calculating it? So is it making sense to you that if my NCI is understated, if my NCI is less, my goodwill will also be less automatically? So it will impact this issue will impact two of my balance sheet items. It will impact my goodwill. It will also impact my NCI. Tell me, are you all okay with this? Is it reaching your heart, everybody? Yes. Dakshineshwar sir, we good? Yes. So we understood. Okay. So I have highlighted. I'll highlight this part. First issue will impact my this. The understatement will impact my goodwill and will also impact my NCI. Now second is what? Second is goodwill impairment. There was an impairment of goodwill of 3.3 million invoice. Was calculated but not recognized in relation to norms Tara. So we have calculated but we have not recognized it. Okay. It is group's policy to translate impairment loss at an average rate. Okay. So not an issue. We will translate it and we will recognize it. So what is the impairment loss recognition? How are you going to recognize? See, NCI is at fair value. We just had a discussion. NCI is at fair value. So this impairment loss will be allocated to both, can I say, group, and can I say it will impact your NCI also, impairment loss. So this now in my balance sheet, I will have to convert it into dollars. Simple. So can I say it will impact, this impairment loss will impact my goodwill. My goodwill will also get reduced. My group retained earnings will also be debited. My NCI will also be impacted. Yes. Okay with this adjustment? Are we okay with this? They have not recognized it. It means what? It is not yet appearing in my draft balance sheet. Are we okay? Tejaswini ma'am and Dakshineshwar sir. Crystal clear? See, understand. When you understand what it is going to impact. Yeah, FCT. This is not FCT. I'll come to that part. Group retained earnings. It is an impairment loss, no ma'am? Group retained earnings. This translation reserve will go to FCTR. Are you getting me, ma'am? Translation reserve goes to FCTR. This is not a translation reserve. This is an impairment loss, ma'am. Impairment loss is my profit. Okay, FCTR goes only currency translation. I have not yet translated it. I am just recognizing my impairment loss. Now, second is what? Norms Tara's asset and liability excluding goodwill were translated using, my assets and liabilities were translated using dollars at the rate 31st December. Okay, that is fine with this because assets and liabilities are always at closing rate. The same exchange rate was used to translate the loss for the year ended 31st December. Now tell me what is the issue over here. What did they tell you? There was a loss. Didn't they mention us that there was a loss of 9 lakh NY? 9 lakh NY. What did they do here? Now this I will let you all identify what is the mistake over here. They said that all the assets and liabilities excluding goodwill were translated at the rate 31st December 2002. We are fine with it. Assets and liabilities at closing rate only. The same exchange rate was used to translate loss during the year. Tell me what is the mistake over here. Yes, Tejaswini ma'am. Loss is your P&L item, sir. P&L item always at average rate. So this is wrong. This is wrong. Now this resulting total exchange loss of 1,75,000 has been included in a translation reserve. Okay, so here your loss calculation is wrong. So here your FCTR will also be wrong in your consolidated statement of financial position, and no entry has been made to to the NCI reserve. See, what mistake did they do here? They did not first, they calculated a loss wrongly. They translated the loss using closing rate. Ideally, it should have been your average rate. And also, they did not. This translation loss is to be transferred to group FCTR and NCI. This is again to be split between both NCI and group. So they did not charge it against your NCI. They did not charge it against your NCI. They did not give NCI its share. Are you getting me? It's a question. Are we able to understand the question? If you understand the question, the solution will be so smooth. So if you understand the question, the logic, if you understand what is it trying to say, the solution will go very smoothly. Now there's one more issue, changes in government regulation. Near the beginning of the following year, the next year, what happened? There were changes in government regulation in the country where Nomsara is located. This has significantly impacted Nomsara's operations and caused a fall in your fall in the value of your NY, fall in the currency of NY. The directors are aware that due to changes in government regulation, Nomsara is no longer permitted to transfer funds to NY. So you remember, let me take you all back to our lecture. If you remember, while we were discussing consolidation, the first class of our consolidation, I told you all, directors would not want to consolidate just because it is not able to receive funds from subsidiary. There will be, the question will tell you that we cannot receive funds from subsidiary. There are long run restrictions on receiving funds from subsidiary, but still you will not even this reason should not stop you from consolidating the subsidiary. Yes, you will remember that first class. Even if you are not able, even if there are long-term restrictions on receiving funds from subsidiary, still the consolidation should not stop. So with this, we understand that with this long-term restriction, the consolidation should not stop. Moreover, however, government restrictions have been enacted with the limit to which peony can exercise right or governance. Here it is also impacting peony's rights. It is also impacting peony's rights, which means what? Peony cannot exercise right. Peony cannot exercise control. Are you getting me? So this is an important, a 5-star point. A lot of us, if I were you, I would have just mentioned, do not stop consolidation, because long-term restriction is, even the standard itself mentions that long-term restriction should not stop you from consolidation. But this point is a 5-star point, only one, like they played with us only with this one line. Okay. So they have given us a draft consolidated balance sheet. So with this, I will understand, I have understood first adjustment. The first issue will impact my goodwill. Okay, let's not do this over here. Let's go slow by slow. Let's do step by step. So what have they asked us? What they have they asked us? Using Exhibit 1, accordance with IS 1, tell us what is the functional currency. You all only told me what is the functional currency and why. With regards to 3 issues outlined, first tell us the correct calculation of consolidated statement of P&L, consolidated statement of financial positions. So here you will have to draft this, adjust the pre-populated sheet. You will have to adjust the financial statements, the balance sheet, and using Exhibit 3, tell what is the potential impact of changes in government regulations. So shall we? Are you all ready? So we discussed the first question where we have to determine the financial currency, not the financial currency, the functional currency. Determination of functional currency of Nomsara. So ma'am, how do we do it? Functional currency is what? The currency of primary economic environment in which the entity operates. So here we take into consideration some primary factors and some secondary factors. Yes or no? So here you see, what are the primary factors? Currency influencing the sale prices. So if I talk about Nomsara, what is the currency that is affecting our sale prices? NY. Yes or no? Currency influencing the cost. Again, this is NY. Financing currency, here it was dollars, then it changed to NY. And retention of cash flows. This, the currency in which your operating cash flows are retained. Now some additional factors, degree of autonomy. So here it is an autonomous. Nomsara is an autonomous Parent is not controlling it. Volume of transactions with parent entity. So the directors of Nom Sara has its own, are autonomous. They are doing on their own. So what is the observation? See here, I have put it into table. Okay, just for your sake, I put it into table. What is my observation? What is the impact? Okay, but you all can write it in a step by form. Okay, don't put it into table. This is only and only for your understanding, guys. Okay, just my suggestion to you all is factor. You talk factor. What is your observation? What is your conclusion, ma'am? If we do not follow how your exam kit has solved, that's okay. That's absolutely okay. You will still get marks. They don't expect you to copy paste whatever you have studied. But if you write it in this format, no, they will give you marks. So when I talk about first factor, what is my first factor? There are three factors that they have given us: sales and cost, financing and independence. So sales and cost are mainly independent on what? Mainly denominated and settled in NY. They have mentioned. So it supports that NY is my functional currency. Earlier loan was in dollar and it is already settled. Financing is now generated in NY. So this suggests what? It is your what? NY functional currency. Independence. Board operates independently from parent. So indicates operational autonomy. You can operate autonomously. So with this we conclude that functional currency is NY because sales in NY, financing in NY, and Nom Sara operate independently of your this. So therefore correct accounting is functional currency under IS 21. Yes. Are we okay with this? Tell me, if you read your exam kit solution, they will tell you from first few factors it is not okay, we are not able to determine it. Then they will confuse you in the solution. Then they will tell you that if we look at these factors, the management can determine that NY is your functional currency. I'll be a little bit diplomatic but straightforward. Not very, don't just be over confusing. Sometimes what happens, so when the examiner is reading your answer, they might read only first part and they give you marks. So always give a conclusion. My suggestion is conclusion, because a lot of times I'm telling you, putting myself into examiner's shoes, you have hundreds of paper, guys, right? So a lot of times we read conclusions. So you focus on conclusion. Do not, just simply give your explanation. Every answer should be supported by conclusion. Every answer, every exhibit should be supported by a conclusion. Cool with this? The first exhibit is clear. Okay. Now adjustments to POD. So we first calculate our goodwill. So you remember our question. What is my goodwill? How do we calculate our goodwill? Okay. Yeah, this is seen. So what is I'll erase it. Scribbled a lot. So this is what? How much? 1.1 million consideration. Wow, amazing, sir. You're so smart. My consideration is $1.1 million. Okay. Now, if I convert it into NY, first you calculate in NY. So, what will be my consideration in terms of NY? 1.1 into 12. Yes. 1.1 into 12 NY. Okay. Now, what will be my this? This is already given. 1.5 million share capital. Net assets is what? 1.5 million plus 4.8 million. So tell me what are my net assets on the date of acquisition? Can you all help me with my net assets on the date of acquisition? My consideration is 1.1 million. I am doing in NY. First, we are discussing in NY. It's 1.1 million into 12. Your net assets is how much? 4.8. Where did I do that calculation? 4.8 plus 1.5. So what is my net assets? Can anyone help me? This is 6.3. 6.3 NY, and NCI they have already given. NCI they have already given 2.7 million. So we do this. We do the calculations. So what is my consideration? 1.1 million multiplied by 12, 13,200. NY in thousands. You all take NY in thousands because everything is in thousands. So we follow that structure. Now NCI 2.7 minus your net assets. So if you all get confused over here, you all can write over here 1.1 plus, 1.5 plus 4.8. Okay. So this will give me my goodwill at acquisition. Cool. Are we all okay with this? Now you will translate it using what rate? Translate it using opening rate. Now, what is my opening rate, guys? You see here. If you see the question, what is the opening rate over here? Opening rate is 12. Opening rate is 12. So you will translate it using opening rate 12. Everything will be translated using opening rate. So your goodwill will come what? Your goodwill will come to $8 lakh. What is my goodwill in a balance sheet? What is my goodwill in balance sheet? Can I say goodwill in balance sheet is 7,25,000? Yes, you remember the first adjustment, the balance sheet they have given us, the goodwill in balance sheet is how much? They have already mentioned us. Goodwill in your balance sheet is how much? 7,20,000. 7,25,000. Our goodwill is how much? 8 lakh. So goodwill is understated by how much? Goodwill is understated by 75,000. Goodwill is understated by 75,000. So goodwill must be first calculated in functional currency. Keep it as a, what we say, make it as a rule that whenever you're discussing, whenever you're solving a question on this, you will first calculate in functional currency only. You see any question, it should be first calculated in your functional currency, then translated. So don't simply jump at translation. So your working note, examiner will look at this working note, guys. This working note is very, very important. So first do this. So what is the error in the question? NCI was translated using opening rate. Closing rate, it should be translated at opening rate. So can I say there is an understatement by 75,000. So my goodwill is understated. My NCI is also understated. So goodwill is understated by 75,000. NCI is also understated by 75,000. So how do you adjust it? How do you increase your goodwill? How do you increase your NCI? Can you all help me with the journal entry? Can you all help me with the journal entry? Please tell me. Can I say I will increase to increase my asset? What do? You want to increase your asset and you want to increase your NCI. So what will be debited? What will be credited? Perfect. You will increase. To increase my asset, I will debit my asset. So I will debit my goodwill, and to increase my NCI, I will credit my goodwill. So both will be increased. 75, 75. So yes, perfect. So if I take you to the adjustment entry, so see, you put +1. +1 means this is the first adjustment. This is how I do. So this is my +1. All the plus will be adjusted. So my goodwill will be increased by 75,000. My NCI will also be increased by 75,000. So I will take you to the draft balance sheet that they have prepared. This is taken as a screenshot. Okay, I just took it as a screenshot. So you see, goodwill 7,25,000. This is a draft. This is already given to us. This will already be given to us. You will prepare one more column, and here you will say your adjustment is 75,000. So your adjustment is of 75,000. You will go to your NCI. NCI is already given 137.5 in your draft. You will increase it. So first adjustment, okay. Are we okay with the first adjustment? Perfect. Doubt? Any doubt, ma'am? Tell me. Any doubt, any question in this first part? First adjustment. So my first adjustment is done. This I will freeze it. I will freeze my first part of my adjustment. So you do it right away. Okay, you prepare the pre-populated balance sheet will anyways be there. This is not your duty, right? This will already be there. So go create one column and adjust it. Just adjust it. If you want to create in one adjusted column also, that is also fine. That's not an issue. But my recommendation will be go with this format. Why, ma'am? Because I will know, as an examiner, I will know my NCI has been adjusted. First adjustment has been given. So +1. This is my +1 adjustment. Okay. Now we go to the next part. Now impairment and translation of goodwill. So here you will have to impair and you will have to give the translation. So we will discuss this. What is my goodwill impairment loss? Can I say goodwill impairment losses of how much? 3,300 NY. 3,300 NY, 3.3 million. If you see in the question they have mentioned, it is 3.3 million. This part, second issue. So 3.3 million. Impairment is to be allocated now. So how do you do? Impairment is calculated at what rate? Average rate. So you will take your impairment. You will adjust it using the average rate. Now impairment, since NCI is at fair value, what is my impairment loss in terms of dollars? In terms of dollars is how much? 2,20,000 impairment loss. Now this is to be shared between parent and NCI. This is to be shared between parents and NCI. So can I say What is impairment loss? What is the journal entry we will pass here? This will reduce my goodwill. My goodwill, I will have to credit my goodwill by 2,20,000. Yes or no? I will have to credit my goodwill by 2,20,000. Now this 2,20,000 first will be impacted. Parent share 220. 220. What is my parent share? 75% and NCI's share is 25%. So can I say 65,000? 1,65,000 will go to group retained earnings. We will debit group retained earnings, and 55,000 we will debit NCI. We will reduce NCI. So can I say this is the journal entry we will pass? You will debit your group retained earnings by how much? 1,65,000. You will debit your NCI by how much? 55,000, and you will credit your goodwill by 2,20,000. Simple. This will not go to FCTR, ma'am. Why? Because it is an impairment loss, ma'am. Only translation reserve will go to your FCTR. Anything that you're translating as per IAS 21. This is not as per IAS 21, ma'am. Dakshineshwar sir, we are good. So let's go to our let's go to our balance sheet. Let's go to our balance sheet. I will go slow because we see how we adjust our balance sheet, right? So I will go to balance sheet. Can I say my goodwill, second adjustment, in my second adjustment, my goodwill will be reduced by 2,20,000. Credit goodwill. My group retained earnings will be reduced by 1,65,000 and my NCI will be reduced by 55,000. So this is how we will create another column. We'll just put these two figures, minus 220, minus 165, minus 55. Okay. So we are done with the second issue also that they wrongly did. Now translation of remaining goodwill. So how do you translate the remaining goodwill? You will take consideration. Now I've picked up that formula only. I've picked up that file only. That first working note that we prepared. Goodwill. So your goodwill at the date of acquisition what? Was 800. Goodwill at the date of acquisition was 800. Now there was an impairment loss of 3,300. 3.3 million. Yes or no? This will be translated using average rate. This will be translated using average rate. So your goodwill, goodwill after impairment loss. Goodwill after impairment loss in terms of dollar is how much? 5,80,000. Yes, 5,80,000. Goodwill as per goodwill in NY currency is how much? 6,300. Now this 6,300 has to be translated closing rate. Now at the year end when I'm preparing my balance sheet at 31st December, don't you think I will have to retranslate it to the closing rate? So this 6,000 up till year end, my goodwill in my balance sheet was appearing at what? 5,80,000. Okay. Now I will have to retranslate it to closing rate. So 6,300 divided by 18. This should give you your 3,50,000. Yes or no? So this in my balance sheet, goodwill is appearing at what? Goodwill is appearing at 5,80,000. Now it should be reduced to 3,50,000. So there is a loss, exchange loss of 2,30,000. Now madam, this goes to FCTR. This goes to FCTR. Yes, are you okay with this exchange loss calculation? Are you all okay with this exchange loss calculation? Please tell me. Yes. So ma'am, how are we going to do it? Your goodwill at acquisition. So exchange loss is of 2,30,000. This goes to your OCI. The exchange loss goes to OCI, translation reserve. So now they see this 230 again. This will be translated. This will be split between your parent and NCI, group and NCI. So what will go to our OCI? What will go to my OCI? 75% of this 2,30,000. Yes or no? Parent subsidiary, sorry, NCI will also take its share 25%. So NCI will also be reduced by this 25%, and this will be my total loss. So third adjustment. Third, I put 3 stars. Yes. Yes. So you will reduce your goodwill by 230. You will reduce your goodwill by 230 because my goodwill was 580. Now it should come to 350. I will reduce my NCI by 57.5. I will debit my translation reserve by 72.5. It is a loss. It is not a gain. Okay. So let's go and see my balance sheet. Third adjustment. Balance sheet, third adjustment. Goodwill will be reduced by 230, 582, 350 we have to bring it. Now my translation reserve will have a debit balance of 1,72,000 and my NCI will also be reduced by 57.5. Okay. Yes, Tejaswani ma'am, are we okay? Did you have issue in this point, ma'am? Tell me your issues. I'll take up your doubts. In the sum we solved in the class, we took entire gain goes to OCI. Entire gain, ma'am, it has to be split, no? Tell me which sum we took. There is a split, always a split, ma'am. So entire sum, I told it goes to OCI, but parent share, ma'am, parent share, only parent share. Are you getting me, ma'am? This will go to subsidiary. Loss, if you remember, I would have taught you every loss, every FCTR loss is to be split between group and parent. You tell me in which sum did I do it, I'll correct it and tell you. As far as I remember, we split the gain and loss between parent and NCI. Tell me, you help me with which sum? I mean, initially, see ma'am, this is a journal entry that we pass. No, you will credit your goodwill, you will debit your FCTR and you will debit your NCI. Are you getting me, ma'am? This is a year-end entry. This is not first year opening entry and the closing entry. Are you getting me, ma'am? We are doing it at the year-end only when you are preparing the financial statements. Okay. So are we now okay, ma'am? If that was a presumption that you would have taken, that everybody else would have taken, now are we okay? That you split it. So we adjust. The third adjustment is what? This. Dakshineshwar sir, we are good. So with this, impact on my balance sheet is also shown. Yes. Okay. Now we go to the third part. The next discussion, the loss. You know, the loss wrongly calculated. Now, translation of known star as loss. So, income and item statements are calculated using actual rate if it is given in the question, or at average rate if it is given, average rate. So, we don't have actual rate, we don't have idea of actual rate. So, we will translate it using what? Average rate. Throughout the year it is happening. So, the group incorrectly translated using closing rate. That is wrong. So, what is my loss? Loss should have been translated. If I translated my loss at average rate, that is 15, loss in dollars would have been how much? 60. But as per them, the loss is how much? Loss at closing rate is how much? 50. Are you getting me? So can I say they have understated the loss by 10,000? I translated loss using closing rate. So in my balance sheet, loss is appearing at what? 50,000. But ideally the loss is how much? 60,000. Yes. Are we okay with this point or not okay? Should I try another method of explaining you all this? Tell me. Yes. So we must increase the loss. If you increase the loss by 10,000, it will impact what? If you are increasing the loss of your subsidiary, it must impact your what? Yes. Perfect. Yes, Dakshineshwar sir. So this loss is to be allocated to your group retained earnings and also to NCI. You remember, sir, NCI calculation, NCI. So it will be allocated to group by 7.5 and your NCI 2.5. So what is the journal entry you will pass over here? You will debit, you will reduce your group retained earnings by 7.5 million. You will reduce your NCI by this, and this goes to your translation reserve. This 10 million goes to your translation reserve. Why ma'am translation reserve? Because it is a translation of your loss, right? From 9 lakh to your $60. Are we okay? Tell me. Are we okay with this working note? Tell me, ma'am. I'm waiting. You take your time. You process the question and hit me up with your notes. I'll not go anywhere. Whatever is bothering you, even if it's stupidest, I'm telling you, you have my guarantee. Even if it is very, very stupid, you have my all my time. Okay, so you will translate it. So exchange loss is to be given. So ma'am, how do we do it? Let me show you the draft balance sheet. Let me show you the draft balance sheet. Can I say this translation reserve will increase This is a loss translation reserve. It will increase. Now it will be translated to 7.5 will go to your group retained earnings, and 2.5 will go to your this. So you debited your group retained earnings by 7.5 million. You debited your NCI by 2.5 million. You will reduce them, and this 10 will be your this. Are we okay? So this is our P&L impact translation of this. Everybody is okay? Now we go to this part. Now exchange loss on Nomsara. So how do you calculate your exchange gain and losses on Nomsara? So you see, what are my opening net assets, guys? What are my opening net assets? 6,300, 63,000. If you remember, 6,30,000, whatever it is. 6,300. If I take it in thousands, yes or no? Opening, you remember we calculated using our this rate, opening rate. Now this is to be calculated using opening rate. What are my loss during the current year? 900. So can I say my closing net assets are 5,400? Simple. Are you okay with this part? Let's not get into this. Are you all okay with this part? Yes, opening and closing. Now this will be translated using opening rate. This will be loss for the year will be translated using average rate, and this closing net assets will be translated using closing rate. Yes, so this will give us a loss. This will give us an exchange loss. Your opening net assets were supposed to be how much? Your opening net assets your net assets without exchange loss should have been how much? 525 minus 60. This gives us how much? Can you all help me with the number, please? 525 minus 60. This is 465. This comes to 465. Yes, but my after translating, it is coming to how much? 300. So can I say there is an exchange loss of 1,65,000? Now again, exchange loss on translation of reserves. This has to be allocated. Yes or no? Exchange loss. They mentioned in the question that they have not given NCI its share. The whole has gone to your in FCTR. You see over here in the question they have mentioned. The last part of the question. They calculated. Firstly, they wrongly calculated. So their loss was 1,75,000. We corrected it because they took loss at closing rate. They took loss at average rate. So that is why their translation reserve was overstated. Our loss has increased. So our loss is 60. So our exchange difference has come to 1,65,000 because after adjusting the loss. Now this 1,65,000 has been included in translation reserve, but we did not make entry to NCI. We did not give NCI its share. That is wrong. All the translation reserve are to be split between NCI and our FCTR. Yes or no? So we solve this question now. We give NCI its share. We give NCI its share. So what is my exchange loss? This 1,65,000. I will give NCI its share 25% into 1,65,000. 41,250. Now the entire loss is wrongly recorded into translation reserve. So you will do what? You will remove. You will reduce your translation reserve, and you will increase your translation reserve, and you will give NCI its share. You will debit NCI and you will credit translation reserve. So the last adjustment entry you see over here, 41.3. I will reduce NCI by 41.3, to 41.25, and I will increase my translation reserve. Are we okay with this? So my translation reserve was understated by loss. So I will increase my translation reserve by this, and I will adjust my NCI. So with this, you will have the adjusted figures. With this, you will have the adjusted figures. Your 350 retained earnings will be adjusted. Your NCI will be adjusted. Rest everything they have done correctly. So tell me, are you okay with this part, draft balance sheet, and this part? Are you all okay with this draft part? Now, Tejaswini ma'am, you hit me up with your notes. What areas bothered you? What are the areas that bothered you, ma'am? Tell me. I'm here for your help. Everybody, both of you, hit me up with your doubts, whatever are the areas. Then we'll go to the next part of your question. Then we will discuss the next part of the question. Tell me all the doubts that has happened or everything that has bothered you. Why were we finding it difficult? What went wrong while we were solving it? Join. Okay, Tejaswini ma'am, did you understand this part? Ma'am, you joined right now. So ma'am, did you understand this part, ma'am? 41.3 adjustment, ma'am, balance sheet adjustment. Did you understand this part, ma'am? Yeah. Now ma'am, my question to you is, what are the areas that bothered you during this question? Tell me. I will address it so that we have some, a mechanical solution to that. For example, ma'am, this bothered me, FCTR bothered me. So I can, address that issue to you. The fourth journal, why group retained earnings? Fourth journal entry, why group retained earnings? What is my fourth journal entry? This one, ma'am. This one are you talking about? Yes. Why not group retained earnings? Where else will you adjust? Loss? No, ma'am. Loss made by subsidiary. So it will reduce our retained earnings from group retained earnings. Are you understanding, ma'am? Where do you adjust the loss? Post acquisition reserve, ma'am. See, ma'am, anything that is technical, anything that is the technical, the heart of your what we say, consolidation will be adjusted, will be doing that way only. FCTR is only translation reserve, ma'am. FCTR, the name itself says foreign currency translation reserve. Anything that is to be translated from functional currency to the presentation currency will go to FCTR. Here, ma'am, are we translating anything? This is nothing but extra loss. Okay, let me tell you. This 10 million is what? Is it a translation loss? Is it a translation loss? No, right? My loss in my balance sheet, nothing about it. In my group retained earnings, I should have recognized a loss of 60,000. I should have reduced my post acquisition reserves by 60,000. Are you getting me, ma'am? But I reduced it only by 50,000. Imagine, ma'am. Let me simplify this. Let me put it into the story. This is me. Okay, this is you, Tejaswini. Okay, now let's say your profit was you made a loss of 50,000, not 50,000. You made a loss of 60,000, ma'am. Okay, but in my books, while I was consolidating you, I consolidated the loss of only 50,000. Don't you think my books are understated? In my books, the loss is understated. Yes. Ideally, I should have consolidated the full loss. Madam, you made a loss of 60,000. I should have taken the loss of full 60,000. Now you remember, let me take you back to your consolidation adjustment. This post-acquisition reserve, this is a post-acquisition adjustment. Ma'am, this post-acquisition adjustment, you take whatever is my share, parent share, you will adjust it into parent's group retained earnings. And 75% you will adjust it into your NCI. Let me take you back to your, here it is a loss. If it is a profit, if it were a profit, what we would have done? Add NCI. Add NCI's share of post-acquisition profit. Again, you remember our profit calculation, group retained earnings working note calculation. We used to calculate NCI's post-acquisition profits, and we used to give in our goodwill working note, in our group retained earnings working note. Let me show you like this. This was my parent. This is subsidiary. So I would take my subsidiaries closing this 5,400, what we say, to FCTR and NCI, but later this is initially we are taking the exchange loss to FCTR. Ma'am, we are not, we are adjusting. Exchange loss will always go to NCR, FCTR, ma'am. FCTR, exchange loss will always go to FCTR. Are you getting me? FCTR and NCI. And this translation, this is not an exchange loss, madam. This is my pure loss, ma'am. This is not my exchange loss. I'm not translating it. This is basically, I am taking my loss. I am taking my share. If 900 lakhs NY in dollars is how much, ma'am? 900 NYs in dollars is coming to how much? $60,000. So I'm just first adjusting this only, ma'am. I'm adjusting this only. Are you getting me, ma'am? Okay, now let keep your doubt aside. Keep your doubt aside. Just let me understand. Let me make this. Let me understand. Let me put this into words. Let's understand. Both your book and my book is into dollars only. You are preparing your books in dollars. I am also preparing my book in dollars. You have made a loss in the current year. You made a loss of 60,000. Okay, this is my post acquisition. Can I say this is a loss of current year post acquisition reserve? So what we used to do in our group retained earnings, parent and subsidiary. So in my group retained earnings balance sheet, working note, what I used to do, I would take 60,000, multiply it with what? 75%. I would add it to my group retained earnings. Yes, if it is a profit, I would add it. Agreed? Yes. If it is a loss, what will I do? I will reduce it. Profit will increase my retained earnings. Loss will reduce my retained earnings. So it is a loss. 9 lakh is a loss. So can I say it will reduce my retained earnings? Ideally, my retained earnings should have been reduced by what amount? 60,000 into 75%. Give me the value 60,000 into 75%. 45,000. Yes, ma'am. My retained earnings should have been reduced by 45,000, but because of wrong translation, I have taken your loss at 50,000 only, ma'am. So it means what? I reduced my retained earnings by what amount, ma'am? Tell me. Can I say 50? 50 into 75%. Can I say I reduced my loss by 37,500 only? So what is the additional reduction that I need to do in my retained earnings? What is the additional reduction I need to do? 7,500. That is what we did, ma'am. That is what we did. Yes or no? First, this is my simple consolidation adjustment because I'm reducing my loss, right? So I will reduce my loss. Then I will give NCI its share of additional loss, and this goes to translation reserve, ma'am. This goes to translation reserve. Okay. Another doubt, that OCI thing. What OCI? So, ma'am, this will be plotted. You remember revaluation surplus? Revaluation surplus, ma'am. What do we do with revaluation surplus? It goes to OCI. Yes or no? I debit my PPI, I credit my OCI. OCI is sitting where? In my balance sheet in the name of revaluation surplus. Yes or no, ma'am? So like this, whatever is my translation reserve, whatever is your preconceived notion so far, whatever assumptions we have, if I made a slip of tongue during that time, I don't remember what exactly did I tell you, but let me put this into words. Let me just mechanically put this into words. If there is a translation loss or a gain, that has to be split all the time, be it opening reserve, be it anything, that has to be split between NCI and group retained earnings. So what, sorry, not group retained earnings, group, don't, you will again get confused. Whatever is exchange loss, it has to be split between NCI and group. So group share, think of it like a revaluation reserve. Group share will sit into FCTR and NCI will debited and credited by whatever nature. Okay, if it is a profit, NCI will increase. If it is a loss, NCI will decrease. Are you understanding, ma'am? In drag and sum, we calculated exchange loss. It was mentioned because before the calculation and profit and loss. In drag and sum, full calculated exchange and gain and loss was mentioned in OCI. Yeah. So think of it like this. Okay, if you like it that way, I will put it that way. I will calculate my translation reserve. Okay. What will I do? Let me show it this way to you. If you like it that way, we can do it. See, here my goodwill. Here they have directly moved to it. So what? Here we calculated this goodwill loss, right? Now, ma'am, see, if I tell you first adjustment, if you like it that dragon way, very simple. What did I do here? There's an exchange loss. So I will debit my FCTR and I will credit my goodwill. 230. Now this FCTR, this is not fully, if you remember that sum, I clearly remember that sum, we have given the loss. I told you this goes to OCI. Yes, this goes to OCI, but only parent share. If you go and solve that dragon sum, ma'am, see in the working note in the below, while calculating this loss, I would have shown the parent share goes to OCI and NCI share also. While preparing the NCI working note, if you remember NCI working note, we would have reduced it, NCI loss, we would have given NCI share, gain or loss, whatever it was. Are you getting me, ma'am? So this part, NCI's part, I mean the total loss goes to FCTR, that will sit into a different reserve in the name of FCTR, and NCI will get its share. Then you do what? You debit your NCI and you credit your FCTR. The net adjustment is same, but don't pass this journal entry because this is wrong. Full loss never goes to exchange gain and loss, fully never goes to parent. It has to be split always. Are we okay? I thought it was a good idea to take it at earlier stage only. If I would have taken at 115, we would have taken more than 2. Are we all okay? Same sum. How would you adjust in PNL, ma'am? In PNL, where it will go, ma'am? In PNL, you tell me one thing. In PNL, where it will go? This NCI, this FCTR loss. This will go to my OCI, ma'am. Yes? Yes. Now NCI, this will reduce my NCI balance. This is my NCI is a balance sheet item. Yes or no? This will reduce my NCI. So NCI is anyways a balance sheet item. So only OCI. This you will your share of loss. You will show in OCI. That's it. Okay. Any more doubts? Now we are left with the last part of this question. Dakshineshwar sir, any doubts? Any questions? So ma'am, Tejaswini ma'am, can I say now are we good? Now do we have a clarity, ma'am? I hope this sum helped you. Yeah. So I am planning, I will have a word with the team. I want to meet you all on 30th of May to discuss all your question answers. So if at all you give me your choice of questions, I will do that. If you don't give me your choice of questions, what will I do? I will take my whatever I find difficult, whatever in my opinion are difficult. See, if I would have taken this, if I would have scanned the exam kit, I would not have picked this question, because for my in my assumption this would have been a simple question. I would have felt this is manageable. But what I feel is, what difficulty you find and what I find it difficult can be a different scenario. So if there's a question that you all find difficult, tell me. I want to meet you all for 6 to 7 hours. I will plan the day. We'll start somewhere around 10-11 in the morning after you have a breakfast, until evening. You all will get a lunch break. I would definitely want to meet you all like that. So we just solve questions. So next few days you only practice question. So 2-3 days you will have in your hand, just practice question. So I want to meet it that way. I want to plan something like that. It can be an extended session also. If you all are okay, I will have a word with the team. Tell me, would you be okay? Dakshineshwar sir, you are appearing in September, but still, if you can meet, definitely it will be a great help. Tejaswini ma'am, you tell me, would you be okay if we plan that? If possible, can you mention the list of questions beforehand? First, my recommendation is you all only give me. Otherwise, I will tell you these questions have been picked up by me beforehand. If you all tell me that, ma'am, these are the areas that we find difficult, my recommendation would be you give me, ma'am. I told you no, because if I were you, if I were to pick a question on my own for this marathon session, I would not have picked this up, because I do understand that what you feel, what I feel can be a difficulty. The difficulty level for you and me can be a different thing, right? What I like, what I understand easily, what you understand easily, may be a different scenario. So recommendation is you give me, so that I prepare my own notes, I solve it in my own way, and I share it with you all. If you do not have that much of time, or if you all at all forget, I will prepare my list. There are few questions that I feel are very important. There's one mock test question from your exam kit that I definitely want to pick that up. So I will pick that up. Cool. I will have a word with team. I meet you all on 30th of May. I think that's Saturday or Sunday. I'll meet you all on that day. So you all can spend your next 4 days in discussing. So we discussed the last part of this question. I hope I was able to address your doubt. I hope I was able to simplify the areas that you were finding difficult, ma'am. Okay. So now I have here I have given you a list, sir, ma'am and sir. I've given you a list that you can use in your normal calculations. Okay. I mean, this is not recommended to prepare, but this I gave because I feel like you should know that these are the areas that should be adjusted in my balance sheet. So what is my adjustment and what is my impact? Increase goodwill, increase NCI, reduce goodwill and translation reserve. So like this I've given your with the impact, so that if you're just solving it even without the video, you should be able to address it. So here, revised statement of financial position, I have made the adjustment in one go only, in one column only. I prefer this way, but I thought I should give you all that. I should teach you all with that book material, plan kit material. If you all can make the adjustments like this, but give a reference note, that is also fine. If you're adjusting in one column only, if at all you're doing it, my recommendation is give a reference note, because I won't understand what is 75, what is 20, what is 30. So refer working note, this and that. But recommendation is add columns only. So I've prepared these working notes for you all. The adjustment, you all can go through it. That will help you. Now, may I know what is the name of the question that you found a little important? Let me go home and tell you, ma'am. I don't remember exactly the name, but I remember it is a mock test question. In my when I was in Mumbai, I discussed this question in one of the exam kits. It is in the exam kit only. I think it is mock test. You remember, you know, right? Towards the end, there are 3 mock tests in your exam kit. So there is one mock test question. One of the mock tests where the calculation of NCI is difficult. I will give you one hint. They had given a P ratio. They had given P ratio, and I think they had also given EPS also, something like that. So that is one of the important, if you can find out, anyways, I will go through it and I will see in my exam kit. I don't remember exact number and name, but all I remember is it had P ratio, and it also, from this P ratio, you were asked to calculate fair value of NCI. So that I feel I should address it in the class, because a lot of us are not done with AFM and FM. So yeah, so far are we good? So you all please go through this working note. I have shared this working note. I've split all of the adjustments that we did into multiple parts. Now the last part, changes in government regulations. What is the impact of changes in government regulations? So see, whenever if you remember, Dakshineshwar sir, when I started off my discussion, I told you, sir, if there is a question on consolidation, you please give the definition of control blindly. Please, it contains marks. This definition contains marks. So please, even if you are reluctant about, ma'am, what will be the conclusion and all, that's okay. But this contains marks. Please give a definition. If there is something that has a definition, please give a definition. So what is the definition of control? Power, exposure to variable returns, and ability to affect those returns. So you give a definition that if you have these three things, you have control, and if you have control, you consolidate it. So what are the effects of government restrictions? What are the effects of government restrictions? Restriction on transfer of fund alone do not automatically remove control. You remember our first discussion, the first class of our consolidation, it does not automatically remove the control. So you do what? You do not deconsolidate, you do not remove it from consolidation. However, if government regulations limit decision-making power, limit our governance right, prevent participation in key activities, then control may be lost. So you be a little bit diplomatic over here. If it limits any of these, then the control may be lost. You pick these lines, ma'am. Where do you pick these lines from? Picked up from question. Not my lines, pick it up from question. So if control is lost, peony must do what? Derecognize subsidiaries, asset and liability. We know the derecognition adjustment. How do you deconsolidate a subsidiary? Derecognize goodwill, derecognize NCI, recognize this disposal on P&L. Disposal loss and P&L. So there are possible accounting treatment. You may have lost control, but still you have significant influence. So here I'm being diplomatic. We are being diplomatic in the question. So if peony still has all this significant, remember the definition of significant influence? So you put all this. Journal and loan was troubling me, ma'am. Rest, I'll make use of recordings. Thank you. Ma'am, that's okay. I'm telling you, have doubts, tell me. If possible, I'll tell you my schedule also. My schedule is 4:30 to 8:30. Every day I have a class 4:30 to 8:30. This weekend alone I'm not here. If you have a doubt, tell me. I will have a discussion with the team. I will meet you all somewhere in between and I will take your doubts. I'm telling you, as I promised you all, till 4th of June I'm with you. Like LIC. After completion of syllabus also, and while completing the syllabus also, I'm there with you. It was a joke, bad joke. So this time I will not be able to meet you. In this time I will not be able to meet you. But if, let's say, ma'am, we can't wait till 30th of May. In between, can you catch up with us? So in between, I can catch up like this. We can meet early in the morning. If the class is available, I will have a discussion. Ma'am, there are doubts. I can definitely reach out to the team for this, for your issues. Okay. So if it is like this, tell me. I will address all the questions. Make a list of questions. Talk to your friends if they are finding it difficulty. When we go to the exam hall, we should go with the satisfaction that we know everything. Okay. So yeah, we go to the first scenario, that there is a significant influence. You give the definition of significant influence and you say if there is a significant influence, you will recognize it as a significant associate. So what will be the accounting treatment? You will account it using equity method. IS 28 will be applied and you will recognize in group's account. Group share of profit will you recognize. Scenario, significant influence is also lost. Then what do we do, sir? If significant influence is also lost, then it is merely your financial asset. You will recognize as per IFRS 9 fair value and revaluation at each reporting date. Are we okay with this, sir? Tell me, are we okay with this sum? Yes. Tell me if you have doubts. Dakshineshwar, sir. Okay. How was the sum? Easy? I'll just take 2 minutes break for my throat. How was the sum? Was it easy? Manageable? How would you rate this sum? Difficult, easy, manageable? Okay. Now this was a good sum. Manageable, yeah, manageable. Sir, in this sheet also, I've given you a sheet. Towards the end, you will find a sheet where you will find what goes where. There is a scope of confusion. I've tried to reduce what goes where. Now I have hardly 30 minutes more. What chapter you want me to discuss, sir? Tell me, you only tell me. Because I won't be able to cover a lot of chapters. The whole group accounting will be left. But anyways, we'll cover that with sums 30th when we meet. But tell me, what chapter do you want me to discuss now? Employee benefits we did yesterday, no? Any particular chapter that is your difficult area, I will pick that up. I'll tell you what I'm left with. We have ethics that I wanted to discuss with you. We have this group accounting, group cash flows and all. Tell me, you only tell me what sum should I pick up, what chapter should I pick up? Cash flows? Okay, we pick up cash flows then. Introduction. IFRS 18 is done, no? So, group statement of cash flows. This only I will be, I thought a lot, we'll be able to cover, but then again, restrictions, time restrictions. So, sir, we are doing here group statement of cash flows. I'll just bring it over here. Now, what are we going to discuss here? All the working notes. I've tried to prepare notes in a way that all the working notes are covered. All our working notes are covered. So group statement of cash flows, you all can go through the mind map whenever you want. What is it? How do we do it? It shows movement in cash and cash equivalents during the year. Now, what are the components of cash flows? We have operating, we have investing, purchase and sale of NCA. If you remember our which definition? Definition as per IFRS 18. It mentions profit, income and losses from your income and losses from assets generating returns independently. If you see IFRS 18 definition, investing category is what? Profit and loss from assets generating independent return. But here it is what? Purchase and sale of NCA. So this is an important point that you need to take. Financing, capital and borrowings will come into picture. Now there are two methods, direct and indirect method. Mostly we will take with your direct method only. Now it starts with what? Profit before tax. Now because of this adjustment, it will start with your operating profit. We start with what? Operating profit. Adjust it over here. This was this. Now, what is the group principle over here? Group statement of cash flow you prepare as if it is a single economic entity. You do not segregate parent and subsidiary. So remove all the intra-group cash flows. So what is the structure of your group cash flow? Operating, investing, financing, net increase and decrease in cash, then opening, and you compare it with the closing. This two you compare, it should ideally bring your closing balance. Now what comes under this? Not PBT, it is operating. Okay, so usually this is the largest section and very important. Includes investing activities, includes what? It includes PP, purchase and sale. It includes acquisition and disposal of a subsidiary and associate and investment. Now financing, what will include over here? What will come under over here? Shares, loans, lease liability and dividends. Now cash and cash equivalents. What is the meaning of cash? Cash, bank and short-term highly liquid investments. So see under here, liquid, if at all they test you on cash equivalents, one thing that we need to remember is, sir, over here is that what comes under this? Anything that can be translated, that can be not translated, I'm just too much into IS 21, anything that can be converted into fixed cash into fixed cash without change in value, without significant risk in change in value. So if something is like that, then and only then it will come under cash equivalent definition. If it meets the definition of this, and then and only then your investments, short-term investments, will be classified as cash equivalents. That is why your financial instruments, but financial instruments, no, your equity instrument is not your cash equivalent. I'm talking specifically with cash equivalent perspective. Equity instruments are not our cash equivalents. Why, ma'am? Because here there is a risk associated. There is a risk of change in value. Your value of equity instrument is subject to fluctuation. So equity instruments are not your this. Any short-term bonds, any short-term government bonds and all, those will come under your this. Okay. Now operating activities, the main working note. Please don't take this operating. So you take consolidated operating profit. I will adjust this. You take consolidated operating profit. You add back all the non-cash adjustments. You add back what? All the non-cash adjustments. So you add back your depreciation, you add back amortization, impairment, loss on disposal and any finance cost. See, now because of IFRS 18, now see, this is a normal structure of your P&L. But see, understand, this is now that we are taking our operating profit, this part, this finance cost will not be appearing in our operating section. This will not come under our operating profit. Are you getting me, sir? This will not come under our operating profit. So this is, the previous, before IFRS 18, our cash flows were prepared like this because we used to take profit before tax. So So you will add back all your non-cash expenditure, depreciation, amortization, impairment, and loss on disposal. Ma'am, loss on disposal will not come here. No, ma'am, loss on disposal will not fall under operating category. But if you have forgotten, loss on disposal on your PP and all will go under operating category as per IFRS 18. So you will add back. If there is any other impairment, loss and all, that will come into picture. You will deduct non-cash income. What is my non-cash income? If there is a profit on disposal, investment income, anyways, if it is given, then it will come. If at all it is added to your operating profit, it will come. And share of profit of associate, anyways, is your investing income. So if there is a non-cash income, you will deduct it. So for example, my depreciation is 10 lakh. I will add it back to your profit. Now, working capital movement. If there is an increase in receivable, you will add. If there is an increase in receivable, you will add. If there is an increase in inventory, add. If there is an increase in payables, deduct. Okay. Sorry. There's something wrong with this. Sorry. I'll take this up. Okay. This is this one. If your inventory increases, there's an outflow. Okay. Minus. No, don't. My bad over here. This is a wrong over here. This working note has been wrongly calculated. I will adjust this. See, if there is an increase in inventory, there is an outflow. You will do what? You will less. If there is a reduction in your receivable, there's a decrease in receivable, there's an inflow, you will add. And if there is an increase in payable, it means what? There is an inflow, so you will add. So you will do what? How are you going to add it? You will, what is the formula? Opening minus closing. Ma'am, how do we find out this? So forgive me for this working note. This is a mistake made over here. I will correct this mistake. So how are we going to, ma'am, calculate this working note, ma'am? You will compare your opening minus, I will update this working note and give it. You will compare your opening and closing. You will compare your opening inventory, you will compare your closing inventory, and you will add and less. If your inventory, I will simply put it this way. If your inventory and receivable are increasing, there is an outflow. If your inventory and receivable are decreasing, there is an inflow. And if your payable is increasing, there is an inflow. If your payable is decreasing, there is a outflow. So if it is an outflow, you will reduce it. If it is an inflow, you will add it. Then apply the cash logic. If it is an outflow, add it. If it is an outflow, less it. And if there is an inflow, add it. Now classification. Interest IAS 7. Interest and dividend classification. Just 1 minute. So interest paid. Is it an operating? Yes. Interest paid, operating, financing, investing. No. It can either be your if you are a bank, it can be your operating. And if it is your if you are a normal company, it can be your financing. Interest received can be your investing or operating. Okay. Dividends received will be your investing or operating depending on your nature of business, but majority of the time it will be your investing only. Dividends paid will be your financing. Dividends paid will always be your financing. It can never be your operating and investing. Now follow the question policy consistently. What is the main business? See, at SBR level, they will not bring your cash flows for bank and all. Okay, so bank and all cash flows will change. They will just simply give you. So just understand, if I have paid interest, it will be your financing. If I have paid interest, I will just simply put it in the normal question formula. If I've paid interest, it will be a financing category. If I've received interest, it will be an investing category. If I've received dividend, always investing category. And if I've paid dividends, always without any headache, it will always be my financing category because cash outflow. Now tax paid working note, you will take how are we going to prepare our tax paid working note? Opening tax payable, compare it with the closing tax payable if there is an expenditure. Now simply I will just discuss the working note. Opening tax payable, this will be given in your balance sheet. Closing tax payable, tax expense, this include both, okay? Current tax and deferred tax. Even in this include both current tax and deferred tax. Okay, now I hope you know what is current tax and deferred tax. So include both, compare it with the closing tax. The balance, the difference is nothing but your tax paid. Tax paid is what your outflow. Tax paid is what your outflow. Now, for example, my opening tax payable was this. Current year tax expenditure was this. Closing tax payable is this 15. So the difference is nothing but tax paid during the year. Now, investing activities, there are some main working notes of your investing activity. Purchase of a PP. How do I find out that we have purchased a PP? So you will take opening PP. Opening PP. I will just show you how the ledger will flow. I will take what? Opening PP. Okay. I will add purchases. I will add acquisition. Ma'am, what do you mean by acquisition? If I've acquired a subsidiary, I will take subsidiaries PP also. Minus disposal, minus depreciation. Now here disposal you will take book value. Okay, disposal, reduce it at the carrying value. Minus depreciation, minus closing balance. Minus closing balance. The balancing figure will be your purchases. The balancing figure will be your purchases during the year. Use cash purchases only. This is a very, very important rule. For example, PP acquired through share, no cash flow, you will not include it. You remember one question of BPP material where there was a foreign exchange gain and loss on your PP. We added it back because of your, we did not include it in this because there was a non-cash increase. So if it is a non-cash increase, you do not add it. You do not take into consideration. Now, sale of PP, cash proceeds shown as investing inflow. So if you have sold, if you have sold PP, there will be a cash proceeds. It will be shown as your investing. So what is a disposal working note? Your book value disposed, profit on disposal. This will be your disposal proceeds. Generally, most of the time, the question will tell you, the question will be specific about your sale proceeds. The question will tell you what are your sale proceeds. Now, purchase of a subsidiary. Consideration paid. Whenever you acquire a subsidiary, this is an important adjustment. This is a very, very important adjustment. Net cash outflow on purchase or acquisition of a subsidiary. When you acquire a subsidiary, sir, the consideration paid minus any cash acquired. See, let's say I am Surbi and I have acquired Lakshya Limited. So there will be an outflow, consideration paid, there will be a cash outflow, but I will also get Lakshya Limited's cash, right? So I will show only net cash outflow. The cash acquired of subsidiary will be reduced. Likewise, if I'm disposing subsidiaries, I have a subsidiary Lakshya Limited, I dispose my subsidiary, I will get a cash inflow. I will receive a cash inflow, but whatever is the balance, cash balance of subsidiary, that will go away from my balance sheet. So I will reduce it. So for example, I paid a purchase consideration of 100, cash in subsidiary is 20, so net cash outflow is 80. Important rule over here, only cash consideration, very, very important. Here a lot of you all will make mistake. There was one question, I don't remember, was it there in BPP or not? There was here the consideration can be of two types. Not two types, can be of multiple types. Consideration, cash consideration, deferred consideration, share consideration. So you only take cash consideration. Okay, you do not take any other consideration because we want to find out the net cash impact. Now, disposal of a subsidiary, you take sale proceeds minus cash disposed. Whatever is a cash balance of subsidiary, you will minus it. That will be your net inflow. Okay. Now, associate and JV working note. Associate, if you have purchased associate, it is your investing outflow. Dividends received, it is your dividend received is your investing inflow. Share of profit of associate, you will remove it from the operating section because it is not a cash. You remember we add back. If you remember in my previous working note, I was telling you, see, in operating profit, we are not going to, if you're taking operating profit, it won't be there in that profit. But previously we used to take profit before tax. Okay, so in profit before tax, we used to add it. Why? Because it is your non-cash. Now, financing section, what are the main working notes here? You will take closing share capital. You will compare it with the opening share capital. If your share capital, now you see the balance sheet. Now you need not do the working note of this. If you see your share capital is increasing or decreasing. If your share capital is increasing, it means what? there is a share proceeds. You have issued some shares. So if you have issued some shares, there will be a cash inflow or outflow, sir. If I may ask you, if a company issues shares, it is a cash inflow or outflow? Inflow. Perfect. So you will, it is your cash inflow. But at this level, I doubt if there will be a very difficult question. But if there is a bonus issue or share exchange and non-cash, then you will have to adjust that. Barely, I doubt at this level they will ask us. Now debentures and loan. Likewise, we will adjust for our debentures and loan. So opening balance, add if there are any new loans minus repayment. This will give you your closing balance. Lease liability, only principal repayment is a financing outflow. Interest, operating or financing. So interest usually, I mean, depending on my nature of business, now the question can be of any type, right? So interest is usually my financing. If it is my financing, if it is not my main business activity, then it will be in my financing section. It will not impact my operating profit. But if my main business is like that, then I will have to check. Now dividends paid. Ma'am, how do we find out dividends paid? See, understand, here dividends paid will be your retained earnings working note. Okay, it will impact your retained earnings working note. So see, if you can find out, if there's a, I mean, not can find out, if in your balance sheet there is a dividend payable, if in your balance sheet dividend payable is appearing, then normal dividend opening and closing dividend we can do. But if generally most of the questions, there will be a retained earnings adjustment. So I will tell you, ma'am, how do we find out dividends paid working? Okay, see, I will take my opening retained earnings. I will give you some number, 1000. My opening retained earnings are 1000. Profit during the year, I will add profit during the year. So let's say I made a profit of 200. Ideally, my closing retained earnings should have been 1200. But see, if my closing retained earnings are 900, usually if there is a dividend working note, there will be a difference in your closing working note. So this is my closing RE. So the difference between these two, difference of 300 is nothing but dividend paid. This difference is nothing but your dividend paid. Are we okay, sir? Now, important rule, only parents' dividend in your group cash flows. You will take only parents' dividend. NCI dividends are shown separately. It will be adjusted in your NCI. Now, NCI transaction, dividend paid to NCI. If you have paid any dividend to NCI, it is your financing outflow. Purchase and sale without losing control, again it is a financing activity. Now adjustments, group adjustments, intra-group adjustments, ignore all intra-group cash flows. So for example, if there are any intra-group sales, any intra-group dividend, intercompany loans, that will be removed, just like your consolidation. Unrealized profit, your unrealized profit affect your retained earnings and inventory, so no direct cash flow adjustment. Foreign exchange differences, separate reconciliation item. You remember there was one foreign reconciliation item. So you adjust, if it is a foreign, it is usually a non-cash. So you adjust your profit and loss accordingly. Acquisition and disposal, yes. Non-cash transactions, share, this is ticket. We have understood this. Acquisition and disposal of a subsidiary. Consolidate. Yeah, so here there is a summary of summary. I've given a small summary of summary. You can go through that. So tell me, so far so good? Okay, so now we have only 15 minutes left. And I doubt if I can take any more chapter in just 15 minutes. If we can take any chapter in 15 minutes. Okay, I'll do one thing. I'll quickly, without going through the notes, I will quickly revise joint arrangements. Okay, joint arrangements, because that is also a small chapter only. Hardly it should take 10 minutes. We'll quickly revise. Hardly, sir, I'll take 10 minutes of your time. We'll quickly revise joint arrangements. Remaining chapters will be difficult for me to cover. Now, joint arrangement. Ma'am, what is a joint arrangement? Here, two or more parties have a joint control. You and I have a Joint control. Let's say you and I started a company. You have 50% stake, I have 50% stake, joint control. So joint control, usually there's first thing, contractual. There has to be a contract and there has to be a control. Decisions about relevant activities require unanimous consent. Ma'am, what do you mean by unanimous consent? Even you should give a consent and even I should consent. If there is a unanimous consent, then and only then we say that there is a joint control. And what is the meaning of unanimous? All the parties sharing the control must agree. Even Dakshineshwar sir should agree and even Surbi should agree. So for example, A has 50% voting right, B has 50% voting right. Important decisions require both the parties, joint control exists. So if there's a question on joint arrangement and joint control, they will definitely tell you whether the question will give you an indicator. Any important decision will require both Dakshineshwar sir and Surbi's consent. So joint control exists only if no single party can control the arrangement and alone. So if the question is taking you to a direction where only Surbi can control, then it is a normal consolidation adjustment. If only Dakshineshwar sir can control, if both can, either of them cannot individually control any transaction, then and only then there will be a joint control. So what are the types of joint control we are going to discuss? Joint operation, IFRS 11. Joint venture, IFRS 11 plus IAS 28. So basically joint venture accounting definition has been defined under IFRS 11. Accounting is as per IAS 28. Now ma'am, when do you classify joint operation? Parties have rights. When do you say that it is a joint operation? When we have rights to both. Rights to assets and obligation, both assets as well as liability. So let's say we have created, let's say Dakshineshwar sir, we have created Surbi and Dakshineshwar sir a company. We have created a company, Surbi and Dakshineshwar. Not company. We have a temporary arrangement over here. Now here in this company, we will have an asset to net asset. So see, let's say Dakshineshwar sir, you are a master of AFM. I teach SBR. So what happens? You and I both coming together for a temporary arrangement where we will conduct marathon sessions where you will teach AFM and I will teach SBR. So here it is a temporary arrangement, sir. So this temporary, let's say we booked a classroom. So all the assets of the classroom and all the liabilities of the classroom, I will have my share in assets. You will have your share in assets. I will have my share in liabilities and you will have your share in liabilities. So if it is rights in assets and obligation for liability, then it is a joint operation. Joint operation, we have rights to net assets only. That's it. That's the only thing that you remember, that you need to remember. In joint venture, only net assets. It means what? You and I create a company. So if we create a company, we have a right in equity only. More than equity, we don't have any right. Everything belongs to that company. So for example, if we create a company, let's say you and I create a company. So here we will have right in the equity only. Whatever equity share, whatever equity is of our share. Other than that, the assets and liabilities of this company will belong to this company only. Then it is our joint venture. So decision process for this. If it is a separate vehicle, usually a joint venture. If it is not a separate vehicle, not a separate identity, separate entity, then it is usually a joint operation. Contractual terms. So understand who owns assets and who is responsible for liabilities. If both the parties are equally responsible for assets and liabilities, then joint operation. Other factors and circumstances check. If parties substantially take all the output, arrangement depends on parties funding. So for example, a separate company formed but parties are directly responsible for liabilities, joint operation despite a separate vehicle. It means what, ma'am? We've created a separate vehicle, but still if we are liable for the obligations directly, the creditors will come to you and I directly, not to the company, then it is a joint operation. So parties are called joint operators. They have rights to assets and obligations for liabilities. So ma'am, how do we account for it? How do we account for it? You will take your share in your balance sheet. So for example, in my balance sheet, I will take my share of joint operation and you will take your share of joint operation. Everything in the share, 50%, 20%, let's say 50%. So let's say joint operation revenue is 5 lakh. So 2,50,000 will be recognized in my book. 2,50,000 will be recognized in your book. So you recognize what? Your own asset, your share of joint assets, your own liabilities. Share of joint liabilities, you recognize revenue share, you recognize expense. Here, no investment. In my balance sheet, there is no investment in the name of joint operation. In your balance sheet also, there is no investment in the name of, no line item in the name of joint operation. But associates, So here I've given you journal entries. You can go through these journal entries once. Now, joint ventures. Joint ventures, the accounting treatment is exactly like your associates. So here you will apply equity method. The only one thing that you need to remember is in joint venture, you have only a right to net assets. You don't have right and obligation to all the assets and liabilities. So share of dividend, just like your equity method, we will apply. Just like your equity, you will apply. Okay. So with this, we complete this part. Tell me, sir, are we all okay with this? Yes. So I will have a word with the team. If at all you also have any questions, thank you. If at all you have any questions that should be discussed, just let me know. I will have a word with the team that if we can discuss those questions, and we'll do that. Okay. So I'll wind up for the day here. I cannot take more chapters because again it will go beyond 2, and I have another class in some time. So if at all, I hope this revision was fruitful, even though I was not able to cover as much as I required, but we have covered more or less 60%, I believe, more or less 50 to 60% of the syllabus we've tried to revise. I will update these notes and I will get back to you again, the questions and all part. I hope this revision was useful and I hope you were able to revise the concepts. Okay. Then I will see you. Let's see if we plan a schedule, we plan this discussion. I will see you then. Bye, sir. Take care. All the best for your preparation. Good luck with your preparations. Bye.